across the board. So no contractions expected. Jeff, the yield curve that you mentioned is a precarious one for the Fed to navigate, but it seems so far the message has been they're okay with it. They're going to hike anyway. We get a lot of Fed speakers here this week. Do you think the tone changes dramatically from the last message we heard from the Fed? Do they want to ramp up the hawk talk, dial it back, or just keep it on cruise control?
Oh, I don't know. I wish I knew the answer to that one. I think Chairman Powell's been very clear. 50 basis points is on the table. I mean, it's hard for me to imagine that with Neil Kashkari, one of the most notable doves, turning much more hawkish last week. It's hard to imagine you could hear even more hawkish talk out of central bankers, maybe just reinforcing the message that's already been put in place. Perhaps if we get more of an easing in commodity prices, they may feel less need to bolster their credibility, their inflation fighting credentials with rhetoric. But there's certainly that risk this week as right, we've got a lot of Fed speakers on the tape. We've got that jobs report, of course, on Friday, which may also influence the outlook for what the Fed may do next. Great stuff, Jeff. As always, thank you for the charts. Appreciate it, sir. Thanks for having me. Always great to see you, Oliver.
Same to you, Jeff Klein, Chief Global Investment Strategist and Charles Schwab. Let's talk some earnings and analyst notes out. We're going to do a little because there is a pretty interesting earnings report later on. We'll talk Micron later in the day. Right now, we need to take a look at some of the analyst notes out that are making moves, as well as a little M&A. That Nielsen story finally comes to a conclusion to some degree, and then we've got a few other analyst notes out to take a look at for Square price target hike. Stick around here. Bell's gonna ring in about 2 seconds.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Morning Trade Live. Stocks are opening higher. The Nasdaq by more than 1%. Russell 2000, same story. We've got risk on after a headline and a press conference from Russian officials pointed out a de-escalation that the market seems to like right now, drawing down forces in Kiev, Ukraine's capital. So that could be a potential next leg for this recent rally. Joe Mazzola joining us, Director of Trader Education at Charles Schwab. Joe, I mean, this seems like we are taking one of our big risk points and perhaps lowering the risk associated with it.
Yeah, it very well could be. First of all, it's a tough follow, you bringing me on after Klein Top, so I appreciate that. But I'll do the best I can, Oliver. Look.
You're a rock, Mazzola.
Yeah, well, I appreciate that. Thank you. So I think you brought up some good points in that, look, this could be just kind of some traditional Russian jawboning a little bit, just to slow things down a little bit and kind of regroup. So we'll see what kind of happens after that. But the one thing that I would point out is it really does seem like a risk-on trade seems to be back in this market. I mean, take a look at what you're seeing. You know, you and I were talking a little bit yesterday about the meme stocks and cryptocurrency, and you know, it does seem like the retail public's kind of stepping their toes back into some of these names. And when they do so, that gives them a little bit of room to the upside here. And I don't think by any means we're in overbought territory coming off some of the lows. And we'll talk about some of the RSIs and some of the stocks we got coming here. But for a lot of these, even after some of the big moves that they had, we're not in an area where you would look at that and say, okay, well, this is a little too far, a little too fast. There could be some more potential for a lot of these ETFs and a lot of the names that we're going to talk about today.
Joe, the response is pretty clear in this market. To your point, there are obvious risk points to this Ukraine story, the inflationary risk points and the geopolitical uncertainty. But for some of these companies that make fertilizer like Mosaic, or are businesses that benefit from higher commodity prices like energy, those ones are obviously suffering a little bit here, as we've got energy stocks down 3%, Mosaic down 9%. The market really believes this headline.
It does, and I think that, one of the things I'm going to keep an eye on is crude oil. You talk about energy, but just crude in general. It dipped below 100. I don't know if we're still there, but I was just checking a few minutes ago. Dipped below 100 per barrel in the WTI, and if you want to talk about something that can maybe bring the economy back to life a little bit, you get a sustained pullback in crude oil, and I think that you're going to start to see some of those sentiment numbers start to tick back up a little bit. We got the big jobs number at the end of the week here, unemployment. That's a lagging indicator. I'd probably keep a little bit more of an eye on today with the job openings. Definitely want to keep an eye on consumer confidence today. I think that's another big one to pay attention to. And then we'll have, I think we also have some housing data coming out this week as well. All of those have been, for the most part, pretty bearish indicators that the market's been climbing a bit of a wall of worry on. So, if those start to kind of turn around in a little bit more positive direction, like I said, there could be a few more legs to this.
All right, let's see if this can spur extension of recent strength. It is a little bit of a different type of strength. The Russell doing better than the NASDAQ this morning. Let's talk some companies. Joe, speaking of stories coming to conclusion, that Nielsen deal, someone finally pulled the trigger, and now we see this company going private, but story pretty much done after the takeover. This has been kind of rumored for a while, but I think it does suggest there are still risk takers in a lot of different forms. The risk takers in trading lately, buying those frothy speculative names, and obviously M&A always is a general sign of confidence and ability and willingness to lay out cash.
$16 billion for the old guard. I mean,
yeah, exactly.
It kind of sends a message that, I mean, we've been, I think we've been seeing the writing on the wall for multiple years now that there's this transition in terms of kind of what old broadcast news is, right? Compared to what you guys are doing here, or what we see with just ratings in general. How do you measure all the different ways that people view media nowadays? And I think that this is kind of the end of that old guard, this transaction for Nielsen. But $16 billion in an all-cash transaction, evidently Brookfield still sees some value there, so they pulled the trigger on that one. Great
assessment. The old guard, as this business really struggled without the need for the TV ratings data. Okay, elsewhere this morning, one earnings that's kind of interesting here, stock that's been cruising along sideways. McCormick up 1%. The Staples Group was also a place that held on pretty well when markets got volatile. So after earnings, it seems like the market likes what they saw. I do kind of wonder if the Staples will come under any pressure on a day like today if we get a big thrust of optimism. What do you think, Joe? I mean, is this a group that could be at risk?
Oliver, I will be pulling out the full ammunition of food puns on this one. The spice is nice for McCormick. I mean, look, yeah, you're right. The valuations in the staples are a bit high. I mean, even though the company said they're expecting sales to grow 3 to 5% year over year, they came and they beat on revenues, they beat on earnings per share. It does trade at a 34 times PE. It's 2 times the industry value. It does get a premium ranking within that industry, but the stock's already 25% up from its October lows. I do see some potential short-term consolidation around this level. You said it's been trading sideways. It's already kind of started to form that consolidation. You got the 50-day moving average right smack dab here where we're at between 98 and 99. you get a good earnings report. You got a little bit of a pop in the morning. It looks like it might be fizzling a little bit already. So I'm going to end this one off by saying, as an investor, you might want to marinate on this one a little bit before you dip it.
I like it. Nicely done.
Now I'm done. I got them all out of my system, Oliver. I'm done.
I was trying to think of one, but I didn't. It's too early for me to hit the puns. I'll have to outsource this to Ben Watson with the chart later on, our pun master. All right, so the stock looks pretty good, up 1%, and Staples as a group are, not a big winner today, but still up 0.75%. So we're not seeing a big unwind in Staples. We're seeing it really in the materials like the Mosaic and then the energy companies, and of course anything connected to gold too. So at this point, enough broad strength in the market to keep those staples going, though maybe it does lessen some of the potential utility of being in these stocks if the market's volatility is dropping. We've got VIX down below 20, 19. That's a pretty big move here. I mean, because even when we had some of these rallies the last couple of weeks, VIX was staying bid, but now this is a 4-week just drop. VIX is getting crushed here, which seemingly confirms some of this risk-on behavior.
Yeah, well, I mean, Oliver, 3 weeks ago was 38.
Yeah.
So it's halved, basically. It's been cut in half. It's just, look, it's as the market has been able to digest a couple of really important things, knowing, number one, that, look, the Ukraine-Russia conflict, I don't necessarily want to say that it's easing or that it's over, but at least they're coming for talk. So I think the market's been able to digest that a little bit in terms of, okay, it's not a shock to the system anymore. That's not to say that can't change. So we need to keep an eye on that. Fed, the Fed talk, the hawkish talk, the market can look ahead and say, okay, the Fed's got a plan. They have a plan, and we can adjust around that plan. And I think that to me is a really important component of why some of that volatility came out. And then kind of last but not least, Jeff brought up this point a few minutes ago, this idea that we have not seen a lot of negative earnings revisions. And I think that was something that heading into these last couple of weeks, there was a real risk and a real worry that heading into Q2 earnings, we're really going to start to see some of those negative revisions. And we have not seen those yet. I don't know. Analysts could be a little bit over rosy or in terms of their expectations. But as of right now, we have not seen those pull back.
Yeah, good point. As you mentioned, the chart from Jeff, still a lot of positive expectations for earnings and some analyst positivity this morning, too. 2 upgrades that we're looking at, price target hike at Square, and then an upgrade on Fortinet from Barclays. That one actually I think is arguably more interesting here. Cybersecurity company, another sector that did get a lift during the worst of the Ukraine and Russia headlines. So that's potentially a group that then might be exposed to unwind, but the overall earnings potential and growth potential for security companies like Fortinet, Barclays says you still want to stick with. They think it's going to 395, making a new high. The stock chart's been looking pretty good here.
It has, and I agree with you, Oliver, that you saw some rotation into the security names. Probably not as much as I think a lot of people thought. I think that when you initially started to hear the talk about the invasion of Ukraine, the first thing that a lot of investors looked at was, okay, let me get into these names because we want to protect against hackers. We want to protect against, some of the deviousness that you might see coming out of that region. And I don't think that you saw the big rotation that a lot of people were expecting. And I do think that this stock in particular, when you look at this double test of the 270 bottom in March and in January, showed that it has some relative strength here. And the RSI, speaking of relative strength, is only 60. So it's not in what we'd call like an overbought area. And that lends a little bit more credence. Barclays came out, as you mentioned, they upgraded it to an overweight from an equal weight with that price target of 395. This thing could have a little bit of room to go, especially kind of given what they talk about, the company's customer geographic and vertical diversity. That I think that helps a little bit because it does lend itself into diversifying that portfolio a bit, and it could give some room to a little bit more of an upside move there.
2% higher. Cloud stocks overall about 1.5% higher today. really important group that is still very, very far from its highs, but the cybersecurity stocks are closer. So to your point, there were still a very limited number of companies that were actually breaking out. Palo Alto was one of them, but a very short list where even some of that geopolitical, perhaps, bid into cybersecurity still had to deal with that long-term downtrend in cloud. So it'd be interesting to see how those companies respond and what type of leadership might emerge on a day like today after we get this headline. Crude's down almost 6% right now. Gold down 2.5%, and the dollar down 1% too. Russell's up almost 2%. So market's pretty busy this morning. There's a price target hike over at Square, and Joe, up about 1.9%. This stock, I think, is a good one to track right now because when its earnings report in late February caused a rally, it immediately went on my list of the top stocks to watch because it was like the first big, highly traded growth tech name to bottom on earnings. And now it seems like we're getting some extension of that, and analysts believe it's back.
Not only should you, kind of keep an eye on the earnings, but what basically with Square at this point, or excuse me, Block, you are taking a look at crypto, right? So as the world turns in Bitcoin, as the world turns in crypto, you're going to start to see that in Block as well too. I mean, basically this company, is down from a $280 high, so it's had a massive pullback, held the $100 level, pushing it back up towards 150. So it's had a nice little bounce. I mean, I think when you look at this company, you're looking at as the cash app. You're looking at what Afterpay could do. One of the things that I find a little bit interesting is that recent entry into the kind of the teen space with that cash app for 13 plus teens. As a parent of a 13-year-old, this is scary, but at the same time, kind of helps me know what my 13-year-old daughter is spending on, where she's going. So I do kind of like that cash app. I will say this, look, upping that price target to 215 from 190 gives it a little bit more room. And once again, if we talk about the RSI and some of these other names, this is around 60 as well too. So we're not pushing up to that 70, that 75 level where a lot of traders might look at that as overbought. Could have a little bit more room to go.
Okay. Block picking up the pace. I gotta get better at calling it Block. Give me a different ticker, please, Mr. Dorsey. How do you see the SQ and not want to go Square? Thank you, Joe Mazzola. Appreciate it, sir. Nice analysis for us here this morning, a coverage of some of the big swings happening in stocks. When we come back, let's talk some trades and let's look at some options. Speaking of reversals this morning, crude oil, obviously the worst. Energy companies paying the price, down about 2.5%.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave them Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
I'm Jenny Horn. Here's a few more of this morning's movers to kick off the trading day. Cowen named McDonald's a top Europe idea, saying that the restaurant chain has a strong value perception among that region's consumers. The firm said despite only a 40% European mix of sales, the investor narrative has remained too heavily focused on its U.S. business. The analysts have confidence in 2022 U.S. same-store sales outperformance, which should lead to positive sales revisions led by the brand's scale and store remodel program. Goldman Sachs reiterated its buy rating on Walmart, noting the company is well positioned in an inflationary environment. The firm highlighted Walmart's leading market position with the lowest prices and widest price gaps, which should support continued gains. It also gives the big box retailer optionality to raise prices if needed to offset the cost pressure and maintain its competitive position. And Wedbush added Petco to its best ideas list, saying it sees durable market share gains for the pet supply retailer. The analyst highlighted Petco's premium pet care business model, which has gained momentum and should drive share gains in the high growth and mostly non-discretionary pet industry. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Okay, let's get some stock picks and let's do some trading. Market's been open now and it's rallying still as the NASDAQ is pushing up towards 2%. The Russell is right alongside it. WTI is dragging on energy companies. Let's start there with Dave Wagner joining us, portfolio manager and equity analyst at Aptus Capital Advisors. David, good morning. Is this the end of the big energy trade here, or do we just need to take a break and wait to resume higher?
Hey, you're exactly right. It's a tough day for the black gold Texas tea out there. Obviously, continued talks with Ukraine and Russia definitely being a headwind for there. But, we continue to believe that oil, though it may be overbought right now, which is starting to pull on back, it still remains very much under-owned. If you look at historical weightings within the S&P 500, the energy sector has been as high as 27%, but has averaged about 11%. So from a weightings perspective, a constituents basis in the S&P 500, it is still very much under-owned by the market. And that definitely coincides being under-owned by hedge funds and actually active long managers also.
Does one need to be careful about the type of energy companies one owns, the high beta Occidental Petroleum type stuff? Is that going to be a little riskier if we lose the Russia bid than just, say, being parked in a Schlumberger or a Chevron or some dividend-paying classic?
Yeah, we've definitely seen the higher beta energy stocks, like you mentioned, Oliver, with Oxy definitely really catching a bid given their economies of scale and their balance sheet leverage that they have. So we do prefer more of the higher quality names if you're going on the E&P side, like PXD, or maybe if you go more towards the oil field servicer companies like a Halliburton, a BKR, a Tenaris. And what we're really seeing right now, Oliver, is a move from, in our opinion, and within our portfolios, from some E&P exposure to more servicer exposure. And this tends to be more of a basket trade on how we're playing this. And there's two primary reasons to be long oil servicers as a natural progression from E&Ps. First, global crude and product inventories are below average. It's currently at like 413 million barrels. This falls below the lower band of the running 5-year average. So we need more activity. We need more drilling. We need more production in order to supply that deficit. And secondly, oil and gas companies produce oil in a two-stage process called drilling and completion. The drilling the well is just like it sounds. It's just simply drilling. The completion process is a little bit more intricate because it brings in casing and fracking the well. These processes are also done separately, but there's been a lot of drilled wells out there, but not completed wells. So that's where you enter stage right, oil servicers, to really complete that process. And you couple that with uncompleted well inventory really being cut in half over the last 2 years. So essentially, producers have drawn down on this inventory and really in order to bring cheap production online. And that trend cannot continue, meaning we need to see more rigs go to work. The servicers are primed to benefit, and Halliburton is definitely the largest pure play servicer in the space.
I will say of a lot of the oil charts, the Halliburton one is a pretty steady as she goes, stepwise uptrend as opposed to some of the exponential Russia-linked commodity style moves that we got, perhaps maybe speaking to the underinvestment still in this industry that may now pay off. A lot of people were wondering why the drillers didn't immediately go back into the ground. Well, maybe we get an answer here that they want to do it slowly and steadily. Okay, we're going to trade it, Dave. Stick with us. You got another group on your mind, but we're going to trade Halliburton here. We'll be right back. I got Tom here with me. Tom, so how do you trade this? So what do you see in options on this 4.5% pullback? I mean, if you like Halliburton and the trend, then this is a pretty unique opportunity to pick it up on a big down day.
Yeah, and you have to wonder, you know, it just hit 3-year highs. It's pulling back a little bit with crude. There's a lot of volatility in this market. So it pays over a 1.3% dividend yield. So I looked at that first and foremost. So maybe I can get paid to wait on an option strategy here where I can buy the shares, collect that dividend, create some yield on a bullish position, but then I can sell an upside call against it to offset some of my costs on the trade, lower my break-even point, and create more yield because I am long those shares. So I looked at for every 100 shares of stock you buy, you go out to the May option series, 52 days till expiration, and I'll sell the 39 strike call against that. That's been some resistance levels for Halliburton over the last month or so. So this actually takes care of that where you're owning the shares, but you're creating yield on your position. You get paid to wait. If you pay roughly about a $34 debit for that, that's going to be your break even. Might be a little bit higher because it is off those session lows from the open. But if you pay $3,400 per spread on this, that's going to be your break even point. That's going to be your risk on it. But you get to collect that dividend. You get to collect the option premium for from the May 39 calls. And you can continue to sell calls against your long stock position, which will continually lower your break-even point and increase your profitability. So maybe a conservative type strategy like this may work if you're bullish on the name.
Got it. Okay, so take advantage of some volatility here, sell some downside, and hope it holds at $34 if you want an alternative to just the direct exposure to the trade. Okay, let's talk some home builders, Mr. Dave Wagner, a group that you like as well, one that has been going the opposite way. So we're just talking about a trend going up that's now on hold coming down. The home builders have been under pressure, but are trying to wake up a little bit here, despite some selling on KB Home's earnings last week. You like D.R. Horton and the group as a whole, right?
No doubt. Much like servicers, we like home builders as kind of a basket trade. You know, you're not fully getting an idiosyncratic story out of them right now because they've definitely been bundled together in the interest rate story here. But as you know, and just mentioned there, Oliver, being bullish on home builders is definitely an out of consensus call. They have definitely been stuck in a doom loop of higher rates fears since really the end of last year. But we vehemently disagree with the prevailing narrative that this year represents peak earnings, implying a theorized collapse of margins and/or buyer demand due to a combination of cost inflation and rising mortgage rates. The outlook for further earnings growth remains very strong, in our opinion, strong as ever, actually, underscored by a record supply-demand gap in housing inventory and a dramatically improved U.S. consumer balance sheet. You know, you really couple this demand, which you mentioned, KBH's earnings report last week. Management came out along with other management teams saying that, hey, demand has not decreased at all. So you couple that demand with the current valuation, the risk reward here looks really appealing to us.
Okay, we're going to take advantage of that analysis and get bullish, Dave. Thank you. A couple good picks for us here that have some really interesting setups. The continuation of trend, perhaps in oil services, and then perhaps the reversal of trend here in DHI. Hey, Tom, what do you think trading the home builder, different approach when you're at the lows instead of the highs?
Yeah, a little bit. You know, they've got earnings coming up at the end of April, so you've got to, concern yourself with that event risk in this name. But it has pulled back over 25% so far this year, off of those all-time highs of about 110 $10.50 just last year in December. So maybe gives you an opportunity. So I looked at a different option strategy here where I can take advantage of a move higher based on the fact that it's pulled back so much. You do have a bunch of headwinds here, Oliver, inflationary pressures, rising mortgage rates and such. So there are some headwinds, but this way you can define your risk using the option market as opposed to buying the shares. So I looked at that same May cycle, 52 days till expiration, where I'm going to buy just a call vertical to the upside where I think it's going to go higher, but I don't need it to go that much higher to profit. So buying the 80 strike call and then against it, because there's still some premium in those 90 calls, I'll sell that against it, creating a $10 wide bullish call vertical to the upside. If I pay a debit of $4, that's going to be my risk, right? $400 per spread. It's actually trading a little bit lower there because it's pulled back a little bit from session highs. But if I pay $4 debit, my potential reward's about $6, right? If this stock gets above $90 in expiration in 2 months, the width of the spread, it's going to expand to that. So you're risking $4 to make $6 on this. So you got a good risk reward scenario. You only need about a $2 or $3 move to the upside to get through that break even of $84, and you're giving yourself that duration. So a little bit more aggressive, but maybe you don't expect it to go back to $110, those all-time highs, but you expect it to go up towards 90.
Okay. All right, so a little bit more aggressive here. Some more direct upside exposure with the call spread. Buying a dip now that's months long going in home builders. Thanks for the trades, Tom. Thanks again to Dave Wagner joining us from Aptus Capital for the bullish take on Halliburton, D.R. Horton. Let's get ready for some tech. We've got Micron coming up. That's a big earnings. Going to be a crucial one to see how.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust the time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to
Oh,
wait.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Morning Trade Live. We are 30 minutes into trading and stocks are still strong. The NASDAQ has ebbed a little bit from some real strength earlier this morning. The Russell just shy of the morning high so far, a little bit under 2%. We're going to talk more data here, pretty interesting couple of prints. We're going to take a look at the consumer with confidence and also the amount of jobs still open, 11 million plus, 11.3, tons of jobs in America right now. We're going to look at Micron, getting ready for earnings. Chip makers have had a nice little bounce up off the lows, but Micron faded from some early strength and a little bit of hesitation to buy this morning ahead of its report. Very important chip maker that has a nice mix of the growth qualities as some of the big names like NVIDIA and AMD, but also one that's still connected into a lot of the more cyclical themes. Micron's going to be a really important report, so we want to get ready for that. Chartmaster's also going to take a look at a few other analyst notes out we haven't gotten to yet this morning. Let's talk about that data, though, with Mr. Ben Lichtenstein, host of the Futures Show. So, Ben, we see some strength this morning. Russell really shot out of the cannon there on that Ukraine headline, but now we've got some data that I think is generally pretty good, right?
Yeah, Oliver, again, this market continues to be headline driven. Whether you're talking eco data, earnings ultimately seems to be the least of such, but ultimately, as we mentioned before, some of the Russia-Ukraine headlines. But yeah, the numbers coming in kind of mixed depending on which number you're looking at here, and the indices are still enjoying some positive territory here this morning. Commodities on the move as well. Let's take a look first and foremost at the strong point here. We've been hearing from Fed Chair Jerome Powell about how labor conditions here in the U.S. are very strong, continue to be, and can sustain a couple rate hikes. Well, I think we're getting a sign of that this morning. The JOLTS number came out. We're talking job openings, layover, the turnover survey, basically, Oliver. And if you remember, the number that came out last month was not a record high because of the prior months got revised higher to 11.448. Last month's at 11.263. Well, they were looking for 11 million, and in this case, well, they came in a little bit higher than expectations, 11.266. So, again, kind of feeding into that narrative. The Fed Chair Jerome Powell has been very clear about. The survey actually said that hires edged up to 6.7 million, while separations were little change at 6.1 million. Now, it was interesting because, again, that was better than expected, but back in the middle of March, the survey, the Bureau of Labor Statistics actually had come out with a number basically saying that 13 states, they had seen decrease in job openings in 13 states and only increases in 8. So I was expecting to see a little bit of a weaker number, but again, a little bit stronger than expected there. Now, on a disappointing front, we saw a number come in here this morning, and that was our consumer confidence number. The number came in a little bit better than expected, Oliver, at 107.2. They were looking for 107. Prior got revised to 105.7, but this number's been missing the mark here, Oliver, and again, a bit better than expected, but down from, I think it was the 115 we saw back in December. Last summer around this time, we were talking up around 129. So with rates on the rise, it has cut significantly. So,
and the revision is kind of an interesting one too, right? Because we revised the last reading lower, which means this one was a little bit higher than the last reading, but we thought it was 110. Turns out it was 105. Right. So 107 kind of just in the middle here of kind of the last two readings we've gotten that are still well off that record.
Which I think you can understand when you talk about rates on the rise at the trajectory they have and the pace they have and the more hawkish tone.
Everyone's thinking inflation.
Geopolitical tensions. I mean, this is going to weigh on sentiment in general, in addition to the fact that when you're at the pumps, you're paying more nowadays. You're at the checkout line, you're paying more for some of these products. Commodities in general have been on the rise, and that weighs on sentiment. So I think these numbers about what you'd expect to see. Again, labor conditions remain very strong. Sentiment seems to be waning a little bit.
Okay. All right. Stocks taking a little bit of a breather here from the strong early start. Data mixed, a lot of jobs. That's good. Trick is getting the jobs filled, which Powell wants to see. That number going up is kind of in the wrong direction to some degree, where we're looking for more participation in the labor market. All right, Ben, thanks for the update here. Consumer confidence is still off those highs, but stabilizing here. Still above 100, too, even with all those negative headlines swirling. All right, let's talk some earnings here. Michael Keeley joining us. Mike, so as Ben mentioned, earnings have not been the main driving force here the past week as we're pretty much late in the season, but there are some important names, and Micron, I think, is definitely one of them.
I would agree with that, Oliver. And you take a look at the stock's price action coming into this print, and it's been all kinds of volatile. with some very, wide swings between highs and lows, particularly this year. And so when we take a look at it, the analyst community is altogether bullish. Oliver, you've got 15 sell-side analysts, not a one has veered away from the buy profile on this. In terms of recommendation, with price targets generally between 100 and 119, and that does reflect the growth opportunities here that the analysts are foreseeing. When we take a look at the ramp up on a year-over-year basis of sales, should they hit the mark for this quarter that they're going to be releasing here, that'll be up 20% off of last year's sales. And should they hit the mark on the earnings side, Oliver, that'll be up 98% from last year's same number. So we've got where you have the disconnect is a couple of levels. Number one, you take a look at the option pricing, and there's expected volatility on the basis of the earnings being released. You've got a market maker move of up over $6 on Micron right now. And you take a look at the last 4 quarters, the firm has come in very close to what the analysts had mapped out for the EPS. And the EPS estimates have risen over the last 30 days. Western Digital had a contamination issue, which affected some production thought to benefit Micron the most in the NAND category, flash semiconductor space. But what I was going to say about the analyst's view, Oliver, is that you do have a bit of a disconnect in that there's a whole pile of analysts that say the entire area of, the main area of DRAM is a story of oversupply. But then you take a look at the pricing, and the pricing's holding up pretty darn firm for the products that are being supplied, and DRAM has not been a part of the supply chain issues. Yes, if there are impediments to getting PCs built because of supply chain issues and shortages of things like certain semiconductor chips in the GPU space, then that can have a trickle over effect. But there has not been a supply chain issue affecting end demand for DRAM. So analysts a little bit perplexed right now, some of them scratching heads and saying, why aren't the prices going down if there's this degree of oversupply? Other analysts saying there might not be this degree of oversupply if that's the case. Man,
tough to figure out right now. That in a way for Micron, I think is pretty well reflected on the chart. At $80, this is a level that it traded at last May. We were there from a good chunk of last summer. It seems like an area that's kind of a midpoint, even over the last 6 months when Micron made a high and then went back to a 52-week low in the broader market sell-off. $80 has kind of been the midpoint. So we're right at this juncture as analysts are trying to figure out if this is a good situation for Micron or bad situation for Micron. That's kind of the double-edged sword of shortened supply, right? You can get prices to be elevated and sticky, but the scale and the volume may be what you have to sacrifice.
That's right. Although the projections on a go-forward basis are looking quite robust, you go out to next year, 2023, and you've got 15% projection on the hyped up sales, and then 23% increase on the earnings out into that, more distant future. Another element that would be of a positive nature here, Oliver, is that analysts and investors do like the sound of, the firm really advocating for a return of capital to shareholders, specifically out of their free cash flow. They got their dividend up and going last year, and that was a vote of confidence that a lot of the analysts did like. Said, well, that removes a lot of that uncertainty about the highly cyclical nature of the business for the firm to commit like that.
Okay, so Micron has a lot to live up to. I mean, with the analysts all bullish, the stock right in the middle of its trading range, and arguments to be made in both directions for the intermediate term outlook. It seems like the long-term one and the EPS growth is one that investors can find some solace in, that this is a very earnings-driven business too. This is not a cloud stock that needs hyper growth to offset the lack of earnings. It's a company that's got top-line growth and bottom-line growth, which you'd think would make it attractive, but still has a lot of proving to do with so many bulls with high expectations. Okay, Mike, thanks, Mr. Keeley. Nice setup for Micron. Going to be a fun one to look at this afternoon. Let's bring in Tim Bigham and let's trade it. He's lead option strategist at Delta Derivatives. Tim, good morning, sir. What do you think about Micron?
I don't really have that high of expectations, on the stock, given the rally we've just had in the overall market and the stock. I think the price action today kind of alludes to that, where you saw, Micron, tech stocks, chip stocks all rip higher on the open, but immediately kind of soften here. So I'm actually staying away from, the weeklies that I normally like to play, simply because I think the expectations from the market maker standpoint have come down sharply with implied vol coming down. So really not getting that big of an edge on the weeklies, but some of that IV has led to the back months, as it always does. So I'm just going out to June and hanging my head at the $70 level, like that on the chart on a technical basis. If it gets down to there, we're looking at under a 12 PE on a current basis, probably about an 11 on a forward basis. So I'm selling the June 70-65 put spread, getting some of that earnings IV even in that back month. But more importantly, not being an aggressive buyer here. I think it probably pays to wait, certainly on Micron, and I think stocks generally here, given the fact that we've seen such a, straight up move post-Fed, using Apple. Apple's been up every day post-Fed, be 11 days in a row if it hangs on here. So things getting a little frothy to the upside. I'll be patient and be a buyer to the downside, and receiving some pretty decent premium on Micron, even though it's not the earnings week. Having earnings coming out still bleeds into the back months.
Okay, so you're able to get a break-even level here that is right at the 52-week low. So that's a pretty seemingly good spot to assume there'd be some support, there would be some buying, and if we don't get down there, you collect a little premium. If we do, then you buy a good stock at a 52-week low.
Yeah, absolutely. I think that's probably the way I would generally play the market here, just given the rally we've really had here that is getting, I think, a little over, its skis here. So I think picking out spots on the chart here on both a fundamental and technical basis, selling some puts there and then hedging accordingly, not only to lower your margin requirement, but, also define your risk. Makes a lot of sense here. VIX isn't up at the 32 level, but it's still rich enough to be selling premium here. It's at the upper end of that kind of normal regime, 16 to 22 on the VIX. So vols come in, but certainly still high enough, I think, for selling. And given the fact stocks, I think, have gotten ahead of themselves, selling puts or put spreads is probably a better approach, in my opinion, than going out and grabbing shares here. Patience will pay, and you'll get paid for that patience.
Okay, seemingly is also particularly resonant with this stock down 0.2% this morning. NASDAQ has slowed down. We're now just 0.5% higher, but Micron in the red does suggest maybe some hesitation, at least until we get through the report here. Chip makers are about 50 bips in the opposite direction as a sector, are higher this morning. Tim, what does your trader instinct tell you about reacting to headlines like the one we got overnight on potential drawdown of Russian forces in Ukraine? Is this the type of thing that you want to make a move on, or should investors look for a few pieces of confirmation to this story?
Yeah, I think the headlines are starting now that we have oil, back at more reasonable levels here. And certainly that chatter before that oil is going to 200 or 300. We heard that in 2008 before. So I think look at history, and I think the reaction to headlines, you almost want to fade the initial move on it, kind of what we saw this morning with oil getting bashed, stocks ripping higher. So especially when you've had such a big sort of trend, when you get the headlines at the end of the trend, you can really start to play them on a counter trend basis. So I think we're at that point here to the upside. So I would almost look to use any kind of good news coming out to kind of sell into, but be more patient to the downside. I think the pullback from here will be bigger than any further gains, at least over the short term.
All right, there it is. Tim Bigham, thank you, sir. Good stuff with the Micron prep and thought here on the brown market. Tim Bigham, lead option strategist at Delta Derivatives. Coming up, let's talk some more earnings. We do have another company after the bell, one connected to a sector we discussed earlier, housing, Restoration Hardware, aka RH. These shares too have found some weakness in these last 6 months. RH actually peaked last August. It's a very unique chart. It's one that's really struggled.
Go to the Analyze tab and select Fundamentals. Then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, the Chart Master is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chart Master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to Morning Trade Live. Equities are still in positive territory, but we've lost some of that initial momentum higher. Let's continue to talk earnings this afternoon. In addition to Micron, we've got Restoration Hardware, ticker RH. Also now named RH2, I should be specific. Jamie Katz joins us, senior equity analyst at Morningstar. Jamie, you've got a 2-star rating on the biz. If I learned anything from Roger Ebert, that's pretty average expectations.
Yeah, I think we actually have the shares in fairly valued territory right now. Obviously, as you'd mentioned prior to the break, shares have come off pretty significantly in recent periods. And so from where we stand today, I think we're looking at a name that has probably about 5% upside to our $407 fair value estimate. But, that's after the shares were riding that 700 plus last year.
So is this a reflection of housing overall cooling down, or just the high-end stuff that maybe will be hard to maintain if inflationary prices are sticking around? What's the risk point to Restoration Hardware? What could limit its upside?
Well, I think there are two sort of key factors here. In the past, we've seen these shares struggle, and demand often struggle during periods of high stock market volatility. And it's something that was addressed on last quarter's conference call, the CEO had called it out, that the demand can be often lumpy, and that stock market volatility doesn't bode well for the business, given the high end price points of the products that are being sold. The other piece is, after 2 years of a lot of spend on housing, the trends on discretionary spend are evolving, and they're moving back from the home to things like travel and dining. And I don't think that's necessarily surprising, but I think, the expectations are coming back to a more normalized area. And I just want to point out that, in our forecast, we have sales rising 10% next year, and that is not necessarily a bad growth rate for a furniture business. It's just not the growth rate that it was at over the past 2 years throughout the pandemic. So I think there's some rationalizing of expectations going on here.
It's really interesting how housing was so powerful that we see a stock like RH trade similarly to some of the other COVID
impact of implied volatility could help the trader. It also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like calendars and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on thinkorswim for the full options for volatility course and a whole lot more.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Good morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Let's take a quick look at the markets. You can see plenty of green here today as markets continue with the up arrows. Here's a look right now. The S&P is up 35 points at 4610. The S&P is gaining 0.75%. The Dow up 266 points at 35,217. The NASDAQ gaining 140 points at 15,128, and the Russell 2000 up more than 2%, 2.1% at 2121. Now to some of the movers in the markets watching Apple and Tesla this morning. Both stocks have closed higher in the last 10 sessions. Now, Wedbush's Dan Ives will join us in the 360 Spotlight to talk all about Tesla's potential stock split news and Apple's iPhone SE production cut and more. Shares of Nielsen did spike higher after it agreed to a $16 billion all-cash deal to go private. $28 a share. The deal with a private equity consortium is $2 billion more than the deal it rejected last week. A couple of analysts, Morgan Stanley downgrading Pinterest to equal weight, cutting the price target to $30, down from $53. The analyst said slower than expected user growth and ad growth is troubling for the stock. Deutsche Bank downgraded CVS to hold from buy, maintaining its $110 price target. The analyst believes the pharmacy's exposure to a recent crackdown on low-cost drug program and its planned expansion into primary care could hurt the company. FedEx announced that its founder and CEO Fred Smith is stepping down on June 1st and will be replaced by the current president and COO. Smith founded the delivery company 50 years ago. Let's check out the futures products. I heard one of the traders shouting, "Oh, crude under $100," and that's exactly right because you can see it at 98.29. It's down 0.75%. I'm sorry, crude oil right now is at 102.85, but I did hear it under $100. Here's a look at Bitcoin. Bitcoin at 48,035. The U.S. dollar's down slightly. Gold futures down 1.5%, and the VIX 22.08. Let's get some insights on the news shaping the markets, and for that we welcome in Rob Fleming, Senior Market Analyst with the Schwab Center for Financial Research. Rob, thanks for being with us. So glad you're here. So tell us about how you're feeling about the news. Obviously, we hear more peace talks, and I think the fact that they've been called constructive has given a little oomph to the market. What are your thoughts?
Yeah, well, good morning, Nicole. Thanks for having me on. Yeah, I definitely saw in the pre-market action the markets turn on those headlines there. Still a little bit of skepticism on if that does come to fruition here. We've seen several rounds of talks come and not end in any progress there. So just got to be mindful of that and see what comes of it.
And so now at this point, when I was looking, so the Dow and the S&P are up 4 days straight. In fact, this is turning out to be a pretty good month here. Can this rally continue?
Well, we think we'll see volatility for the foreseeable future here on both sides, up and down. I think what we've seen in the last 2.5 weeks here is we got some clarity from the Fed. It seemed like this rally started when we did see the Fed's statement and come out and take action there, and that seemed to provide some uncertainty being cleared up there. We did see crude oil come off the boil a little bit from that surge that we've seen, so that's definitely helped. And we're seeing Q2 and Q3 earnings holding up there, so that's probably adding to some of this. But we think moving forward, as the markets contend with the geopolitical front and how aggressive the Fed's going to be, we're still going to see some volatility moving forward.
Right. Yeah, and the Fed, I mean, there's been talk of 50 basis points for the next 4 meetings, or 4 of the meetings, I should be more specific. Your thoughts? I heard that from Citigroup. You think people are feeling that the Fed's really going to make those big moves?
I'm not sure about 4 of them, but definitely the 50 basis points May, June looks like that's being priced into the market there as well. So we'll have to see. We got some Fed speak this week, today and tomorrow as well, so we have to gauge that. But also take a look at some of the data points that we got coming out this week, particularly the ISM manufacturing, looking at a prices paid component and supplier delivery times, new orders. And then we'll get the personal consumption expenditures as well coming out. And that's a good report because it's going to show real spending, inflation-adjusted spending. So we'll see how much inflation is hampering consumption at this point.
So that's a big point. And that's when we know at some point where inflation becomes so high, people stop driving or they stop buying their favorite things at the supermarket and just buy exactly what they need. That being said, at this point now, we're waiting on a jobs report on Friday. How important is that report? What will you be looking for?
I think that the headline figures, I'm not sure how much that's going to move the markets at all, but we're looking inside the report for the wage component, average hourly earnings, the average work week as well. Same with the participation rate, because we saw the JOLTS job openings, labor turnover data today come out, still remaining well above the amount of unemployed. And I was also surprised by the amount of the quit rate of people voluntarily quitting their jobs actually went up. It was trending lower for the last couple of months, and it went up there. So trying to look at how we start getting those jobs filled and start helping bring those numbers down, and that'll in turn help the supply issues that we have and hopefully tame some of this inflation that we're seeing.
Yeah, I know something that was on your list today was really a lot about rates and where we stand short-term, long-term, and rates that really affect folks such as mortgage rates and others for loans, autos, businesses. Tell me a little bit about what you're seeing with rates at this point and what it could mean for folks.
Yeah, we're definitely seeing where rates have an impact. We've seen housing data the last week or so come out, definitely being hampered by the rise in rates. When you're looking at shorter term loans, car loans and such, credit card loans as well, we tend to look at the shorter end of the curve that tends to feed off of that. But the longer end there, we're looking at how the markets are interpreting what's expected for the economy as a whole there. So we're seeing that kind of getting close to that inversion of the 2-year and 10-year yields there. It's getting pretty close right now, and that's part of our recession checklist. Now, we're not saying that a recession is imminent. That's not even our base case, but we're definitely watching the yield curve and the inversions there, because those have a pretty good track record of preceding recessions. Now there's a wide range of how many months after the inversion that a recession does occur, so you got to keep that in mind.
And as the S&P 500 has been moving higher, we were speaking of that. In fact, it's at the highest levels since mid-January. So as stocks have been moving higher, the VIX has been pulling back, right? Makes sense. So as traders and investors look at their portfolio, are we ready to make any changes in the longer term portfolios?
Well, we always maintain that having a well-diversified within and across asset classes targeted to your risk tolerances, time horizons, and then being disciplined on rebalancing, maybe using some of these rallies that we got here to make sure that your allocation is to your target here. We're not recommending taking any excess risk right now, so we're recommending taking a look at your plan and making sure you're not over your skis in any certain portions of your portfolio, and take advantage of these moves to maybe trim high and add low. And for the active trader, the short-term traders, we still are saying, the value factors, earnings growth, balance sheet strength, cash flow yield, things of that nature seem to be outperforming and have outperformed for quite some time. And then also, in this volatile times, as we see gaps overnight, maybe look at taking profits a little bit earlier, or limiting your share size or dollar amounts on your trades.
Understood. Rob, thank you so much. Rob Fleming, Schwab Center for Financial Research. Thanks for being with us, Rob.
Thank you.
Plenty more to come right here on Trading 360. Wedbush's Dan Ives will join us. Dan is going to talk all about Tesla and Apple, Tesla's potential stock split, and Apple's iPhone SE production cut, and more on tech. Anything else on his mind? Fortinet is today's disruptor after Barclays upgraded it to an overweight rating, and George Sillis is back, and he'll have all the details and a way to trade it. And we will preview Chewy earnings in our 360 round. But up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals, and Achilles Larea from Larea Wealth Management takes us through the trades for Boeing, Tesla, and Coinbase. That's next on Trading 360, live from the New York Stock Exchange.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides, live in the New York Stock Exchange. Thanks for being with us. It's time for the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts, and here to take us through the trades is Achilles Larrea, founder, CEO of Larrea Wealth Management. Thank you both for being with us. So, Achilles, we'll start with your first name here, and that is Boeing. As I see this chart and see it under this $200 line, it's going back and forth here, but not a great chart. Tell us why this one's on your radar, Achilles.
Well, anytime, you have to realize that with a company like Boeing, plane crashes are part of their risk model. You're going to have that time and time again. That's never going away. But that doesn't mean that the company is fundamentally unsound. We believe that this stock is going to keep rising in spite of that, and that we're looking at easily a $200 price range in a 12 to 18 month time frame. We're also thinking that this company has more value than just the planes. Everybody thinks of Boeing as their planes, and yes, it's a big part of their business, but they do rockets, they do a lot of other things that are big money ticket items. And they also do a lot of leasing. There's a lot of diversification of income as far as this company is concerned. And we think that this stock can be a big winner for our clients long term.
And UBS also stuck to their buy rating. They agree with you. Of course, the plane crash you were talking about was the 737 Boeing jet that crashed in China. And so, that is obviously something that Boeing has had to deal with over the years as part of the headlines. That being said, a couple of buy ratings, a couple of buy calls. Ben, as you take a look at the chart, what are your thoughts?
Good morning, guys. That all having been said, obviously, again, the tragic event, I think considering the stocks fared pretty well, it's nearing some key resistance at that point, at this point, which has me a little bit concerned. But, Nicole, I think you really hit the nail on the head. You said it's been mostly back and forth, and for the most part, it hasn't had a lot of directional conviction for a while now. But again, after topping out back in February, I think it was, of 2019, up around 446, it's really struggled due to some of these fundamental kind of underlying unease or uncertainties that the news and the recent crashes have created. So again, here you can see the 60-minute time frame, the hourly, and the recent move off the end of November highs. We saw up around $232, recently down to $162. So basically a 50% decline here, a big move to the downside here in terms of net change, and they're are trying to claw their way back, but right into this kind of quadruple bottom that we saw right around this 190 level. So it'll be interesting to see if they can gain some momentum to the upside here. 60-minute time frame again shows this nice move now from 162 to 194. But as we take a look at the daily time frame, you're going to see that we're kind of running into the 50-day moving average right now. We're well below the 200-day moving average. And I want to point out where RSI has a little bit of room to go. The bulls want to see it take out a couple of these key moving averages. And, in terms of what we're seeing here, it almost reminds me a similar pattern potentially in terms of what we saw into the fall of 2020 when we came into earnings. So you can see again, we were kind of bottoming out, and we got a nice little lift from that, a nice move up, held above into, nice little run up here, held above the 50-day moving average and above the 200-day moving average all the way until we went sideways into the summer of last year. Now, lastly, I just wanted to point out the weekly time frame. I have this channel drawn because the lift that we're getting right now I think is significant, and I pointed that out again back up to this 194 level from the 162 area. But here again, we're just kind of running into at some point the top of this channel. So again, some key areas to look right now in terms of that moving averages and also in terms of this recent channel on the weekly time frame. This will be key if we can get back above that.
Right. Okay. So let's, Achilles, take a last look there at Boeing before we get to your next one. I want you to comment on what Ben was showing us on the charts.
Yeah, absolutely. And here's what you have to take away from this. When the crash was first reported, the stock went down about 10 points. We went in at that point. We were picking some up around the 29.68 level. I'm sorry, not 29.68. We were picking some up when that first occurred, and then we've made some money on that. We feel that this is still a great way to complement your portfolio with a well-known name, and to make sure, don't go and buy more than 5% for your total portfolio. We're keeping it within bounds, and we believe that the stock is a winner.
Understood. Okay, I am looking at Tesla. So many headlines when it comes to Tesla, the amazing run it has been on of late. The talk of a stock split and looking to the shareholders to approve more shares. All the other names, by the way, are also higher from, some of the peers in the group. Achilles, what are your thoughts here?
We've made 78% year to date on the stock. We believe that there's a ton room more. The stock split represents an opportunity, not unlike Amazon. When Amazon announced their stock split, and that was a 20-for-1. This represents another opportunity for people to get a high quality company and get more of it at a later time. But once again, we're going to go in, as I mentioned with Amazon, we're going to go in now. We're going to go in when it splits and a little thereafter. It is our strategy. It has really worked well for us over the years with other stocks. And we believe that this is a winner overall, to have a well-known name, get double-digit returns, and take advantage of that split.
Yeah, it's pretty amazing here. I mean, often we see stocks running up ahead of the split. You said you're going to go in before and right after as well. Ben, your thoughts here as you take a look at the Tesla trade. By the way, folks, we'll have Dan Ives from Wedbush later in the show, so I'm looking forward to speaking with him about this. Tell me, Ben, your thoughts on the chart.
It has been amazing, to say the least, here in a couple different ways, and we'll get into that. But I think this is an exciting space in general, and I think investors are, we're seeing their appetite for some of these names. So again, as the broader market here has rallied back, Tesla's done really well compared to the NASDAQ. The NASDAQ today just getting back up above 15,000, just getting back to those Feb highs over the last couple days. But take a look here as Tesla, they took out the Feb highs basically a week ago. I mean, again, you can see the run up here. Here's the Feb highs up around this 950 level. And so they have been off to the races, continuing up and through the $1,100 level. So just shy of that right now, currently trading up on the day by 0.25%. Now, we've seen some other big tech names, Amazon, Apple. I think you mentioned Amazon, Nicole, but Apple also on the move again. They're seeing the best week. I think it is best winning week since 2003, but a nice run up here. And I do want to point out again, if you take a look at the daily time frame, you'll see again the net change here. Again, year to date, we're talking only up by about 3.5%. But look at month to date here, up 25%. You can see the big move that we've seen back off this $800 level. That gets us through the 50-day, the 200-day moving average. It looks like we may be able to avoid a death cross here, which investors were concerned about. Now, you can see that the RSI is a little bit overextended at this point. You can also see a couple of the hurdles that we still have to get up above. We'll just call it a double top-ish area that we have around that 1,240 level. I wanted to look at the weekly because I wanted to point out this is exactly what the Boeing bulls are looking for. Remember, we were talking about how Boeing is kind of in this a bit of a channel to the downside right now. Well, again, in a very similar pattern in many ways, how if Boeing bulls could get some energy to the upside in terms of what we're seeing with Tesla, well, this is a very bullish pattern here. We oftentimes talk about these ranges that form through the middle. In this case, we'll call it 1,000. Oftentimes opened up the door for a retest of the upper extreme. So, yeah, there's some momentum going here right now. Again, the one thing that has me a little concerned is the RSI is a bit overextended here, Nicole. But again, that's on a daily time frame. I think one thing to take note of, and for two, a reminder that it can stay that way for a prolonged period of time. And there has been some strength there, to say the least, yes.
Final thoughts, Achilles, on Tesla as Ben summed that up?
Yeah, remember, we're going to be going in 3 different times, 3 different trades. So we're definitely going to average our costs inward. But once again, owning a high quality stock, brand known name, an innovator in its space, we believe that you're going to do well with this trade.
Yeah. Okay, let's turn our attention to Coinbase. Obviously, we've seen Bitcoin pull back, even though it's run up a little bit recently. Coinbase, much of the same in that it's well off its 52-week highs. Achilles, do you see opportunity now for Coinbase?
Of course, Nicole. When you see a stock getting beat up along with cryptocurrencies, this stock does pretty much what cryptocurrencies do. So crypto has been in a bear pattern for a long period of time, but also coming out of it in a very quick manner. So Coinbase doesn't really have any buildings or any assets per se on the big side. A lot of their model is remote and the like. This is where we see the opportunity. When we start to see the run up in cryptos, this stock goes up accordingly. It's up almost, I believe, 16% just in the last 2 months and a half. And we see it going up further because it has been tested quite a bit during that time period. So just going forward, another name to own. This is one where you really have to be cognizant that you're not going to own this for a long period of time. You're going to own this for maybe a 12-month period, in my opinion, maybe less. But we see a definite pattern on the upside, a definite pattern for making money for that short frame time period.
Interesting. It's not too often that you come on and say for 12 months or maybe less. Ben, what do you think when you take a look at this Coinbase chart?
Well, I think that's actually kind of important because relative to Bitcoin, although, again, we've seen coin get a bit of a lift with that appetite for crypto coming back into play, that kind of risk-on, cautious optimism, I guess I've been calling it, again, over the last week or two now since we've come off those March lows. Again, we were just talking about the indices and the tech names that have rallied back. But, you know, this is one that's been lagging a little bit relative to Bitcoin. Again, Bitcoin actually broke out of a range back to January levels, mid-January levels yesterday. But here you can see, again, coin is lagging a little bit relative to. So I want to point out that, well, maybe Achilles is right here in terms of the potential for a short-term lift if we were to get some follow-through as far as Bitcoin. But, Nicole, you mentioned Bitcoin's having a hard time kind of seeing some follow-through today, which is a little bit concerning considering, well, the broader market here is getting a little bit of a bid. But still, again, a ways to go before I can get really excited about this one. Possibly a bottoms in here, but I want to see some of these areas that were established on the way down get taken out. For example, first and foremost, the Feb highs ultimately, and then, as mentioned here, back to, well, as Bitcoin's been able to get back to the mid-Jan levels, I'd like to see coin do so as well. I don't need to be the first one to buy the lows here necessarily. I'd like to see some momentum to the upside, but you can see here, speaking of momentum, there has been a little bit in terms of back above the 50-day moving average. The RSI has some room to expand here. One thing that's encouraging for the bulls, look at volume. It's really increased over the last recent levels. But I do want to point out, I've got my eye on this 220 level. Again, I think it's going to be important. Here we are right here, the upper extreme of this range that we've been in basically since the gap down that we saw, if you remember, back at the end of January, middle to end of January. Take a look at the weekly time frame. You can see again here, really this is that 220 level. So you can see the big move down. And since then, we kind of been a little bit more rotational after bottoming out around 150. So I think that's the next hurdle to get up above here, this 220 level. And then could be some potential to the upside. Also take note that 220 level coincides with the lows that we saw May, June, July, and through the early fall of last year. So prior to kind of failing up around 360 after an attempt to break out, you can see that really well-defined series of lower lows and lower highs on a weekly basis all the way down to 150. So again, I think 220, the next hurdle, 150, the level to the downside that the bulls want to be a bit concerned about. Should we take that out?
I'm glad you did the upside and the downside, especially with that 220 on top, considering that we've seen Coinbase down 21% at this point. So that's a good point to make there, Ben. Thank you for that. And thank you both, Achilles Larea and Ben Lichtenstein, for today's Big Three, Boeing, Tesla, and Coinbase. Appreciate it. Coming up next, Dan Ives is standing by of Wedbush. He's talking about some of these hot stocks, Tesla and Apple, both making news. Both have been running higher. He has all the details and much more next here on Trading 360.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Let's take a quick look at the markets. We're looking at the Dow at 239 points at 35,194. The S&P up 0.75%. The Nasdaq gaining 1 full percentage point at 15,140. And the Russell is gaining 2% as we speak. We have a very special guest with us right now, and it is time for our spotlight. We're spotlighting Tesla and Apple, two names that have been on the run. Dan Ives, Managing Director, Equity Research at Wedbush Securities. Of course, all about his Tar Heels. We'll have much to discuss, Dan Ives. Let's start with, you've loved these names. You've touted these positively based on the fundamentals and your channel checks. Let's start with Tesla. So is this the right time for shareholders to issue more shares so they could do this stock split and move forward? Tell me your thoughts on the big Tesla talk now.
Yeah, and look, this is obviously the second stock split in as many years. I think it just shows, just how strong they've actually gotten in terms of demand. As demand continues to play out on EVs, this stock, in our opinion, is going to continue to move higher. You look at Giga Berlin, you look at Austin, supply was the issue. That's no longer an issue. And Nicole, in my opinion, this is really just the start of this next leg of the Tesla story.
And what do all the contrarians say that you think is absolutely out of line when they talk about Tesla? That just gets under your skin, and you say they really just are not as informed when it comes to Tesla. Is it Elon Musk's leadership? Is it what else Tesla does besides the way they're able to produce the vehicles and keep their promises? What is it that you would say to some of those folks that are really on the downside of Tesla?
Yeah, look, I would say if you've hated a stock at $100 and now split adjusted, you hated it at 5,000. I'm sure, again, if these were NFL scouts, they would have hated Tom Brady coming out of Michigan in the 2000 draft, right? So I think it just comes down to haters will hate. But if you look at what's happening in EVs, you look at how they're building out in Berlin and Austin, you look at overall demand, they could be looking 1.6, 1.7 million units this year. Going into next year, we could be looking at 2.5 million. So as this all starts to play out, I think it's a re-rating story, but also it's because of profitability. Now they're starting to really ram profitability. And as a risk on starts to take hold, Tesla is going to be front and center.
As we look, and I see so many of the other names are higher, right, in the group overall. But I think so much of it, and you tell me, is Elon Musk. And my worry one day is that he puts out on Twitter, Tesla's doing great. I'm going to focus more on my rockets or whatever else is his next baby. And what happens to Tesla shareholders? Don't you ever, because I know we have some issues now that may be some headwinds, such as in Shanghai, the shutdown of the plant. We've had supply chain issues, which hasn't really affected Tesla as much. But is there anything that could be some major headwind that could be realistic?
Yeah, well, first of all, I don't see Musk leaving as CEO probably till at least second part of the decade. So I don't think that that's something that's really a risk in the next 4 to 5 years, especially as FSD starts to continue to ramp. I mean, look, the biggest headwind is, of course, China shutdowns, a zero COVID policy that could strain supply if that continues. But outside that, we don't really worry about too much, fundamentally speaking, as it plays out.
Mm-hmm. All right. How about we turn our attention to Apple at this point? Both these names have been driving higher, as you said they would. You've liked these companies for a long time, the leadership, the moat, the products, the brand loyalty, all kinds of things. Slowing down on production, is this a big deal or not a big deal?
Yeah, it's not a big deal because that continues to be tangential in terms of iPhone SE. iPhone 13 is really going to be front and center. Demand continues to expand. I think as that plays out along with services, it's a re-rating story. And in my opinion, this is a stock that continues to move higher.
As we saw Coda winning over at the Oscars, how much is the streaming side of this going to become a story? Because really, Apple TV really didn't feel like a major competitor, did it? I mean, like we saw Disney come on and get all these subscriptions, and there's so much other talk. Apple TV wasn't really front and center. How about now?
I think that, look, I mean, it's historic, right? I mean, for a streaming player to win Best Picture, and it's not Netflix or Amazon,
right.
It's Apple. I think it really shows that they're no longer tangential. They're going to further ramp up their content efforts. I think they could double down there. I think it's worth $10 to $12 incremental to the stock as it plays out. And, I think it just shows less than 3 years within launching Apple TV Plus, they win Best Picture for Coda, which is just a groundbreaking film. And, even though, of course, the Fight Club scene was front and center at Academy Awards, I think actually the headline was Apple winning Best Picture as a streaming player.
I like how you summarized that. Well done, well done. And yeah, I think Coda was very impressive, and I think that's why it was an incredible takeaway for so many reasons. That being said, I wanted to know your targets, what your base case and your bull case are for these names for both Tesla and Apple. We always check in with you on that.
Of course. Yeah, so 200 base for Apple. I think we'll see north of $3 trillion again as a market cap. 225 is bull case. And then you look at Tesla, 1,400 base, 1,800 bull case. Look, I think as we start to see this sort of risk-on trade play out, Apple's going to lead us higher across the board in tech, and that's why we're bullish here. And to me, it's a time to double down on an oversold tech tape.
I think people get obsessed with a name like Tesla because it gets so exciting, right? And when they see it down at 600-700, they say, oh my goodness, and it was 1,000 and it was more than 1,000, and they jump in and they think there's some big buy happening. And it's true because it gets back above 1,000 in a blink of an eye. And now you have the talk of this stock split. I mean, what's the timing? How fast do you expect this stock split would happen?
Yeah, but Nicole, they said the same thing about Tar Heels in late January, that they wouldn't make the tournament, and now they're in the Final Four. So the point is, I think being very near-term focused, I think the stock split just another positive catalyst as this all plays out. Fundamentally, we'll have deliveries next week. We're expecting bullishness there. And then you got the barbecue in Austin, the ramp of Berlin. That's going to be the key as they further flex those muscles on EVs.
Okay, and for your Tar Heels, I know what you're doing on Saturday. You're having this big rematch, right? Because Coach K was crying after the last game, and you want to just do it again and blow them out. Is that what you're hoping for? I mean, the Duke fans are probably not happy with you right now.
Look, but just an amazing run by Duke and Coach K, of course, the legend, the GOAT, to get there. Carolina, just a massive opportunity and what they've done in the tournament. But I think on Saturday night, this ultimately ends with Duke leaving New Orleans and Carolina going to the final. And I ultimately believe we're in the championship.
Oh, I like it. I like the predictions there. It's so great to see you, Dan. Thank you
Great
so much.
to see you.
Were here on the floor
Congrats
of the
on
stock exchange. You could talk. Oh, thank you. Thanks, Dan Ives. I mean, all the traders here would love to talk March Madness with you. You know that, right? They love this. It's good to see you. Thanks, Dan Ives of Wedbush. Thanks. Coming up next, we're ready to talk about the disruptors. We're looking at Fortinet. Barclays upgrading this stock, and George Silas has all the details and a way to trade it.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360. I'm Nicole Petalides, live in New York City. It's time for the disruptors, and George Silas is here. He's back. Welcome back, George. Looking at Fortinet, FTNT. What a nice run it's had recently, and Barclays upgrading this stock to overweight. Tell us a little bit about this one.
Yeah, it's actually been a good runner in the cybersecurity space, Nicole. Over the last year or so, Fortinet's up about 85%, and even the last 6 months compared to some of the peers. Companies like Okta, which actually are, again, cybersecurity names, but that company actually faced a cybersecurity breach, so that actually is a challenge to their business. But over the last 6 months, Fortinet is also up 18%. But it's really a traditional network security company. One of the things about it, it's got a really good balance between products and support services. Product revenue is about 35% of its revenue, and about 65% is services. And the services component of its business is a higher margin area of the cybersecurity space, but they focus on small and medium-sized businesses, government agencies, and today we get an upgrade, a really modest one, if you will, by Barclays. They upped the stock to an overweight from equal weight to 395, and this is their next 4-quarter target from 364. And they actually see a continuation of the solid foundations of fundamentals. And if you look at Fortinet, there's a reason why it's been higher in the last year compared to other higher growth but lower multiple or lower profitability names like CrowdStrike. The free cash flow margin is about 49% for Fortinet. It's got a GAAP profitability about 18%, and that's again compared to CrowdStrike, which actually is not profitable at all on a GAAP basis. So this is really a demonstrative of the market we're in. There is growth in technology names, especially these names like Fortinet, which are still growing 30+% revenue year over year, but it's growing profitable, and it's also growing with a very high free cash flow margin. And that's why Wall Street has rewarded companies like Fortinet relative to some of these non-profitable and highly priced to sales-based companies like CrowdStrike, as well as Okta, which again isn't necessarily profitable on a GAAP basis, but also they face some challenges of recent based upon a cybersecurity breach of their own product.
Yeah, as we look at all these cloud names, right, and the whole group overall, Tell me, when you compare it to the peers and you have an example trade, it's already had this nice run that you and I were speaking of. Tell me the big picture here going forward.
Well, so going forward, you know, there may be a potential for some of the growthier areas of the industry group. Maybe CrowdStrike, maybe Okta will recover a little bit quicker. I don't necessarily think Fortinet is going to, you know, move quite a bit aggressively higher. Again, if you just look at the price target relative to the current price at $340, you know, that's a pretty modest increase of about $65. Which is close to 20% over the next year, which is pretty reasonable considering we're in a nice rebound in the market and the cybersecurity space is growing, especially the cloud area of the cybersecurity base, where Fortinet is actually more of a hybrid. They've got on-premise traditional networking, but also cloud, which is growing. And with that said, if you just look at the stock, it's been relatively range bound, somewhere between 260 and about 390. And in the last 3 to 6 months or so within that range, I don't necessarily think it's going to break out of that within the next 3 to 6 months. It could reach the higher end of that range, which is the target that Barclays has got around 395. But between now and then, let's look at, for instance, April, about 52 days to expiration. We could certainly sell a combo strategy here, which is an iron condor, by looking at selling a 390-400 call spread, and then below the current price selling at 290, 280. So we're basically getting very wide ranges here. Break evens on this would be 390, 280 on the upside, 287.20 on the downside. So if you think it's going to stay within those two break even ranges, you could sell this, or a trader could sell this particular strategy or combo for about $280 a contract. Now, that's your reward. Your risk is, of course, the other side of that, which is about $7.20, but your return on risk on this trade is close to 40% at 39%. And that's what you want to do when putting on a combo trade like this. You want to see your return on risk greater than 30%, as well as having some probabilities of expiring within those two boundary ranges of 390 and 290 between now and expiration.
Right. Got much. George Sillis, great to see you looking there at Fortinet for us today, which had an upgrade and now an example trade as well. Thank you, George Sillis. Good to see you. You notice we're live at the New York Stock Exchange. Doesn't it look cool? It's so great to be here.
Looks fantastic.
I have to tell you. It's fantastic, and we have now our finger on the pulse. We've put our footprint here, George. We're ready to really make our mark. Thank you. Coming up next, we are going to preview Chewy's earnings in our 360 round. The online pet care company. We're going to take a look at this, and as people get back to the stores, what does it mean? Our panel is next.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait for
Wow,
it.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Commodities are lower after a top Russian negotiator, Vladimir Medinsky, said ongoing talks with Ukraine have been constructive. Crude oil down around 3%. The WTI sold off on the news, back below 100 to $98.44. The Brent down to 102. Medinsky said he would look at the Ukrainian proposals, report on them to Putin, and that a Putin-Zelensky meeting is a possibility. Grains also lower. Corn briefly limit down. Beans are lower by about
on this one. What is it that you're waiting to hear? Slower growth, some headwinds, so not a great buy. Why is that?
Yeah, there are two factors that leave us neutral in this name. One is slower growth, especially in net customer additions. And then secondly is their margin outlook. We see margins remaining under pressure as the company grapples with inflation, not just in product costs, but also in shipping cost inflation. That puts them at a cost disadvantage relative to bricks and mortar peers.
And that's something you were talking about, Lee. You were talking about some of the headwinds of costs, right?
Yes, indeed. As Seth said, cost for transportation, but also labor. They've had a bit of a problem filling some higher paying roles, but I guess they have done a little bit better with that. Also, they have their supply chain challenges. And of course, one other thing is, we had this big pet adoption during the pandemic. So people bought a lot of pet supplies, but yeah, they still sell food, but there's a lot of bowls and leashes and everything that people have already bought. You don't buy them all the time. So that might be another headwind there.
Right, and that's something that was in your notes, Seth, actually. The rate of pet adoption actually slowing in the fourth quarter was something that you noted, Seth, within your notes.
Right.
And also just some of the headwinds that they've been facing. I mean, is there a lot of competitors? You talked about inflationary pressures, but also some competition too, right? From the likes of Target and Walmart?
Yeah, for sure. Oh, I'm sorry. Go ahead.
No, Seth, go ahead.
As it relates
Seth,
to the
tell me
competitive environment, we are seeing a little bit more competition from the likes of Target and Walmart. They've been slower to pass through some of the product cost inflation, which has limited the ability for Chewy to maintain its gross margin rates. And we think that Petco really has hit the nail on the head with its business model, which is really end-to-end holistic pet care, which cannot be provided fully online in Chewy's model. So they're taking material market share as well. As it relates to the outlook from a margin standpoint and a pet adoption standpoint, first on the margins, we're expecting declines in the first quarter and 2022. And as it relates to new pets, we're expecting normalization of pet adoptions. That started to occur through 2021, and I think we'll be back to a normal rate in 2022, which will slow the top line growth for the entire industry from extreme levels back to more normal levels, with the caveat that we still get an annuity stream from the installed base of pets that we're acquired during the pandemic and still will continue to eat and eat more as they grow.
Right. So, Lee, what do you think of the chart?
Right. The chart is saying wait, I think. Just a couple of key levels you might want to look at here. We have some support there at 3580. You can see that's the short-term triple bottom support level. And I think traders would want to see that high taken out of the 38, that's 55 up there. That's the high of the triple bottom. We also see we have a trend line, though, that we broke, but we've got now the 50-day moving average just right below it, but the 100-day right above it. So it's you've got some work you've got to definitely do here. The only thing I would say is that this is a very kind of arcane point, but that last bottom you see in the triple bottom there, that particular low was actually inside the lower Bollinger Band, and the previous low was outside. Sometimes that solidifies that area as a very strong support area. So also keep your eye on that. But it's very
Oh, that's a good point. I like that. Seth, what would it take for you to change from a neutral to a buy?
Yeah, so, and this is a really tricky print for one, because there is very high short interest and relatively low expectations. There are good industry fundamentals as reported by Wolf, that is Petco. That being said, we think the company Chewy is at a bit of a disadvantage in the near-term environment because of the customer adds as well as the gross margin outlook. So if we see better customer additions than forecast and better gross margin guidance than forecast, we very well could change our view.
Right, I understand. Okay, and I mean, obviously the labor costs hopefully will be coming down some. Lee, you noted some of the headwinds, but customer loyalty is important. Final quick thought, Lee.
Right. So I think some people like the company because it is one of the few pure e-commerce plays. So it does have that going for it. But as Seth said, even if the dogs are eating more, there's a lot of people that sell dog food.
It's great to see you both. Thank you. A great setup for today for Chewy after the bell, which of course we'll have here for you folks. Thank you both. Seth Basham of Wedbush and Lee Bohl of Charles Schwab. Thank you for being with us. And that is going to do it for Trading 360 live on the floor of the New York Stock Exchange. Thanks for being with us. I'm Nicole Petalides. I will see you at 2 p.m. Eastern Time for the Watch List. Fast Market is next.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock, takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in. To discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Good afternoon, traders, and welcome to Fast Market. I'm Tom White, and we've got a great show lineup for you today, including discussions and example trades in Micron ahead of their earnings after the close, and Five Below, which reports quarterly results tomorrow morning. And like Folio, we'll break down consumer sentiment data on Lululemon, which reports earnings after the close today. Now, 2.5 hours into the trading day, stocks are higher as traders monitored ceasefire negotiations between Russia and Ukraine. Growing hope for a ceasefire appeared to help investor sentiment in early trading. The Russian deputy defense minister said Tuesday that the country will drastically reduce military activity near the Ukrainian capital of Kyiv. Now let's take a look at the four major indices, which are all in the green once again, extending this week's gains. S&P 500 up 0.75%. Dow Jones Industrial Average also up nearly 0.75%. NASDAQ 100 up just over 1%, and the Russell 2000 leading to the upside, up over 2% on the session. But to help me break down this market action, let's bring in my co-host for the day, and that's going to be Nick Theodorakis, a Managing Director of Financial Risk Management at TD Ameritrade. So, Nick, we've had some positive sentiment for markets over the last 2 weeks here, and then it comes out that the negotiations in Turkey went well, right? There's no ceasefire. There's still military action going on in Ukraine, but this is enough for equity markets to kind of take this as a positive as they're making some headway. What's your take here on the market action?
Yeah, and I think interestingly, just checking oil here, down 3%, still above 100, extremely elevated kind of to historic norms, but you're seeing some of that come out of the commodities as well as the equities catch a bit of a bid. So, overall, Tom, I think it's a sense of, just a little bit of calm, right? I think, 2 weeks ago we were talking, what does it look like from an escalation standpoint? What are the other types of military actions that are going to be taken? What are the types of, weapons that can be used, those types of things? It doesn't mean that's totally off the table. So I don't want sort of to get lulled to sleep here thinking this is over. But in a de-escalating environment, markets are certainly taking this as a positive. And I think, with the idea that COVID's sort of slowing, yes, there's a new variant, but, some of those unknowns, again, are becoming knowns. And you feel like things are kind of being understood better by markets. And therefore, you're seeing less volatile intraday swings right now. You're seeing the VIX come in. And you're seeing the overall markets kind of get back to what feels like a bit more of a stable environment. And there's been a lot of news out over the last couple of days about the record level of stock buybacks that the companies are doing at these levels. And all the CFOs out there, right, are thinking that this is a buying opportunity for their own stock. And then you have individuals thinking and hearing and reading that this is, potentially a buying opportunity across the market. And you're seeing that money flood back in pretty quickly. So right now, those factors are all making things fairly stable. I know we're going to talk a lot about inflation too, but obviously the flip side of that is the inflationary pressures that we're seeing and how that affects the equity valuations. But for right now, markets are liking the sentiment out there in the geopolitical space, and that's overriding the rest of it, I think.
Yeah, definitely. Any good news on that front would be a bonus. And it seems like the markets have been predicting that, even though there hadn't been any, concerted efforts on either side to kind of give in to what each other wants. We'll have to wait and see in that. But Also, what didn't spook the market today, Nick, was economic data. We had consumer confidence, home price index, and the JOLTS report, which once again reiterates there's a lot of job openings out there. Let's bring in Caroline Woods, a contributor on the network, to help us break down this information, because there was a lot out there, Caroline, but it didn't seem to spook the markets, even though, some of it was mixed.
Yeah, I mean, I think it's just kind of telling us a little bit more of what we already know. But let's start with consumer confidence, because there's obviously a lot of concern about that waning and what it could lead, and if it could lead to demand issues. But consumer confidence actually ticked higher in March to a reading of 107.2, still slightly lower than estimates, but it was actually the first increase in confidence that we've seen in 3 months. Now, there is a caveat to that, and that's only because February's reading was revised lower to a reading of 105.7 from an original reading of 110.5. So yes, a tick higher, but not necessarily, only because of that revision lower to February. The present situation index rose substantially, though, suggesting economic growth continued in late Q1. Expectations, on the other hand, weakened, with consumers citing higher prices, especially at gas pumps, and the war in Ukraine as factors. Of course, the Conference Board's confidence index, though, is much more optimistic than the University of Michigan sentiment index that we saw just recently. That fell to 11-year lows. But this confidence reading has more to do with strength in the labor market, how consumers think about the labor market, whereas the sentiment index is how they think about their financial well-being. Now, in terms of job openings, you mentioned that there's quite a few job openings. The JOLTS came out. That's the Job Openings and Labor Turnover Survey. Job openings actually edged a little bit lower from a record high, though vacancies still far outpace new hires. So employers are still struggling to bring back more sidelined workers. In terms of openings, we saw 11.266 million openings versus 11.283 in the previous month. So just really slightly edging lower. Still higher than estimates of 11 million. Some of the largest increases in job openings were in the arts and entertainment industries, up by 32,000. Federal government jobs and education services were both up by 20,000. Now, in terms of turnover, quits were little changed at 4.4 million in February, so not leaving the labor force altogether necessarily, but just leaving for better or new jobs. But this is the 9th month in a row where the number of people quitting topped 4 million. So it suggests that employees still have the upper hand over their employers. We'll, of course, get ADP tomorrow, weekly claims on Thursday, and then the big jobs report on Friday. And then the only other thing is home prices. They continue to heat up in 2022. This report is from January, so it's definitely lagging. But according to the S&P CoreLogic Case-Shiller Index, national home prices rose by 19.2% year over year in January, up from 18.9% in December. The 20-city composite posted a 19.1% annual gain, also up from a month earlier, and surpassed analyst expectations. Areas with the biggest annual gains: Phoenix, Tampa, Florida, and Miami. Smallest annual gains: Washington, D.C., Minneapolis, and hey, good news for you, Tom, Chicago, although they were still up double digits from a year ago. And of course, shortage of inventories will likely to continue to keep prices high, although we could see demand continue to cool with higher mortgage rates. Pending home sales fell for the 4th straight month. So, we'll see what impact that has on prices.
Yeah, I think the rest of the country's got it right. Nick and I need to move out of Chicago and into one of those warmer climates. Everybody's moving down south, and I don't blame them. I live here in Chicago, and it's not fun sometimes. But, Caroline, one of the things I kind of wanted to hit on was the fact that, is there some divergence here between the expectations index in a lot of these consumer sentiment and consumer confidence numbers, where the expectations are lower than the current situation? It seems like everybody's okay right now, but looking ahead, are markets ignoring the fact that, hey, consumers are starting to feel like the latter stages of 2022 are going to get worse than they are right now?
Well, I did see for the consumer confidence index that consumers expect that inflation will reach 7.9% looking out. So I think it really has to do with the fact that they'll be facing higher prices for even longer. So yes, present conditions are currently better than future expectations. especially looking 6 months out and further. So, I mean, it is something to consider. I think, though, that this particular index really seems to focus on the strength in the labor market, or consumers' expectations of the labor market, which we know has been very strong, whereas those sentiment indexes are for how consumers feel about how they're doing, their financial well-being. So some may say that the consumer confidence survey is a better indication of where the economy's headed. So in that sense, it could be good that we're seeing it tick higher. But yeah, I mean, I think that we're dealing with inflation at 40-year highs, and it's going to continue to weigh on consumer confidence.
Definitely. But that strong jobs market offsetting probably a lot of concerns out there for the consumer. All right, great stuff as always. That's Caroline Woods, a contributor on the network, breaking down all the economic data that we had today. But now let's bring in our next guest, and that's going to be Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Nathan, welcome to the show. I guess I wanted to get, Nick mentioned the VIX falling to lows we haven't seen since January 13th, when the slide started for equity markets. With the positive, sentiment coming out of the ceasefire talks between Ukraine and Russia, it almost feels like investors have a false sense of security at this point, Nathan, even with all the headline risks out there. Your thoughts?
Yeah, good morning, Tom. Morning, Nick. I kind of feel that way as well. If you go back to March 8th, when the S&P was basically retesting that February 24th low at 4170 and it held, we were probably too, collectively, pessimistic at that point. And the sentiment had just really stretched. And then if you come into today, you could probably argue, to your point, with the VIX down at 18, that maybe we're a little bit complacent and maybe a little bit too exuberant at these levels. So, this is the kind of area where you want to come in and talk about protection, callers, put spreads, those types of things with the VIX at 18. But with the sentiment being so bullish, nobody really wants to hear any of those kind of arguments. I'll say this technically, I think this is really critical as well, is if you look at the S&P 500, we've got some key levels. 4,600 is where it topped out roughly 2 times back in February. The NASDAQ 100, the NDX, it's running up into its 200 SMA. It's been flirting either side of that today. On the bullish side, I will say the Russell is moving above the 2,100 level for the first time in a couple months. So that's certainly something to monitor. So, guys, this is just a market. You have to respect the price action when stocks are in this type of rally mode. But then let's not forget the backdrop that, it's great to see the headlines that's coming out of Russia and Ukraine. But if the war was over right now, it still comes back to inflation and the Fed. And inflation's been an issue for quite some time here. So let's not forget about that. Let's not go to sleep. We'll respect the price action. And then I'd say keep an eye on those technical levels.
Yeah, we had those big pops, in not only Bitcoin, we're having the fall in oil, which is helping equity markets today, a little bit of a reprieve from those rising energy prices. But then I also, Nick, look at some outliers, and I know you being on the side at TD Ameritrade, we're dealing with financial risk. The rally that we've seen in some of these stocks again, the meme stocks, AMC and GameStop. GameStop's fallen about $10 today, but AMC's still higher. These are warning signals that I see in the markets when everybody gets comfortable, and then you see people piling back into these meme stock names that fundamentally maybe just don't have the makeup to support their equity prices, but you're still seeing a lot of speculation on those sides. Your thoughts?
You look at this almost like the barbell kind of mentality, right? There's these really solid fundamental companies that have sort of supported markets throughout this, right? And now we're hearing more about stock buyback. We're hearing more about, solid fundamental performance from these really big names. And then you have sort of this extremely speculative, other group of names that tend to be extremely volatile. But when there's a lot of cash, when there's an abundance of cash out there, traders, investors are taking a shot on these things. And I think that's how you have to look at it, right? There's sort of this solid fundamental piece, and then there's sort of the shot that you're taking. And separating those two things in your mind is very, very important, right? If you're watching the show, if you're trading, you can trade lots of different stuff, right? Try to separate out sort of the the balance sheet items in the fun to watch type trades, right? Make sure you're allocating correctly based on your own personal risk tolerance. But these names are rallying, based on basically speculation and headline, right? Like we've heard, AMC is going to start, looking at, taking over other companies, looking at, finding places if they feel are mismanaged, they're going to take them to kind of turn them around the same way that, turn them around the same way they've turned themselves around. Like these are kind of wild headlines that are driving markets. It's not based on fundamentals. So there's a little bit of a wave happening right now. But don't be surprised, if there's a pullback, if they announce earnings, if they announce other things, because there's not typically in these names that we've seen historically the fundamentals to support the valuations that are there. So, for every upshot like this based on a headline, there can be an equal downshot based on actual fundamental news or, some other headline coming out kind of, maybe debunking it's a way to put it. But just, again, comes down to portfolio, comes down to portfolio allocation. It's not a horrible thing to look at these names, but you got to really understand, where your risk tolerance is and what you're actually trying to gain by placing a trade like that, and understanding kind of where that could go. History matters, right? Do a lot of kind of historical analysis on the risk side, but you also have to think about it from a go forward perspective. How high can these names go if, and then start layering in all the things we've talked about, right? Inflation and this and that. If the money kind of gets sucked up, if the liquidity goes down a bit in the marketplace, where is it going to come out of? The really solid fundamental names or names that are more speculative like this? I think that's the question you have to kind of wrestle with.
Yeah, sometimes the markets ignore those fundamentals. But Nathan, one area of the market, and I think this is what's supporting equities at this point, and you mentioned a bunch of the technicals on the major indices here, these key levels that we're reaching, is the earnings growth expectation. So I always think in this realm where it's at the tail end of earnings season, we basically just have a few big names left. We ramp up in about 2.5 weeks here with the financials that report. I think this is going to be the key moving into the second quarter of this year, is that earnings expectations and the growth expectations a lot of people have on the markets may, be that catalyst for some downside or some added volatility, not necessarily downside, but that could be a catalyst for moves moving forward because we're going to get more clarity on these inflationary pressures, right?
Oh, absolutely. I mean, like Larry Kudlow says, earnings are the mother's milk of the market, right? So it's definitely, this is going to be such a critical quarter that's coming up here in terms of hearing from the companies. And, we're not going to necessarily, I don't think, get the full extent of how the consumer is faring, but a lot of the companies will give us some color in terms of how, the war and inflation have been affecting basically either their margins, their corporate margins, or the health of the consumer. So, the bullish thesis here, Tom, is hey, look at the employment numbers, look at corporate earnings, look at a lot of the economic data, expansionary territory. A lot of that has come from the Fed and from fiscal stimulus, and the Fed is raising rates, but it's because the economy is strong. It's because the consumer has excess cash. It's because they believe the consumer is going to hang in there. So that's really the thesis for the bulls, is that rates are going up for the right reason. But yeah, this earnings quarter is going to be so critical in terms of getting that clarity from those companies that are closest to the ground in terms of how the consumer is actually behaving, and guidance being obviously key within that component as well. And then you look at the price to earnings ratio on the market. I'm still kind of surprised we're a little bit this high with the yields creeping up as they have been. So we got to keep an eye. 2.5% looks like where we had some buyers come in on the 10-year. But if that continues to go up, that tends to be kind of detrimental for that valuation aspect around 19 or so on the S&P right now, which is historically high.
Yeah, and you mentioned that S&P 500 just above those failures in February at those highs right here. So is this a breakout, or do we get some follow through maybe to the downside? All today, but Goldman Sachs came out with some notes on the consumer staple sector, Nick, and they're giving price target cuts on Procter & Gamble, Clorox, Colgate-Palmolive, Reynolds, some of these consumer staples and their products, right? Their brands. And they're saying that this inflation caused by Russia, Ukraine now, and the already existing inflationary pressures that we've had out there as far as pricing goes, it's going to prolong it, right? And that's going to be a detriment for their margins moving forward. Your take here, because this is typically that safety area that a lot of investors look at when they want to have paid dividends. These are financially, for the most part, pretty secure firms as far as the amount of cash in their balance sheet that they're a safety play considered sometimes. But when you get a firm coming out and downgrading or cutting price targets on a lot of these stocks, does that raise red flags for you that, hey, inflation's here to stay until the end of the year?
Well, I think Nate just hit it, right? Like it's a valuation concern, and it's really about understanding the fact that these companies have the balance sheets, right? They have the fundamentals to make it through the cycle. That's not really the question. It's about how much do you want to pile in at these levels, given the backdrop of everything we're talking about. There's a war going on, right? But the inflationary concerns, now you're seeing the potential inversion of the yield curve. We haven't, we made it 19 minutes without talking about that. That might be the biggest indicator of fear down the road, right? Like the recessionary concerns that are built in right now. I was reading something this morning, I think from Bloomberg, that was saying, the U.S. is the most likely nation to experience stagflation based on economic data. So there's a lot of concern out there for that type of environment. It doesn't mean you're going to stop buying Palmolive dish soap or Dove shower gel, right? But the companies are going to really potentially have earnings contraction if the cost of labor continues on the uptrend, the cost of all of the components going into all of these consumable products is on the uptrend. It's difficult to see that scenario where that and a rising rate environment doesn't make corporate profits look a bit worse. It doesn't have to be drastically worse. And I think you're seeing that in some of these downgrades. There are still buys or still holds, but the prices are coming down a bit. And I think that's the logical backdrop right now that's out there for a lot of these companies. How could that go the other way? Well, if inflation really does come down sooner, if companies figure out their supply chain issues sooner, if this war really does wind down sooner, I think, these valuations are probably still a bit elevated, but seeing that end sooner, I think would give the markets, which tend to be forward looking, a lot more confidence in kind of the current valuations. And you might see that volatility kind of remain low.
Yep, and that 2-10-year yield curve is at the flattest level that we've seen so far over the last year, so we'll continue to watch that one. We had the inversion of the 530 yesterday. I'm looking at the 3-month 10-year, and that's still widening at this point, so no inflation or no recessionary fears there. But now let's get into a discussion about Micron. They report earnings after the close. This is one of those stocks, Nathan. It's down about 14% this year. Off all-time highs that we saw at the end of last year. But this is one of those stocks that a lot of people say, oh, it's in the chip space, but it's cheap compared to NVIDIA and AMD. But this is a different segment, right? This is memory-based chips, DRAM and NAND, and you get more price fluctuations in there as far as demand goes and their margins also. Your take on here on Micron and what it's telling you into these earnings.
Right, yeah, you're exactly right on the 7 PE. It really sticks out. You look at it historically, though, and that's really been the case for a stock like Micron. They really follow those price charts on DRAM and NAND, as you mentioned there. Technically, you look at the stock, it's basically just kind of in this sideways channel between 70-ish and 98-ish, kind of in the middle of that range. We are above the 200-day SMA. They had a really good report last time, and they received a couple upgrades this year so far. The semis have come back. We've seen some pretty extravagant bounces off the lows. If you look at something like an NVIDIA, for example, and how much it's recovered off that March 8th lower. So Micron, not as much. And, it really comes down to the pricing of their markets there for DRAM and NAND. And, there's, on the bullish side, they talk about the data center. On the bearish side, they talk about the PC, perhaps some coming in there. To 7 PE, it's kind of hard to overlook within the chip space.
Yeah, definitely. And Nick, when you look at the stock, it's been pretty choppy over the last 3 months or so. Did hit those all-time highs at the beginning of January, about $98.50 a share. Just broke through its 200-day. Still got some resistance at its 50-day moving average coming up. But when you look at this stock going into earnings, and we see some big moves post-earnings. That doesn't mean it's going to happen again. But your thoughts here on Micron?
You know, Tom, it has bounced really nicely. 65 was the low. It's certainly come back up from these levels. Sorry, I got some background noise. We finally got somebody to come and do some work at the house, which is a crazy thing these days. Can't get away from it. So apologize about that. But it is a crazy bounce that we're seeing in the stock off of those lows. And I think to hopefully go into earnings and hear demand is strong and chips are coming back online, particularly that physical hardware, I think is a really important thing. So as always, when we go into these earnings calls, the numbers matter. The stock's going to move on that, but we really need to understand what the forward guidance is for these companies. And I think it's going to be fascinating to hear how they talk about their supply chain and how they're delivering on those. Because if they're not able to deliver, even if demand is there, I think that's where you can see a company like Micron get hit and kind of fall back down to those low levels we've seen. If they're able to tell us that their forward outlook is great, hey, that's awesome. And it's all going to be about deliveries, I think, for their earnings guidance.
Yeah, definitely. And Nathan, we've got an anticipated market maker move that the option market's pricing in about $6.10 plus or minus either way. Stock's trading about 80.70. How do you want to look at this? Because if you look at the implied volatility in here, the near-term month is about 113% on aggregate, and then it falls off pretty broadly over the next few option series. So give me your example trade here in Micron going into earnings.
Yeah, Tom, normally when I hop on this show, and you guys as well, as an option trader, when you see that IV discrepancy, that skew based on the earnings week, you kind of want to position yourself such that you can take advantage of that skew, via calendar call, calendar put, long diagonal call or put, et cetera, based on your outlook, bullish or bearish. Today, just as an example, I just wanted to throw out a strategy out there. So I'm sticking to this week's expiration, and the strategy is a call front spread. It's a ratio spread. You're basically going long one call and you're selling two at a higher strike price. It is a bullish strategy, but you can position it such that you can bring in a credit. And so I was deliberately trying to position this around that implied move of about $6. And I also wanted to position it such that you could put it on for a credit, at least at the time that I was looking at it. So what I was looking at is basically this week's 83, 87 call front spread. You're buying one of the 83s, you're selling two of the 87s. At the time that I was looking, it was about a 19-cent credit. Where does this leave you? Well, basically, if the stock tanks, 19-cent credit. If the stock goes sideways, 19-cent credit. If you get that implied move to the upside, your maximum gains at that 87 strike, you just really don't want this guy to push on above the 91 level. That's where some losses can occur since you're short double the contracts.
Right, so we've got a back ratio here where you're buying one of the April 1st weekly, the 83 strike call, just out of the money to the upside by a couple bucks, and then selling two of the 87 strike calls. Your credit's about a dime, we'll say right here. So you're still profitable on any sell-off in the stock because you did collect a credit for it, but you do have risk to the upside because you're selling two of the 87 strike calls. So it's almost like you buy the 83, 87 call vertical, but you sell an extra call to collect to that credit, because if your assumption is that it's going to go higher, but maybe just that one standard deviation move and kind of settle in there at the apex of profitability on that, where it's almost $500 in profit at that 87 strike at expiration. You break even about 91.10 on this if you collect a credit, but you do have risk all the way to the upside. So if we do get that big move to the upside, that's where the pain will come in on this type of trade. Nathan, your final thoughts on this, because what I look at when I look at a trade like this is, yes, it's a bullish trade, but it's moderately bullish, expecting the option market to kind of be pricing right the move to the upside, especially after the pullback that we've seen from those all-time highs at the beginning of the year.
Sure. Well, first I'll say is that, keep in mind, you've got a requirement on that short call. You're net short a call at the top. So there's a requirement for that. The other thing that I would say is because this stock is in this sideways trading range, you might be inclined to feel a little bit more comfortable with a strategy like this where you're net short a call. What do I mean by that? Well, if you're in a stock that's in an uptrend and it's basically rallying into all-time highs, analysts can't get over their estimates quite enough. They keep on raising and guiding, and sometimes you get some of those outsized moves, meaning moves that are either bigger or lower than the implied move. So if you go into a situation where it's a really hot stock, really hot market, analysts keep on raising their estimates, and you were in danger of getting this above implied move, this probably wouldn't be a strategy that you would employ. But since it's been in this sideways trading range, maybe that makes you feel a little bit more comfortable that you're not going to see this stock basically spike above that 91 upper break-even level.
All right, great analysis on that example trade here in Micron, taking advantage of that anticipated market maker move here and the higher implied volatility by selling that extra call against that. Remember, you do have risk to the upside on that. All right, great stuff as always, Nathan. Thanks a lot.
Thanks, guys.
All right, that's Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. But coming up after the break, Nick and I will be joined by Megan Brantley from Likefolio for a discussion on Lululemon ahead of their earnings. Fast Market will be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade. I'm Tom White. I'm joined by my co-host Nick Theodorakis, but let's bring in our next guest for our hashtag segment, and that's going to be Megan Brantley, the Vice President of Research at Likefolio. Welcome to the show, Megan.
Thanks for having me, guys.
All right, we're talking Lululemon. Shares are down about 11% so far this year, off nearly 30% from those all-time highs we saw last November. It seems like consumer sentiment data is getting hit. It would see in some softness as the Omicron variant was pretty rampant in January. We saw the overall market get hit, and maybe that's causing Lululemon. What kind of data are you guys seeing into this report? Because it seems like the way that people are dressing has changed over the last couple of years since the pandemic started, but they've also got some new products coming online here too. So what's your data showing us today?
Yeah, so you guys really had to twist my arm to talk about Lululemon today. I was really thrilled whenever I saw that that was the topic. But what's really interesting when we look at a company like Lulu is you're right, they did benefit as really dress codes kind of loosened up over the pandemic. You know, people were buying clothes to work from home instead of clothes to work in. And so now things are kind of shifting. But what's interesting is that somehow Lululemon is now harnessing a whole different set of trends. So when we look at mentions of people who are talking about, you know, going to a group fitness class or joining a gym, those mentions are up by double digits year over year. So, you know, whenever you're re-entering this public workout sphere, you know, you need nice workout clothes now. All of a sudden, you know, you care what you're wearing to the gym versus what you were wearing when you were working out in your basement. So it's interesting to start to see Lulu, you know, harness some of that momentum as well. And I think this chart is really interesting because, you know, we always talk about how are these companies performing versus peers. And, you know, we included, you know, Nike, Gap due to their Athleta brand, and then Under Armour just to give some perspective. And what you can see is that Lulu, at least from a demand perspective, that's that x-axis, it's gaining the most momentum versus its peers. I think that another interesting note that I want to call out is you'll see that, you know, this is something that we've talked about, that Nike has been doing a really good job lately in terms of consumer happiness. And actually we see Nike higher than Lulu. But what's fascinating is that the reason that Lulu has kind of, you know, lost a couple of those happiness points, especially recently, is due to this new product launch that you kind of hinted at, these new tennis shoes that or running shoes that they launched that are sold out and people can't get their hands on them. So we have sold out mentions just spiking and really kind of dragging on that sentiment. So it's a little bit of an interesting scenario for Lulu to be in, but I think that, you know, it's a positive sign, at least for our data. You know, we're seeing Lulu kind of reach this inflection point as consumers are returning to shopping in stores again. They're getting back in the gym and they're really liking these new products that Lululemon is putting out.
It's a great analysis, Megan. I think it's so interesting to see, right, companies that figure out multiple revenue streams, right? They bought Mirror too. We didn't even talk about Mirror, right? They've got at-home fitness. It's okay to wear their pants if you're a guy now into the office. You put on a different pair of their pants to go to the gym. It's pretty amazing. So you know, it seems like people really enjoy the brand. That slippage you're talking about, though, in the happiness score. What are you looking to hear from them, you know, with earnings, you know, right around the corner? Right? What are you looking to hear from them in terms of guidance to kind of stem that? And do you think that if people hear the right thing from them, that ticks back up, or do you think this is truly just supply and demand, and no product means not a pleased customer?
You know, whenever we look at the actual mentions of these tweets, you know, because we're looking at what the consumers are talking about, the most common, you know, cause of negative sentiment, at least recently, tend to be related to those sold out mentions. So people who are talking about they can't get their hands on the product that they wanted, or the color that they wanted, or the specific, you know, type of short or pant that they wanted. And so I think that is kind of this lingering supply chain, maybe product shortage issue that they kind of hinted at. But what we see is that those purchase mentions on this chart, I think, is really cool because you're starting to see that inflection point. We saw some just loss in momentum whenever it came to, you know, consumer demand and how enthused consumers were about shopping with Lulu over the last couple of quarters. And those 2 quarters that I have highlighted really shows a reversal. And now they're reporting on that Q4, so that second to last bar. And you can see definite improvement versus Q3. You know, we would expect this into the holiday season. But then what's really interesting is they're continuing to build on this in the current quarter. And just for reference, we're about 2 months in already on that, you know, that first quarter of 2022. And so this is a really nice pace for Lululemon. I think that is currently measuring out about 19% higher on a year-over-year basis. And this is something, you know, this is just a trend reversal. So for us, this is an interesting inflection point and tells us that if Lulu is able to, you know, meet the consumer demand is certainly there and it's building.
Yeah, and Megan, and we know about the inflationary pressures, the supply chain issues, the raw materials that they're using for their products. Those prices are going up, right? It's already at an elevated price level point for a lot of people. But I kind of wanted to hit on this, the new phenomenon, the shoe, right? I know you're a runner. I've been wearing the same brand and model of running shoe for the last 15 years. I'm not going to change for that. But you guys are seeing positive mentions there. Now, we've seen shoe companies come and go trying to compete against Nike and Adidas, and they just kind of fall by the wayside eventually, and they don't get any traction. Is that what you expect? Is that what you expect here, or is this something that, because people are so brand loyal to Lululemon, they'll keep trying this out?
You know, this is an instance where, you know, I am a runner and I missed my chance to get my hands on these shoes. I'm like devastated. They're already sold out in my colors. They're sold out in my size across the board. I even would have gotten a color that I didn't like just to try these out, because just in the mentions that we're looking at, the reviews are extremely positive. People are talking about, you know, if it's possible, these shoes feel like butter. They feel the same way that the Align leggings make me feel whenever I'm working out and when I'm wearing them. So I think that, you know, you made a good point that a lot of other companies, one that comes to mind is Under Armour, that tried to get into shoes and they didn't really execute, right? They didn't do a good job. We saw mentions of people talking about wearing Under Armour shoes and it hurting their feet. This is not the case with Lululemon. The early mentions of people who were lucky enough to get their hands on these shoes are extremely positive. They talk about them being extremely comfortable. They talk about the material being high quality. And I think it's interesting because if you listen to comments from their, you know, product team, they talk about that they're, you know, these shoes took 4 years to develop, that they did, I think, 1 million foot scans, and that when they were developing this, you know, this is one of the first shoes that was actually developed based on, you know, women and women's feet. A lot of time, shoe companies, they develop based around the man's foot and kind of adjust to fit women's sizing. And this was kind of a reverse because, you know, Lulu knows their audience. And they also know that maybe, you know, maybe if a woman picks up a pair of these shoes, they'll want to buy a pair for, you know, her husband or her boyfriend or, you know, her partner, whoever. And so I think that this is really interesting, but at least from our data perspective, it appears that this could be a little bit of a spark that maybe Lulu needed as they started to kind of lose some of that momentum to kind of, you know, reinvigorate their consumer base and introduce a new product. And so far, you know, the most negative things are just people talking about that they can't get their hands on the shoe, like me.
Yeah, and I think, you know, you might want that Lululemon emblem on the side of your shoe. That because half the people here in Chicago that are wearing Lululemon never working out in that Lululemon outfit ever, but it's all about brand recognition and quality of product. So I like that angle that you used, that they did a lot of research before they actually came out with a product. But now going into earnings here, Megan, are you guys positive on the scores? Because it seems like the trend is kind of reversing the past couple quarters.
Yeah, I think that we're in the, you know, the early moments of this kind of reversal and the spark for Lululemon. Our score is coming in bullish, slightly bullish. It's a 29. I think that for comparison, last week, whenever we talked about Nike, Nike was a 37. And part of that was just because of how much happier they're making their consumers. And, you know, Lulu's consumers are already pretty happy. And so I think that from our perspective, we are definitely leaning bullish into this event, you know, acknowledging that maybe in the quarter that they're reporting on, they're not going to have a lot of this, you know, this new product energy to hit on. But, you know, we do think that they will be able to make some nice nods toward guidance and potential sales moving forward.
Yeah, and you guys were spot on that Nike call too, because that stock has rallied post-earnings and hitting highs post-earnings from where it was prior to that. All right, great stuff. As always, Megan, appreciate it.
Thanks, guys.
All right, that's Megan Brantley, the Vice President of Research at Likefolio. Now, Nick, let's take a look at Lululemon going into these earnings. The stock got beat up pretty good from those highs that we saw last November. It's bounced off of that. It's back above its 50-day moving average, still below its 200-day moving average at this point. But when you look at this, you know, implied volatility really elevated. This is a high-priced stock, Nick. I mean, you know, using the option market might be the way that some traders or investors look at this, just due to the high price of buying 100 shares or 50 shares of this type of stock. Anticipate a market maker move about $23.50 here, plus or minus either way. Break down the example trade that you brought to us based on, Likefolio is pretty positive on this this name going into earnings.
Yeah, look, I think Lulu, just to touch on the earnings piece for 1 second, you know, I mean, Megan said it perfectly right. They know their audience. They start with a ton of research, but there's a lot of revenue streams out there that they can still tap into, right? Like men's shoes. There is no men's shoes. So unlike you, Tom, I'm always trying out new running shoes, and there's a lot of cool new brands out there already, and I think they see a huge opportunity in that space. And there's a lot of other elements they can get into. And then as you blend these types of, you know, clothing with work and workout together, I think there's a lot of interesting kind of collaboration and sort of, you know, cross-stitched, if you will, products out there, no pun intended. But, so I saw Megan's information, a bit ahead of time and kind of went over that. And I agree, they are positive, not as positive to her point as Nike, but it's a little bit of a different audience, and the brand loyalty, I think, is every bit as strong if you know people that know it. It's just a little bit more of a niche brand still. So I kind of took that into account. We are up almost 20% off of the lows, right? So yes, we're well off the highs, but we've bounced 18, 19% from those lows as well. So a little bit middle of the range. I think it's all, as I say this every time we talk earnings stocks, I think it just comes out of the guidance. The numbers already happened. How are they guiding? How are they going to meet the demand? Are they developing a men's shoe? Where is that going to fall in? Like, what is the outlook for this company in terms of the next couple of quarters? So I set up a call diagonal, selling that front week volatility with earnings, being captured there. It is a very high vol, to your point. So 103 vol, predicting about a $26, $27 move. And then I went out to the April monthlies, and I was buying the 365 call. So there's a diagonal component to this spread. Buying the 355 calls. And what that's doing is giving you a $10 wide vertical that you're purchasing, but you're still taking advantage of that higher front week volatility. So you're getting more of an offset with just a very short-term trade, but you still get that $10 wide vertical component if the stock does rally to the upside. The other nice thing about that is you've paid some, right, with a real high vol, you've paid a bit more of the cost of buying that longer dated option, and you still have the ability to roll 3 times. Plus, then you can turn it into just a vertical in that regular way April expiration. So you've got a little bit of ability to adjust this, and you've got room to run to the upside because you're purchasing that vertical component, which is a bit different than how we normally look at it. But the bullish example helps use that front week volatility to pay for a longer term call, and it gives you that verticalization that you can then maneuver from there.
Yeah, I like looking at strategies like this, Nick, where it's a call diagonal, and we talk about that sometimes on the show, but this is a little bit different because you're buying that slightly out of the money April 14th weekly or monthly series, which has 16 days till expiration, and then selling the near-term April 1st weekly 365 call that is about $20 out of the money to the upside. You're paying roughly about a $5.75 debit. That's going to be your risk. Your break even about 334, just above 334 on this particular trade, and with the apex of profitability being at that 365 strike, which is right around that one standard deviation anticipated market maker move that the option market's pricing in at this point. And besides that, Nick, because it's got that vertical component in it, you've got no risk to the upside on this one. All the way up past 450. I mean, this is set up as a bullish example trade. Your risk, as I mentioned, is what you're paying for that $575 per spread on this one. Now, you've got assignment risk if it does go up through 365 by expiration. Those expire in 3 days on the April 1st weeklies. But nice look at a different type of strategy here that takes a bullish stance. Now, if you're bearish, you can do this to the downside where you do a put diagonal to the downside. But this is just one way to look at it based on Likefolio's data, which is pretty positive going into this report, plus 29 on their score. All right, great example trade here, Nick, to look at Lululemon based on Likefolio's data. But coming up after the break, we're going to take a look at Five Below, which reports earnings tomorrow morning. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. After some constructive comments from Russian and Ukraine negotiators, the euro's back above 111 and holding up around 1%. It's come under pressure in recent weeks with a hawkish FOMC compared to the more accommodative European Central Bank, and in response to its proximity to the war. The run-up in the euro sent the greenback to 98.05. Both the dollar and yields. Rates here in the U.S. have backed off recent highs. The TNX to 2.4 from 2.5% as we await inflation data due out later this week. The personal income and spending numbers Thursday. The jobs report Friday, where investors and traders will have a close eye on the wages component. Yesterday, Bitcoin spiked to 48,000, but limited today in terms of follow-through, which is odd when you think about it with risk-on environment we're seeing in the indices. The NASDAQ and the Russell both up over 1%, but maybe not when you consider how the move up we've seen in crypto has been more tied to Russia's war on Ukraine. Last week, Russia said they'd be willing to accept Bitcoin as payment for oil, and with peace talks progressing this morning, the same negotiator that called the talks constructive said he would look at Ukrainian proposals, report on them to Putin, and then a Putin-Zelensky meeting is a possibility. Bitcoin's down around 1% as futures are trading just above 47,500. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market with Tom White.
Welcome back to Fast Market on the TD Ameritrade Network. I'm your host, Tom White, along with my co-host for the day, and that's Nick Theodorakis, Financial Risk Management Managing Director here, or at TD Ameritrade. Nick, let's get into a discussion about Five Below. They report earnings tomorrow morning, and I should have gotten Megan's take on Five Below because we've hit that stock with Likefolio prior to that, and they're always pretty positive on Five Below going into earnings. Just due to their mix. They've got about 2,500 stores out there. The cost to open a new store is relatively low compared to competitors in the space, whether it's Dollar Tree, Dollar General, even getting up to Target, because that demographic that Five Below has as far as what people make a year that go to those stores is far above the discount retailers like Dollar Tree. Your thoughts, I hear what the market's telling you on Five Below, because it's pulled back pretty significantly from all-time highs in the middle of last year.
It has, and if you look at the earnings page within the Analyze tab in the platform, the ball is interesting on this one. So, it's kind of middle of the range, right? So they are significantly off their highs. I would expect just complete sight unseen, right? Just hearing what we've heard and talking like we have for the last 45 minutes here, I would think there's a huge impact to their stores in terms of staffing, in terms of the cost of the products that they're putting out there. And when you do have a very budget-minded consumer coming into your store, I think you have to be very careful how you pass those costs along. So I think that's going to be, to me, the fascinating part about earnings, in particular the earnings call. How are they keeping up with the demand? How are they keeping stores stocked? How are they keeping stores staffed? And all of those things, right? They're a frontline retailer. all of those things are extremely sensitive to how their earnings are going to look. So I was interested to see that the vol isn't really as high as it has been on some quarters. It's certainly elevated, but not kind of to the moon like some of the vols that we've seen. They're looking for just over $1 billion in revenue on about $2.50 per share EPS. So I think the numbers I think can be skewed by a few things, right? What does the supply look like? Is it going to be a Lulu conversation like we just had where there's demand and they don't have the products they want in the stores? Or is it going to be, hey, we were able to get this stuff stocked just right and we sort of hit it out of the park? And those are kind of the bookends I think that we could see, Tom.
Yeah, and going into the retailers and what they're looking at, you always have to bring into the equation of inflationary pressure. So let's get to this example trade. And this is probably based on an example as far as what like Folio would give us. And it's the same kind of setup that you looked at before, Nick, in the previous stock in Lululemon where you're doing a call diagonal. I did the same type of setup here where I went out to that April 14th of the monthly series, buying the 170 strike call, and then selling the 182.5 strike call and the near-term options that are elevated as far as implied volatility goes, the 182.5 strike call and the April 1st weeklies. If I'm paying roughly about a $6.25 debit for that, that's going to be your risk, $625 per spread. That break-even point, just about 166.5 on this one, with the apex of profitability being basically about $12 above the current share price. From that at or near that 182.5 strike. You do have that option to roll, as Nick mentioned, on the Lululemon, but that'll actually increase transaction costs, no commissions, but transaction costs on that, just minimal, would increase if you adjust it. But the idea here is that the stock grinds higher after those earnings results on this. The anticipated market maker move is about nearly 8% plus or minus either way, so that 182.5 strike sets up nicely based on the option pricing that we're seeing currently. But the idea here is that if the stock goes higher, now, if you think that the stock's going to go lower after earnings, then you could definitely do a put diagonal to the downside using the same option series on that. But that's a breakdown of another diagonal, slightly bullish on Five Below going into earnings. All right, that's going to do it for Nick and I today on Fast Market, but stick around on the TD Ameritrade Network as Next Gen Investing is coming up with Alex Coffey and Jenny Horn. Have a great day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act.
Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Hello and welcome to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, a lot going on here today. S&Ps, after trading significantly higher, fading just a little bit. NASDAQ has in many ways led this rally alongside some of the meme stocks and some of those the really high end of the risk curve, which has kind of imploded a little bit today. So we'll talk about that more as the show goes on, but we got a jam-packed show once again.
We do a lot of earnings movers today, actually, after the closing bells. So a lot of pre-earnings to look at, which always excites me as we oftentimes discuss earnings season. But to get to it, we will go through our upvote and downvote segment. Following that, we will chart and trade our upvotes. Our FOMO discussion today is about Lovesac following their fourth quarter earnings, seeing a nice pop on the day. Then we will preview Chewy ahead of their numbers this afternoon, and we will look at Costcorp, ticker symbol KOSS, why they're seeing some activity today, some meme stock enthusiasm perhaps, but we'll dive into that coming up next.
Yeah, looking forward to that conversation, Jenny. Throughout the show, a lot of fun things to unpack here, but Lovesac, I didn't even know Lovesac was public, so I'm excited for that conversation as well. But as always, we'll kick things off with upvote and downvote. A good list of movers, we're going to narrow it down.
Yeah, so to start things off, we will talk RH, who has earnings. Other notable names reporting that I want to include are Micron and Lululemon, who we did preview yesterday. But RH is one to focus on today. They remain very tied to this housing market and equity market. So they have seen a good degree of selling this year, down about 29% year to date. But surging today, they were actually up higher earlier in today's session, fading along with the broader market, like Alex mentioned, but still up almost 3% ahead of this report. Now, historically, this is a name that has struggled during heightened times of market volatility. They are a high-end, or high-priced, really high-end furniture maker, so it does make sense that they have that exposure to that consumer spend, which we know has been pressured with inflation. But we do know that trends on discretionary spend have really evolved away from maybe the home and gone back to more normalization, say like traveling or apparel. But the expectations for this company are normalizing. I was actually listening to an analyst discuss expectations for this name today and saying that they're still targeting 10% revenue growth on an annual basis, which is still, I would say, a strong number for this company. It's just not parabolic like it once was during the pandemic, Alex, when everyone was so keen on either moving and then refurnishing their homes or just fixing up their current homes. Now, what they also, I think, have done really well over the last few years is this was a company that I think operated in more brick and mortar sense of the word, but they have pushed outside of that, expanding their e-commerce. They saw e-commerce boom, but they do still offer, I would say it's like an in-store experience. If you've ever been to an RH location, you know that it's a whole experience. There's a restaurant. Everyone's very well dressed. It's a very fancy brunch, to say the very least. But this is a name that I would say operates now in an omni-channel way, which is expected to give it some strength, as it does still have that brand presence, which I think makes it so important in the furniture space.
Yeah, so I've never actually experienced the restoration hardware RH experience, but I've heard nothing but good things. I might be not the clientele they're focused on, might be above my price level here, but it's got a couple things working for it and a couple things working against it. So you talked about how maybe trends have moved away and demand was pulled forward for some of the home improvement stuff, such as furniture and stuff during the pandemic. However, if to say we're facing some type of an economic slowdown in the future, nothing that we know for sure, but there are more and more murmurs about that amongst financial circles. Typically, kind of counterintuitively, the high-end luxury side of things usually is less impacted because, unfortunately, those of us on the lower end of things tend to be impacted more than those who are kind of the higher on the luxury side of stuff. So, at least initially, you may not actually see a huge impact in terms of sales and stuff of that nature if there is a slowdown for something like RH. But if trends are moving away from those type of products, that can actually weigh on it. But I'm looking forward to this announcement nonetheless. We're going to say upvote today. Another straggler in earnings season here, Jenny, but kind of an expensive name, a lot of volatility, always fun to talk about.
Yeah, and I mean, high end is actually even, I would say, undermining it because some of their couches retail for like $15,000. So I'd say there's high end and then there's RH. The Cloud Couch is one that has like a very loyal following. So definitely is one that may be isolated for that very reason, but we'll get more on those numbers this afternoon. But next is Nielsen. Now, Nielsen after today's surge, is actually the best performer. So far, we do still have 2 more trading sessions in the S&P 500 in the month of March, beating out the next best performer being Tesla. Now, the company announced it will be acquired by a private equity consortium led by Evergreen Coast Capital and Brookfield Business Partners for $28 a share, implying roughly a 60% upside to really March 11th, which was back before we had any rumors of a potential takeover. So this was not a huge surprise from what I've gathered. Alex, this has been sort of murmured about for the last several weeks, but today these companies decided to finally take a bid. Now, they've committed to debt and equity financing, including about $5.7 billion in an equity commitment from both Evergreen and Brookfield. This all-cash transaction is valued around $16 billion and expected to close in the second half of this year. Now, Nielsen is kind of an old-school company to me, Alex. They operate in this media and content ecosystem and provide ratings. And it's very interesting to me because as things with the media have naturally evolved so rapidly, really in the last 5 years, this company seems a little bit outdated. However, obviously, this private equity firm does still see some value here because they did offer 60% premium to their closing price March 11th.
So up almost 21% today. You talked about the company itself, its performance amongst its peers, but really the overall market. Many of those reasons would make it one of, if not the story of the day. But we're not just upvoting or downvoting based off of the interest in the particular story, but rather for a greater conversation. And then ultimately, in these greater conversations, we're looking at trade illustrations. When you're looking at something like Nielsen, you in many ways, you're taking this one off the board from a trading standpoint. If you were already involved, of course, great prospects here today. Of course, you see a big move higher, but $28 a share is kind of the expected closing price. Stock's trading at $26.86, so you got about $1.14 and what would be referred to as deal premium. Well, why is there that difference? We have a price tag. It seems roughly confirmed, seems as if it's going to go through. Well, one, there's always that risk that it wouldn't. And two, you talked about it closing on the second half of the year. So there's that time value of money factored in. Oftentimes, this deal premium game is more of one for institutional investors, not one for retail investors. So I'm not going to say it's off the board, as you certainly could potentially go in there and try to play that game. But typically, liquidity does dry up. The options world particularly dries up. As this is seen as more and more certain, closer to that deal, you'll see that squeeze closer to $28. So downvote today.
I completely agree because I feel like from a news perspective and maybe just from our perspective, the story is pretty much done. It's over. We had rumors of this and it finally happened. So a downvote as well for me, Alex. But now our next name today is Pinterest. obviously has fallen sizably this year alongside several of its social media peers. Sizably, I mean down 27% year to date. But Morgan Stanley downgraded Pinterest to equal weight from overweight with a reduced price target to $30 a share from $53, so pretty sizable target reduction there, but still does imply a 13% premium to Monday's closing price. Now, they said Pinterest user and time spent trends are challenging while the company shifts to existing time spent towards lower monetization creator videos, which to me means influencers essentially. But the analyst did acknowledge that some of these larger platforms with more engineers, more ad sales, and existing ad networks like a Meta or an Alphabet have the ability to monetize this format over smaller names like Pinterest, just with this scale that of course a Meta or an Alphabet operate at. So during their fourth quarter earnings, we did see a sales beat and as well as a profit beat, but the company's CFO did admit that their fourth quarter monthly active users declined due to Google's November algorithm updates as well as competition. So sort of tied into what this analyst was saying today, we are seeing shares just slightly lower, but some downbeat, I would say, guidance for this company from this analyst.
Yeah, and it's probably an overdue adjustment for the analysts. I respect that they waited for the rally to kind of sell into that a little bit, but they had it at overweight and at 53 prior. It's been a long time since we were near that price, so cuts down to 30, goes to equal weight, kind of equivalent to what many analysts would call hold. So pretty neutral rating for Pinterest here. I'm going to say downvote though because it just seems late.
It does seem late. It seems like you fell asleep at the wheel a little bit because this name has been in a pretty sizable downtrend since the start of this year, along with so many other social media names. So a downvote today. Now our last name today is Lyft, with some news that actually Lyft as well as DTE Energy are launching an incentive program for drivers who purchase or lease an EV to use on Lyft's ride-hailing network. Now the program will offer Lyft drivers a rebate of up to $2,000 when they apply, with the remainder to be given out in 4 installments ranging from $750 to $5,000 when they complete 200 rides per quarter. Now DTE is investing heavily in EVs, investing more than $1 billion annually to improve what they said is electric reliability and boost the widespread adoption of EVs. This to me seems like a great story, Alex, as I do think that everyone should be incentivized to use an EV, especially when gas is so expensive, which is just crippling some of the drivers, and we are paying now this gas fee surge as riders. So it does seem like this is a win-win, but I would say it's still in beginning stages of this story, but I do like the sort of ESG movement here.
Yeah, I didn't see a lot of coverage on this story, but are we back to the point now where you just mention electric vehicles and you're going to catch a bid? We've seen sort of this meme mania return. That was very much a part of that as far as I can see it. So interesting story. I think it fits in just fine. We're going to say upvote.
An upvote, and I just paid $7.99 for a Lyft, so maybe prices are starting to normalize. I haven't paid that low in years, so a good sign maybe for the ride-hailing economy. But we will move on with our upvotes today, those being RH as well as Lyft. So to tell us more on the technicals and the options activity in both of these names is Rick Ducat, TD Ameritrade Network contributor. Rick, let's start things off with RH, who has earnings today, a name that we've decided is fancy, very high-end, although I do have to say I wistfully walk by that store and there's like gorgeous chandeliers. I can't really afford it, but I like walking by the store.
Well, you know, that's something I'd like to. Not really in the budget for me either, unfortunately. But looking at this chart, we're down about 47% off of our yearly highs near 744. Double bottom support. I think you could make the argument for that near about 333, looking at the longer term picture here, down for the past 2 years or so. That was an interesting point to keep your eye on back in 2020 during the fall months. 8.6 thousand options traded today, about 60% calls. The biggest trade was plus 700 April 1st, 285 puts at a 95-cent debit. So basically looking for a 25% decrease by the end of the week in the stock for this trade to be profitable. Seems like they're looking for earnings to tank.
Rick, it seems like much of this rally that we've seen over the last few weeks has been led by names that have been beaten up the most. These ride-sharing names, Lyft, Uber, kind of fit the bill there. You're both catching a bid, about 6% higher here today. Any thoughts on that, and what are you seeing on the chart and in options activity?
Well, not a lot of real movement in terms of the actual share prices since the last earnings. We're only down about 4% since February 8th. Implied volatility is quite low today as well. The 56% reading, only in the 28th percentile for the year, so definitely in the lower end of the range. 17,000 options traded today, almost 90% calls. That's a huge imbalance here. Two identical large trades that took place within a couple minutes of each other. Both were plus 1,000 January 20th, 52.5 calls for a 310 debit. Looking for about a 40% increase in the stock by the beginning of next year. So pretty hefty move upward.
Yeah, someone obviously feels pretty strongly about Lyft and probably the ride-hailing industry, which has been beaten up. But as you said, it's been relatively quiet lately, which I think that quiet is something that both Lyft and Uber will take given the volatility in the overall market. But Rick will be sticking around for more on the technicals. Alex and myself will also be right back with Next Gen Investing.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. We're still joined as well by TD Ameritrade Network contributor and charting specialist Rick Ducat. We're going to go through RH and Lyft. Very different companies here. I'm not even going to try to tie them together, Jenny, but I'm interested in the technicals here because I'm looking at RH and I'm looking at it on a 5-year horizon. And it's as if all of that took place between, the pandemic and now post-pandemic has completely normalized.
Yeah, and so, I mean, it is ridiculous when you look at that chart and you see, again, what was the last 2 years almost completely erased. But some would argue, I think, that things did have to normalize and that some of these spaces where things just shot up, maybe without fundamental change in the company. And so I do think some signs of normalization isn't necessarily a bad thing, but when you're looking at this company now ahead of earnings, it does give you some pause. And I do think also it's tied to the housing market as well as its very high price tag for all of its items is another thing that gives you some pause. I actually have a hand-me-down lamp from RH that doesn't even work very well, and it was probably very, very overpriced. But Rick, from a technical standpoint, tell us about RH ahead of this report. It's a store that I say I love to pass, but that's pretty much all I do with RH.
Maybe that's how these two tie together. You have to become a Lyft driver to afford the RH lamp there. Just kidding. And looking at our charts here, it's looking like this product has been in more of a falling wedge type pattern recently. if you take a look at point A, we had an interesting gap up today above our 21-day exponential moving average. That's our yellow line there. And exponential moving averages, as always, are more weighted toward the recent price action, whereas a simple moving average is equally weighted across the data set. So we bounced off our old support near 333 about a couple weeks ago, and now we're breaking above the upper trend line in our wedge type pattern here. So it's kind of interesting that this happened heading into earnings. And look at point B here as well. So this would be the area where I think that a lot of traders would probably have their eye on to see whether we'd have some continuation or a rejection of this move upward. Near 411 matches up with the previous highs, and that was where things kind of topped out last time, and as well as being roughly the location of our 63-day exponential moving average in orange. So that moving average is about 416 or so. So if we can break above both of those levels, that would be a pretty encouraging sign for the bulls. I'm also looking at the MACD today. This is a measure of momentum. It compares two different moving averages that are kind of specially constructed here, and looking at how far apart they're diverging or how close together they're converging. So looking at point C here, we did have a bullish crossover with the faster moving line crossing above the slower moving line. However, it's not really translating to a lot of follow through so far. We're seeing kind of the bullish momentum actually waning a little bit. Look for the slower moving line, also called the signal line, to pass above that zero demarcation there. That's another type of bullish signal that you could keep your eye out for this in this name.
So bullish momentum waning, even though we do see shares up over 3%, that is a little bit concerning, Rick, ahead of this report. And Alex, like you mentioned previously, I thought you made a really good point. There are these areas of the economy that are almost insulated, those being luxury, super, super high end, which I would consider RH, or maybe the lower end, like a discount store or a dollar store. So it does fall into one of those favorable areas, but it's just, I think, predicting how supply and all of these different inflationary pressures can weigh on the stock. Obviously impossible, but there is that concern, I think, ahead of this fourth quarter report.
Yeah, one thing for certain, though, the difference between high-end luxury and discount is the margins are vastly different. Right. High-end luxury lives in massive margins and less goods sold, where discount, it's all about scale, and those little increases in cost can really have a major impact, of course, on that. So RH, unfortunately, or fortunately for them, is going to be maybe a little bit less impacted by cost increases than others, just because they have bigger margins. It's going to have an impact the same way that it would for many of these companies. It's still in the discretionary space. You talked about a lot of demand pull forward during the pandemic, and we see that on the chart. This has normalized tremendously. But from a trading standpoint, I went out to the April monthly. I went to the monthly expiration as opposed to a different expiration, just because typically there is more volume in those traditional monthly expirations. Not a very actively traded name in RH, so I was trying to find a little bit more liquidity where we could. And in this case, maybe you'll see that in the April monthlies as opposed to something on a shorter term basis. That being said, went to the 350, 347.5 put vertical. Did this in order to get a $2.50 wide spread to keep things a little bit smaller, as this is a very volatile name. Last I checked, over a $45 market maker move. So, there's a chance that this one can move, over 10% on this report. And in order to be somewhat protected by that, we wanted to define our risk. So in this case, our risk definition would be if it falls below 347.5 and stays there going through expiration, we stand to lose 200. If it stays above 350, we can make $50. So when you have that large risk reward kind of disparity where we're risking 4 for every one we can make, typically you associate that with a little bit higher probability of success. And so our break even would be 349.5, but let's not be confused here. This is very much centered around this earnings event. Likely we'll have an idea of how this will turn out as soon as this comes out.
An earnings pure play, but like you mentioned, shares could fall $29 over and this trade would still be successful. So like you highlighted, that high probability of success, something very important to keep in mind when heading into these earnings events, and this is maybe more exposed to that earnings event. But now our next name today is Lyft. Rick, and you previously mentioned that 90% of the options traded today were calls. So some fairly bullish momentum in the options market today. It's interesting. I think the momentum has shifted a little bit on these companies, ride-hailing companies. Not necessarily surprising as we have seen things start to normalize. And I actually had such a positive Lyft experience the other day, which was my first one in months. I mean, I haven't taken a Lyft or an Uber in months, that I might even be changing my momentum here.
That's good to know. So our chart here, I think I'm going to approach it from a more bullish perspective based on the news that we saw today. So looking at what we've got here first, we passed above the yellow 21-day exponential moving average after bouncing around it for a while here, and we're also peaking our head above the 63-day exponential moving average as well. And keep in mind that these moving averages, they operate as support in uptrends and resistance in downtrends. So we broke through some important resistance there. Price is still kind of within a more triangular pattern there. If you look at those two white dashed lines, they're converging toward each other. So this is the kind of situation where you can see some interesting buildup in a name like this. You can see some like a pop bottle being shaken up. The pressure is building when it's bouncing around back between two increasingly narrowing ranges. So I think if you were looking for an upside breakout, the first point that you'd want to be looking at would be around 43, because that would be the line of our upper trend line there. So a break beyond that would be important. That'd be probably what you'd be looking for as a trader. And then the resistance point is near point B then, our 252 exponential moving average. That's near about 45 and a quarter or so. And keep in mind as well that moving averages, the more time that's included in the data, the more significant it is. It's the shorter ones are more responsive, the longer ones have greater weight, so to speak. Looking at point C finally, we're having kind of a similar momentum situation to our previous chart. We did have a bullish crossover recently, but not a lot of follow through in terms of big bullish momentum to the upside. Now today we're having a nice move upward. We're up over 6% now, but that hasn't really followed, it isn't really being reflected quite as much yet in this indicator here. So keep your eye out to see whether the momentum starts to increase. If these two lines start to diverge and separate from each other, that would be a sign that the bullish momentum is building in this name.
So some tentative bullish momentum, we'll say today, Rick, and you highlighted watching that $43 price level with Lyft trading just shy of $40. We needed it to go up about $3 to that level. But as always, your insight is so important on both of these names, especially RH ahead of that report. Thank you so much, Rick Ducat, TD Ameritrade Network contributor. So when looking at Lyft, Alex, obviously not an earnings catalyst, but a name that is seeing momentum today. I mean, up 6% on the day, so definitely worth keeping on our radar. And that $43 that level that Rick highlighted, I think was an important one to keep, sort of in mind when trading.
Yeah, and you guys both mentioned call volume. Just wanted to quickly explain why maybe isn't an indicator of where we're going to go, but it can be an indication of why we're seeing an exaggerated move. Is if you think about it, if the regular everyday investors are buying calls, those on the other side of the trade are therefore selling those calls to them, and they don't necessarily have an opinion. They just want to have a neutral offsetting trade. They're just looking to operate at scale, and so therefore to offset some of that directional risk, they'll go out to the open market and they'll buy shares of stock. So it can kind of be fuel to the fire, if you will, when you have big moves already happening, adding some additional momentum one way or another. We're looking to, in this particular illustration, also join in some of that call buying. As what we're doing is we're buying a call vertical going out to the April monthly. We're buying just one strike in the money at 39, and we're selling the 44 call. It's slightly above the level that Rick had talked about, around 43, and it also corresponds to a recent high that we had seen in the stock. And so looking to do this for $1.80, that would make our break even in a couple weeks in April to $40.80. Max profit on this would be $320 if it was above 44. And since we had the news on the electric vehicles, I won't say run out of gas, but what I will say is maybe you'll see this stock rally, and the idea would be that it maybe needs to recharge around 44, and so that would be where we kind of cap those gains.
I love the good EV pun, and I do think it's important to look at a longer term or even just the yearly chart, because despite the fact that we are seeing this 6% move today, obviously that green candle is very noticeable, but things have fallen a bit for this name. I mean, this is a company that has dealt with a lot of weakness over the last year, year and a half. So things are still relatively low, which is something to consider when obviously we just, looked at an example bullish trade. But that does it for this segment. Now, coming up next, we'll be talking Lovesac. That's ticker symbol LOVE, which I love that ticker, no pun intended. Seeing some movement today following their fourth quarter earnings.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Next Gen Investing. I'm Alex Comfy alongside Jenny Horn. Jenny, today we are talking Lovesac, the subject of our FOMO segment here today. And we were talking before the break. I know you had done some looking into some of the products that are available that they're selling. But I had a couple of these in our house when we were growing up. I haven't seen, talked, or sat on one of these things, and it has to be a decade.
I mean, I didn't realize how long-lasting this company is. It was founded in 1995, so this is not a new company. They just went public back in 2018, which I remember when they went public and their debut on the NASDAQ. But this is not a new company. Like you pointed out, these have been around, and they're very well-loved couches and what they call Sactionals. That is their words, not my own. But they do specialize in what I would say are higher end, kind of continuing our RH conversation. They have all of their couches and Sactionals are washable, customizable, guaranteed for life. They have a 60-day tryout guarantee, and they ship for free, which is big in this economy. But they also have some couches that have speaker functions and different charging functions. I think the part that really got me, Alex, was that you could have these couches for life, they say, or at least as long as the company is around, they will guarantee to fix up your couch for life. But they are not cheap. What we were talking about before during the break is that I looked at a 10-seater Sactional with 12 slides in leather, which retails for $29,000, which is a lot of money. But regardless, shares are surging today, up about 13% on the day following their fourth quarter and fiscal year results. Now, they reported fourth quarter sales growth of 51%, beating their estimates of $174 million, totaling around $196 million. Gross profit also rose 46% year over year, with margin contracting by about 200 basis points to just shy of 56%. Now, their operating expenses did climb 60% year over year, while EBITDA increased over 23%. And their earnings per share actually grew ridiculously. They grew 48% from a year ago, but they crushed forecasts by nearly fourfold. So the company's CEO did highlight their strong financial performance. They said that they are now facing several macro and industry shifts, which affirms their power of their unique business model and their products. They said they will continue to drive growth by making smart investments in their product extensions and technology, by deploying the company's omni-channel sales model and implementing supply chain as well as operating efficiencies, which to me sounds like standard CEO talk, that they will be able to handle the situation going forward, given the different, obviously, headwinds really weighing on the retail industry as a whole. But to see a company like Lovesac that has been around for years and years and years be able to grow their sales 51% is why I think it's a FOMO candidate today, Alex. I mean, I don't think I'm necessarily in the market for their most high-end couches, but they are a very cool product. And a store did just open by my parents, and I was asking them about it, and they said it's always packed. So, I mean, there are not a ton of actual physical locations. I think there's about 120 in the country, but a very interesting company that operates in what we utilize in our home every day, which is your couch.
Yeah, and I think they've obviously made investment into other areas to greater, open up their potential addressable market. Because let's be honest, kind of the beanbag chairs that they have, the Lovesac's that is their namesake, that's a particular market. It's not going to hit, the same level as the Sactional, which I'm looking at. It's a couch.
Yeah.
It's a couch. It's a modular sectional, but they have speaker systems that you can get embedded in them as well. So they clearly have done, and placed money into innovation, into research and development of getting things beyond just their traditional namesake product. And hasn't completely paid off for the company, but overall, if you look back over the last 5 years, the stock has generally done okay. It's certainly higher than where it was 5 years ago, and of course, maybe you saw some of that demand pull forward throughout the pandemic time period, spilling over into last year. And then, of course, we've seen a lot of the froth come off the top for many of these names as well. So I'm looking at it, Jenny. I think it's certainly an interesting conversation. There's tons of volatility, though, in it. And so with that, even post their results, options are expensive. You're getting quite big option premiums for this, and so you have to kind of consider what kind of risks you would like. What I looked at here was a call calendar, which sort of utilizes some of that near-term elevated volatility against some of the still elevated, but a little bit less so implied volatility of a further date. And so we talk about this as a highly customizable style of trade, as you get to select durations as well as strike selection. But really the goal here was to reduce the debit and so that we don't have a tremendous amount of capital being allocated to this trade. It allows for a little bit less to be set aside compared to other strategies. So the downside of that is you need something to happen. More than likely we'll need a rally towards 65 over the next few weeks for this to be a profitable strategy. In the event we do not get that, or even that it shoots well beyond 65, which is certainly possible as well, you can see that our risk profile starts to tail off. So we talk about this sometimes as throwing a dart at a strike price and hoping that it reaches our level. So if 65 didn't meet the particular investor's benchmark for what they thought was going to happen, they would likely look for a different strike. This is just one illustration of a rally towards 65. One of the reasons I chose 65 is that was actually pretty close to where we peaked out today. So if we just saw kind of a move back towards the highs of the session, that would get us towards 65.
Yeah, so obviously, hoping to gain on some of this bullish momentum we are seeing today. And you'd have to say that similar to what we discussed with RH, if you believe in sort of any recovery or normalization in the markets, or you believe that things are headed to a more normal, this might renew consumers' faith that, you go out and buy the $28,000 couch. Although they do have some that are more reasonably priced, but this is definitely a higher end item as well. But that sort of, I would say, if you were interested in buying a $5,000, $6,000, $10,000 couch, you might perhaps still be interested regardless of the economy, which ends up being, I think, a tailwind for a company like Lovesac. Seeing a positive move today, clearly a positive reaction to those earnings, and a very interesting company. I spent far too long on their website this morning, Alex, but that does it for this FOMO segment today. Coming up next, we will stick with our earnings theme. We will be talking Chewy ahead of their earnings, which are due this afternoon.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Next Gen Investing. I am Jenny Horn alongside Alex Coffey, and we are also now joined by Caroline Woods, TD Ameritrade Network contributor, to help us preview Chewy ahead of their report. Now, Chewy is a company that's been faced with a good degree of weakness lately, which I find very interesting because we have discussed on this show how this almost is a consumer staple. If you have pets, I know it's considered discretionary spend, Caroline, but unfortunately, you do still have to feed your pets no matter how bad things get with the economy. So it has been interesting to watch this name take a nosedive, but they do operate in a very niche market. And I do have to say, anecdotally even, that you do have to spend top dollar on your pets. It's amazing how quickly it goes on Chewy, but unfortunately it does. So really, what can we expect for the pet retailer ahead of their earnings?
Well, I think pets would argue that pet food is a staple versus discretionary spending, but Chewy's actually up about 2.7%, 2.8% ahead of those results this afternoon. Over the past 2 days, it's gained almost 10%, but year to date still down, or actually over the past year still down about 40%, 15% year to date. In terms of what we can expect, a loss of 7 cents per share versus a profit of 11 cents a share in the year ago period, also wider than the previous quarter's loss of 3 cents a share. Revenue is expected to come in at $2.43 billion. You know, Chewy was a big pandemic beneficiary, but as you said, it's gotten hit very hard and up against multiple headwinds now. On its Q3 earnings call, Chewy executives warned, or they basically talked about inflationary pressures, product shortages and labor constraints making execution challenging, so not so much a demand issue, but just these headwinds. Also said they expect those to continue to weigh on near-term profitability, hence the expected loss. That said, earlier this month, Wedbush did warn that Chewy could release a muted near-term and 2022 outlook, partly because clients are going back to physical stores, Wedbush argues, so that would translate into a demand issue. Wedbush says there's modest risk to the 20.86 million customer count estimate. That's the consensus. Also said inflationary pressures on margins will likely remain severe in the near term, pointing to an increase in FedEx shipping rates. So Chewy likely to address all of those headwinds on its conference call today at 5 p.m. Eastern. But yeah, it certainly seems like not so much demand, so people still may be ordering and they need the pet food, but there's been shortages, not just in terms of labor, but also in terms of inventory. So we'll see if there's any easing in sight or if they continue to be up against these.
I hosted alongside Tom White Fast Market yesterday, and we had Andy Swan, the co-founder of Likefolio.com, on, and he talked to us about this company in particular. One of the things he stressed was just how happy the consumer data is that tracks this particular company. And I can say anecdotally from my own experiences with it that they do stress customer service, and maybe that's the differentiating factor of them and something like an Amazon that really focuses on scale and availability of products, and of course, speed at which you get them. Chewy is looking to differentiate by being kind of that number one player for whatever their set of demographics of their addressable market may be. I've argued that it's a very urban demographic when you look at something like Chewy. It's a lot more difficult to go get a bag of dog food or cat food if you don't have a vehicle. But if you live in, the Midwest, suburban America, you drive to the store, you go to your Super Target or Walmart or wherever it may be, you just throw it in the cart alongside everything else. It's maybe not your favorite thing to go buy. It's a little bit heavier, but it's not that much more difficult. I have to walk down the street half a mile. It's a lot more difficult. So I don't know if you have any experiences with this brand, if you got a pet at home, but thoughts on kind of where they fit in this space, because we know we're also seeing investment from them in things like pet healthcare and trying to get more of that discretionary spend as well. Seems like they're trying to build a pet ecosystem.
I don't have any experience with Chewy because I don't have any pets, although as I was doing some research for this hit, I did notice quite a few comments about the customer service being top-notch, which should, of course, count for something. I will say that Wedbush just came out adding Petco, so a Chewy rival, to its best ideas list ahead of Chewy's earnings. And what they pointed out in terms of rivals said Petco should be more resilient than rivals due to its exposure to higher spend customers, growing loyalty offers, unique revenue drivers, and a $1.4 billion own brands portfolio that cannot be found elsewhere. So I thought that gave a little bit of interesting insight in terms of what Petco offers that Chewy might not, and that's basically higher priced items. So clearly, when we talk about consumer confidence, consumer demand, higher priced items, they're still seeing demand for that from those people that have money. I do think another headwind, though, Alex, that could be addressed on this conference call, but RBC seems to think that it could be in the rearview mirror soon, is the labor issues. They said they think labor will undoubtedly continue to pose a problem in Q4, particularly as COVID-related absenteeism further stressed an already tight labor market. But of course, that's in the past. So the analyst notes that Chewy's already at the tail end of labor issues, citing the company's outsized progress in filling roles that have been particular pain points. So pretty impressive that they've been able to maintain such great customer service despite having a shortage of workers. But it sounds like that's a headwind that could get cleared up soon. I will say we have seen a few price target cuts heading into this earnings report. Citi adjusted the price target to 48 from 61 last week. Barclays cut to 43 from 64 about a week before that. But overall, analysts, the majority do have a buy rating on Chewy still, 14 buys, 9 holds, 1 sell. And some of the price targets are as high as 100, which of course is what it traded at during the peak of the pandemic. I saw some in the 90s. So some analysts still especially with a median price target of $68, it's trading around 50, still see upside momentum here. And it looks like the past 2 days, it's really started to see that momentum. So we'll have to see if it can continue when it releases the report later after the bell.
Yeah, up over 6% so far really this month, as we have still 2 trading sessions left, or I guess 2.5 in this month, Caroline. But I saw an interesting fact that said the percentage of pet products sold in the U.S. online specifically jumped from 4% to 27% from 2014 to 2020, which just shows that people started then, I think it was just the pandemic, getting their things online. But I'm also speaking in a very urban area, like Alex pointed out, so I'm a little sheltered because I would pay top dollar to get my cat litter delivered because that is really, really heavy. But of course, there is that large market that a company like Petco is taking advantage of. So I tend to forget that there are other companies in this space because Chewy's delivery is so wonderful.
Other than Amazon.
Right. I mean, and they've done actually, I think, a better job than many would have suspected competing with an Amazon. But things are crowded, to say the very least. Even though people will spend top dollar on their pets, it's a very crowded space. But Caroline Woods, as always, thank you so much for joining us. Now that does it for this segment today. Coming up next, we are talking costs. That's ticker symbol KOSS. Falling now following, I would say, a product announcement, some mixed meme stock activity. We'll dive more into that coming up next.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
I'm Maria Schrader. Here are a few stories to watch this hour. Deutsche Bank downgraded CVS Health to hold from buy and kept a $110 price target. The analyst sees a negative risk-reward ratio and thinks there could be negative near-term estimate revisions in the pharmacy segment. He also sees potential negative headwinds from opioid litigation. CVS is down over 3% today. Credit Suisse cut the Real to neutral from outperform and cut its price target to $8 from $15. The analyst says he is disappointed by guidance and that the company's path to profitability is significantly longer and requires much more gross merchandise value versus its initial IPO model. The Real is still up over 2% today. And Morgan Stanley downgraded Norton LifeLock to equal weight from overweight and kept a $28 price target. The analyst sees downside risk for Norton's fiscal 2023 revenue estimates because of slowing sales and the general macro environment. Overall, he sees limited catalysts for Norton to move higher. The stock is down around 4%. This has been your TD Ameritrade Network Market Update. Now back to Next Gen Investing with Alex Coffey and Jenny Horn.
Thank you, Maria. Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, Taking a look here at Cost Corp here for under 30. A little bit lower price stock, of course, down a little bit today. A little bit maybe tied up in the meme stock run, I would say. And to say a little bit, I mean a lot of bit. This is one of the original names. Maybe didn't get the same amount of attention as a GameStop or an AMC. And I was thinking about this during the break because this is like kind of a headphone and speaker sound equipment company. GameStop electronics, AMC kind of electronics, costs electronics. So for some reason, there's this desire for this meme mania to take place in these sort of entertainment sound system type of companies.
I almost put Koss in the bucket with BlackBerry, which is also a meme favorite, because I looked at some of these speakers and I'm a little bit mixed. But we had some news today. They announced on Twitter an all-new utility, which they say features detachable USB Lightning, 3.5 millimeter cord to give listeners flexibility. They said it honestly looks like a headphone I used 15 years ago, but nonetheless, we have seen the stock surge, and it is lower today, but they jumped over 29% last Tuesday. But again, I would say a lot of that momentum is tied to the rally we've seen, most notably in a GameStop as well as an AMC. So to tell us more on Cost Corp is George Tillis, TD Ameritrade Network contributor. George, is this a meme surge? Does this company actually have meaningful value still? Are they, I'm associating them with BlackBerry based off of the one snippet I saw of their headphones, but they sort of seem like yesterday's headphones.
I think so. Look, I think it's certainly getting caught up with the meme stocks, and it was a highly touted meme stock last year. I mean, it went from around 250. It was a trading range at 250 for years, and it jumped on an intraday basis to over $100. It closed at around $65, but overall, last year the short interest in the stock was about 30%, and I think it's getting caught up again in this short interest squeeze, a meme phenomenon. But there's things that are different this time around. A few things going on, and I think this is why you're seeing huge jumps in the stock, is one, the market cap is very small, around 75 million, so that means it can be pushed around very easily. But two, if you look at its top line sales, and I went back 5 years, top line sales compound annual growth rate is down 6% per year. So that's 28% over the last 5 years, whereas the industry group, which includes companies like Bose and Sonos, GoPro is actually in the audio speaker and headset business as well. Apple, we have to think about them as a competitor, Turtle Beach as well for the gamers. Lots of competition, and market share has been eroding. But the industry, in terms of compound annual growth rate, has been growing about 28% per year, or 276% in total over the last 5 years. So you can see the disparity in terms of sales growth, which is declining for costs, but actually increasing for the industry group. Now, the thing is, it's a very low volume, low float stock, so it can jump around. But I did look at the short interest last year at 30%, and now, based on last month's figures, at less than 2%. So I think that you're going to see a lot of volatility in the name. If you're looking for a short squeeze, this may not be it anymore, because of the fact that it looks like the short's covered, and the company is profitable, albeit it's a small profit, about 4 cents a share, is trading over 300 on a trailing basis in terms of their multiple with decelerating sales growth. So I don't expect a lot for the company, but there's not to say that traders will bounce back into it, push it higher, but with low volume, the way it's trading, expect lots of gaps and lots of volatility.
George, I'm just going to say it. I'd be willing to bet that those who are involved in this, on average, couldn't tell you any of that information you just gave me. They're looking for volatility. This is the same way I think of GameStop, AMC, Bitcoin to some extent, Tesla even to some extent. This is a desire for volatility. We see these names all perform better when volatility comes out of the overall market. When we see volatility in the overall market, they find a different playground to play in. Maybe they go to E-mini S&Ps. Maybe they go to Apple. Maybe they go to Microsoft. But you don't see these names typically do well when the overall market is volatile. For me, this has always been, alongside many of the other meme plays, a desire for movement and risk. Thoughts on that before we say goodbye?
Yeah, so look, it's a good point to bring up. This is going to be a name that's very volatile. And I just looked, it looks like they don't have options that trade. So if you're looking for what's so-called gamma squeezes, in high short interest stocks like AMC, which again, short float is about 20%. Options are trading at the call volumes are through the roof. That essentially, when exercised in the money calls, are subject to, of course, purchases by market makers and brokers, that can create a squeeze. So if you're looking for an option-based squeeze, maybe cost isn't the play. But then again, based upon the low flow of the stock in terms of the market cap, it can be pushed without options. So this is an interesting one because it doesn't trade a lot of volume, doesn't have options, but low market cap. So, I have to say caveat emptor to all these names. There's no reason, or buyer beware, there's no reason not to participate. You have to be aware of what you're buying. It's fun stuff if you're making money, but you have to consider the downside risk as well. And looking at the top, 25 to 50 stocks that are highly shorted, cost is not even on the list, as I mentioned, because the short interest is now less than 2%. So maybe not a squeeze-based stock, but there's certainly a lot of beta still in this name.
All right, George Chillis, good stuff. Thanks as always. That does it for us here on Next Gen Investing. For Jenny Horn and myself, we'll see you tomorrow. The watch list is coming up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watch List. When the default list appears, select the name box, then Create Watch List. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Good afternoon and welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange. Thanks for being with us. Let's take a quick look at the markets. 2 hours left in the trading session. You can see plenty of green as the rally continues on Wall Street. The Dow Jones Industrial Average up 179 points at 35,134, gaining a 0.5%. The S&P 500 is up 36 at 4612. The Nasdaq gaining 1.3%, and the Russell up 2.1%. Today's top story: investor sentiment is turning optimistic as traders are watching peace talks unfold between Russia and Ukraine. Russia's deputy defense minister said earlier that the country will drastically reduce military activity near Ukraine's capital of Kyiv. The news has pushed major indices higher, with the Russell, as we noted, leading that way. Tech-heavy Nasdaq looking pretty good, too. Let's take a closer look at the top stories. Ben Lichtenstein is with us, host of Futures on the TD Ameritrade Network. Ben, good to see you. So look at what's been going on. Equities continue the move to the upside, right? The Dow and S&P up for the fourth day. So that's some good news. In fact, the S&P and the Nasdaq are having their best month since October. What's going on here?
Hey, Nicole, good afternoon. Yeah, we're seeing some optimism, as you mentioned, with the Nasdaq back up through 15,000, the Russell up above 2,100, and again enjoying some gains today. Now, I'd argue it's somewhat cautious optimism, as we did hear some comments from some of the top Russian negotiators. We heard from Ukraine negotiators, and that's what really sent the market higher in terms of that risk-on sentiment. Now, we've seen the indices to the upside, commodities to the downside, with some of those geopolitical tensions easing some of those that premium we've seen come into crude oil, for example, and while some of the other products has come off. Take a look at the selling. This is the 1 minute time frame, so you can see today crude back below 100 for the first time since mid-March. Now, this came after some optimism tied to, well, Russian negotiator Vladimir Medinsky said that talks were constructive. This is a 3-day talks going on in Istanbul, Turkey. And you have Russian top negotiators again saying that they're going to look at Ukrainian proposals and report on them to Putin, and possibly there would be a meeting between Putin and Zelensky. Now, here, take a look. As you can see, though, crude oil coming off to 98.44 and then kind of rallying back a little bit, more of a sense of realism coming into play. Also, take note, we were unable to take out key lows. Again, 93.53 we saw earlier in the month of March. And I just want to point out, we're still holding at relatively elevated levels, just off that all-time high of 147, but you can see off the pandemic lows where things stand. So again, crude oil at $100 a barrel. Well, partially what's got the 210 inverted today for the first time since 2019. But, you know, again, I think some of those comments were dialed back a little bit. Russian negotiators said that de-escalation around Kyiv and some of the other cities do not mean a ceasefire. They were very clear that there's still a long way to go to actually reach mutually acceptable an agreement with Ukraine. So I think that's why some of the big moves that we saw kind of were tamed a little bit throughout the day.
Yeah, good point. I'm glad you brought up the 210 curve as well. So as they're feeling some optimism, tell me what's going on here with gold.
Oh, this is actually interesting because we've seen gold almost mimic the dollar in many ways recently as well. You have that geopolitical premium come into play. That's given the greenback a little bit of a lift, or it's been supported by some of that safe haven type tendencies. Gold, a very similar situation. We saw it to within $20 of an all-time high, but that move was short-lived. And even today, with these comments coming across the wire earlier this morning, gold sold off. So take a look, similar to crude. I mean, when you're talking about the geopolitical premium coming into play and ultimately out of products like gold and crude, in this instance, gold, well, it sold off, as you can see, down to 1893.20. Now, again, much like crude, a very similar pattern, kind of rallied back throughout the day. And as mentioned here, the dollar has sort of been working its way back off lows from earlier down to 9,800. So to see both kind of inching back up really speaks to some of the geopolitical premium and tie to these comments this morning. Now, we mentioned how crude was unable to take out the March lows from earlier this month. Look at gold. It actually did get below that key level again, below the, what was that low again? It was 1895.20. So we got down to 1893.20, but we always talk about spending a prolonged period of time below a key area of support or resistance, above a key area of resistance, in this instance, support. And you can see we spent very little time down there. So kind of a V-bottom pattern forming, maybe a double bottom for the bulls to find some support on. And then also, I just want to point out, still holding above the 200-day moving average. You can see, again, we were talking about crude relative to its all-time high up around 147. Gold just shy of the all-time high just recently. Again, first first week of this month. It fell short of, but you can see we're remaining relatively elevated, holding below 2,000, but up above 1,900. So again, as mentioned, that optimism you were talking about, I think it's cautious optimism. I think investors are kind of looking at potential for both sides to play out here still.
Yeah, well, that was the rally from 2009 till now, really, right? I mean, they saw a rally that ran up, and people, it was the rally they love to hate because it just kept running up, but they felt so cautious the whole way. Let's see what happens next. Thank you, Ben Lichtenstein, host of Futures on the TD Ameritrade Network. Thank you. Now let's take a look at the bigger picture. Paul Schatz is with us, President, Chief Investment Officer at Heritage Capital. Thank you so much for being with us. So we were just noting the gains that we've been seeing. In fact, the S&P 500's at the highest levels since mid-January. I mean, what do you make of the moves that we've been seeing, Paul?
Hi, Nicole. Always good to be with you. It's a couple things. Number one, people are making the monumental mistake. Number one, they made the mistake in Q1 that the decline was somehow Russia and Ukraine related. Last time I was with you, I said it's 80% Fed, 20% everything else. Now, the headline seems so bad. People are talking about the inflation boogeyman and still the possibility of a nuclear weapon. They're losing sight. It's not what the news is in the markets, it's how the market reacts and responds. They could not bang the market down any lower off of the February 24th bottom. We had a couple more attempts in early March that failed. So that was a clear bell ringer that, look, we may not be going back to new highs in March, but the path of least resistance was now changing to up. And today, I'm sure after today, you'll see all these bulls come out of the closet because, as you just mentioned, we're now above those kind of critical February highs in most of the indices. So that will beget more buying. The VIX is now below 20. That begets more buying. And finally, quarter end is more buying because how far stocks fell.
So that noting, I mean, you're watching the Fed, and while there are concerns about inflation and slower growth, you still think recession's not in the picture here, right?
I don't think recession's in the picture this quarter, next quarter, Q3 or Q4, no. Look, the next recession is coming for sure, but the last one was less than 2 years ago. So I know everyone now is a yield curve expert, and there's got to be 15 to 20 different yield curves. But once the yield curve inverts, it's not a point in time that you go, holy geez, here's a recession. It takes quarters and sometimes years for a recession to hit. It's a horrible, timely indicator. Eventually, and maybe sooner than later, perhaps in 2023, there'll be a recession and we'll look back and blame it on inflation or oil or whatever boogeyman comes along. But inflation is not in the picture today. Earnings growth was slowing and GDP is going to slow. That was my forecast to begin the year. That's still the same. But listen, we're coming off some really good economic numbers. We're not going to go from 5, 6, 7% growth to negative growth. It doesn't happen that way unless you get a global pandemic, which I don't think we're going to go through again.
You actually see Dow 40,000. Dow 40,000. When is that?
Coming into the year, I said we would be a choppy, frustrating, not a fun and a challenging year for equities. But at the end of the day, we go down Q1, up Q2, maybe down Q3, up Q4, plus or minus 5%. This year looks like 1994 and 2018. I wrote about it on our blog the other day. I'm banging on my fist that I feel super strong conviction. From this year, we're going to have another run a la 2019, 2017, 1995, maybe not that big, but so Dow 40,000 is a next year story. This year, people should be happy with maintaining kind of the status quo. If you're plus or minus a little bit, you're not going to go to cocktail parties and pat yourself in the back and tell your neighbor what a genius tech stock picker you are, but it's not going to be a horrible year. It's just one of those years we're going to digest some big gains. The Fed is our biggest enemy.
Right. And then you think that everything's sort of peaked, the inflation print, as you see oil coming down. You noted used car prices. You'd called that?
I started writing about it in Q4 that I felt very strongly inflation would peak by the end of March, which is in 2 more days. So could I be off by a week or a month? Yes, I feel super strong conviction. Again, inflation is peaking right now, right this second. Bond yields are peaking. People think because the Fed is raising rates that long-term rates, bond market rates that they buy in their mutual funds are going up. Not the case. When the Fed starts raising rates, you're at the end of the move in bonds like the 10-year. So yeah, I think inflation is peaking right now, market down. And I think you can buy bonds in this period. I think bonds will be a very, very, very rewarding investment next quarter and for certainly the rest of the year. The risk reward is sensational.
All right, and then you like biotech, REITs, and of course you followed Tegna all this time, which in 3 months was up 20% with a buyout now. That's a name that you had brought to us. Tell me a little bit about that and then those sectors that you like.
So Tegna, I've offered a number of times as a pick here. It's a super media, or it was a super media company. And I said, you know, the big catalyst there is going to get taken out. They had multiple offers. Well, it finally came to fruition, got taken out at $24 all cash. That's coming up. So kudos if you were able to hold on to that. Sector-wise, look, whatever falls most bounces most. That's why you're seeing stuff like, you know, semiconductors and internet and technology as a whole bounces strong. Right? That's the norm coming off a bottom. And field leadership will emerge. Biotech has been so I could easily give all the stuff that's gone up. Doesn't help investors. Biotech has been so decimated. It's the worst subsector that I can find over the last, 15 months. So that one, at least your risk reward is skewed in the investor's favor. That's number one. And REITs, kind of at the other end of the curve, we started buying REITs just a couple of weeks ago. So it's a fresh buy for us, but it certainly has the look and feel of a sector that wants to lead. And you could push back and say, well, that's a little defensive. It's got all that yield. Sure. But you have a little barbell there with some crazy aggressive growth on biotech. It's the conservative REIT side.
Yeah, I have to go, Paul, but did I hear you say Dow 40,000 or did I only read it in the notes? Dow 40,000?
No, I think that's a 2023 story, not a 2022. And yes, Dow's going to 40,000.
All right, Paul Schatz, nice to see you. Thank you.
Seeing you.
President Chief Investment Officer at Heritage Capital, Paul Schatz. Coming up later this hour, Apple is on pace for its best daily winning streak since 2003. Can it do it again? What are we up to, 11 days? Greg Martin will tell us why. Then we'll preview Lululemon's fourth quarter results before they are released after the close. And our panel is ready to stand by and talk about memory chip stocks and what names investors really should be watching. We'll take a look also, a technical look at Synopsys and Cadence Design Systems to see what stands out about these names. Stay with us.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait for it.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back. Let's take a look at the biggest movers in the market right now. Shares of Nielsen spiked higher after it agreed to a $16 billion all-cash deal to go private. It's $28 a share. The deal with the private equity consortium is $2 billion more than the deal it rejected last week. FedEx announced that founder and CEO Fred Smith is stepping down on June 1st. He'll be replaced by the current president and COO. Smith founded this company 50 years ago. EPAM systems jumping amid the rise in the major averages. Investor sentiment seems boosted by renewed hope for Russia's ceasefire in Ukraine after the Russian deputy defense minister said that the country will drastically reduce its military activity near Ukraine's capital. Norton LifeLock shares are falling after Morgan Stanley downgraded this stock to equal weight from overweight. The analyst maintains a $28 price target but cites uncertainty for the rating change. The analyst sees slowing top-line growth as it moves further away from COVID-related tailwinds. Here's a look at Bitcoin. It's around 47,000. Let's check it out. 47,820, down 0.75%. So let's talk with Kevin Horner and do some technical analysis, Senior Manager Trading Services Education at Charles Schwab. We have a couple of names here. The first one is Synopsys, Kevin, and I saw it's been creeping higher. Tell me a little bit about this one, also a share repurchase program too.
That's right, Nicole. First of all, your office here is fantastic. Consider me extremely envious of your placement today. Looking at Synopsys and Cadence both, these are application software positions, and you know the software group has had a very rough 2022 until the last week plus. In fact, really just kind of making a new higher low in the very recent week and a half. And so I went diving into the group looking for some leadership here, and I found two that look pretty darn interesting. Both of these had consolidated recently. Let's look at Synopsys first. Consolidated in a pretty good range between about 280 and 3.25, 325. And in the last 2 days, just yesterday's move in particular on Synopsys took us through that major ledge at 325 and seems to have some momentum now. And so this is an interesting one for traders who maybe have been long in the window of consolidation. They might very well be looking for ways to get themselves some profitable exit strategies. And that might mean working against a very short-term moving average, like maybe a 10-day moving average that can kick them out if the trend of the last, say, 2 weeks is broken. That's one way to think about it. So they can, if you've been in this and you're looking for profit opportunities, something like that short-term moving average can work. When you look at the breakout ledge at 325, though, a lot of traders expect a retracement to that same breakout. So if you're a trader who's not in a position like this and you're thinking, hey, I don't want to miss out, but I still want to participate, maybe you start small and let things go a little bit and see if it gets thrown back to the breakout spot. And if it can hold that breakout ledge on a confirmation basis, then it might inform the bullish trader that there's more opportunity and they may feel comfortable adding to a winning trade or a position that continues to maintain that 325 ledge. But, you know, this break of this major area, it's a 45-point range. The implication at this type of break could be to test the prior highs.
Okay. Well, we like that. We love your charting capabilities here because I know there is a similar story, at least in that they've both been creeping higher of late. Cadence is the next one, had a March 9th death cross, but after that, really moving higher. Tell me a little bit about that one.
Yeah, you're absolutely right. The exact same thing kind of playing out here. The small difference is that in the last week on Cadence, we've seen a nice, comfortable consolidation, even as it was moving through a major ledge of resistance at 158, kind of coincident with that 200-day moving average. And what's happening now, similarly, is that you have a 10-day moving average very quickly sloping up through the most recent ledge of what was resistance, likely now support in that 158 to 160 area. And again, it offers the traders opportunity to say, hey, I want to participate if this is going to be the bigger move in software. There's a good opportunity once more. When you break a range like this, this was about, let's say, 135 to 158, a good 23-point range there. That added to the breakout spot at 158. Now you're targeting that mid 180 range, and that again gets you close to the prior highs. So, normally, Nicole, I like to come to you with trades that can kind of be construed either way, bullish or bearish. But these are significant moves in companies that have been outperforming their sector, believe it or not. They both were beaten down, but they held up better relative to the S&P 500 than the software sector did by itself. So when you're thinking breakout in an individual group, a lot of bullish traders lean on leadership, and it looks like these are two that have kind of made the move a little bit in advance.
All right, Kevin Horner, thank you so much. Yeah, we're on the floor of the New York Stock Exchange. I know you like where we're sitting here, so we've put our footprint here. Pretty happy about it. Thank you, Kevin. You'll have to visit when you're
Nicole.
in New York. Kevin Horner of Charles Schwab. Thank you. Coming up next, megatech companies are experiencing a rebound. I know you've seen it. How about a real leader, and that is Apple? Much more. Stay with us.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the Watch List. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's time to talk about Apple. Apple experiencing its best run since 2003. We're talking about, I believe it's 11 straight up days. Let's talk about this tech giant and welcome in Greg Martin, co-founder, managing director, Rainmaker Securities. Thank you so much. What a streak and the daily gains that we've been seeing. What are your thoughts when you take a look here at Apple and this run in particular, whether or not it can continue?
Well, good to see you again, Nicole, and thank you for having me. You know, it is interesting. When we spoke last, we talked about Apple's new announcements with their new products, including the iPhone SE 3. And today we find out, although yet unconfirmed by Apple, that they are planning to cut production on their SE3 and and some other iPhone and AirPod units. But yet Apple remains as hot as ever. It's up 11 straight days, as you point out. And its stock is nearing 3 trillion. And I think the market, when you think about what's going on with global uncertainty, the war in Ukraine, inflation, I think the market, is still really taking a flight to quality, and they view Apple as about as high quality and stable a company as there is. That said, they're now trading at something like 28 times forward earnings. Their inflationary concerns, the production cutbacks that we just saw today. China has some lockdowns, which represents close to 20% of Apple's revenues. They've halted sales in Russia, which, while small, still is about 2% of sales. And there's still a lot of global macroeconomic headwinds that make their sort of hot streak a little bit, suspect, especially since they're already trading at 28 times earnings. So it's going to be fascinating to see how the rest of the year unfolds and whether they can keep this hot streak alive. I think that some of the headwinds will start to impact the stock.
Right. Do you comment on the stock or not necessarily on the moves that we're seeing? For example, right now, over 6 months, it's up over 20%. And as we noted, it's had 10 consecutive sessions of gains. Today is the 11th. We had on Dan Ives earlier from Wedbush today, who had his base case at $200 a share and $220 as his bull case.
I generally like the stock for the reasons I stated, but there are some headwinds, and those headwinds ought to start affecting Apple. And of course, last week, the EU just came out with their tech crackdown with the EU Digital Rights Act, which is taking direct aim at companies like Apple and Google. And if you look at one of Apple's biggest drivers for growth and gross margin, it's in their services business. So think iTunes and digital downloads in the App Store. And the EU has said, we need to open up your platform to other app stores. So there's definitely headwinds. And of course, today's announcement about lowering production and forecasting by 20% on the SE3. So I'm maybe a little more confident than Dan is about where the stock will end up. But we are, I think, if you think about the flight to quality, a little bit more stability in the interest rate environment. The Fed kind of clarified 7 rate hikes. I think there's a feeling that there's containment happening between Russia and the Ukraine, which hopefully will settle that war soon. So I think the market is pouring into companies that they feel more safe about, and Apple's one. But I do think that some of the headwinds will start to impact the stock negatively.
Yeah. I know there are seasonal demand changes that you were noting. As we go into the summer, that's not necessarily the hottest time for Apple. It's usually, I always think of it as the holidays or September, where they often launch new products. But that being said, we do have a little bit of a production cut here that you noted, as well as other things that are happening, right? You have rising rates, and I don't know what else you want to talk about, but I mean, overall, when you think of the Apple ecosystem, it's still very, very strong. There's even talk about a hardware subscription overall. They also had Coda win, right? This is the first time a streaming won, right? For this Best Supporting Actor. I saw that in other awards. That's a big deal, right?
There's no doubt. I don't think it impacts, global revenue significantly, but it does show that their original content strategy is working, and their original content strategy is aimed at driving more Apple services, more people to subscribe at Apple Plus, Apple TV Plus. So I think that's all good for Apple. But I do think that, when you see a flattening yield curve, you see these, production, cutbacks, you see some of the macroeconomic issues that might portend a potential recession. I don't think that's ultimately good for Apple. And so I think there's some good wins in the near term and it may just be that the market hit their stock too great, at the beginning of the year, and that they're kind of getting back to where they should be. But I think that the global economy is going to start to impact Apple negatively, and these small wins that they may be getting aren't going to be able to overcome some of those headwinds.
Oh, wow, that's some tough talk there. Okay, all right, so we'll have to wait and see. That being said, any other tech names that you do like or on your radar as possible winners?
Yeah, well, I mean, listen, like I said, I think there's a definite flight to quality. I continue to really like Google. You know, that company operates in a monopoly environment in search. And, you know, as more and more people access the web, you know, globally, more people are going to be using Google for search. They still have the best business model in the history of man with their paid search product, and their global dominance continues. So I still really like Google. I think they trade at a better valuation than some others. So I do think I would still try and stick with safer companies with, you know, better near-term cash flows that have stronger balance sheets. I think as we head into a recessionary environment, the quality companies are going to rise above the more momentum plays.
Yeah, good to see you, Greg. Thank you for all the details on all of these names, Apple, Google, and more. Greg Martin, co-founder and managing director, Rainmaker Securities. Thanks for joining us, Greg.
Thank you.
Still ahead in the second half of our show, we're going to take a look at Lululemon, the fourth quarter expectations. And we'll discuss what investors need to know about preparing for retirement, particularly during this very volatile market time.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device. Welcome back to the Watch List. I'm Nicole Petalides, coming to you live from the New York Stock Exchange. 90 minutes left in the trading session, and we're seeing this rally continue. In fact, the Dow and the S&P have been up 4 days in a row. The Nasdaq up for the third time in 4 days, and you're seeing the S&P up 40 points at 4616 at the highest level since mid-January. The Dow's up 221 points at 35,177. The Nasdaq up almost 200 points at 15,185. And the Russell, the small caps, the best of the bunch, up 2.5% at 2129. Let's take a look at Lululemon. Lululemon will report its fourth quarter results after the bell today. Combing through the numbers, Michael Keeley, contributor for the TD Ameritrade Network, is taking a look at this one. Very interesting about Lulu when I think about all the competitive companies that came out, Athleta and others, but really Alo Yoga has come out, and that one has been very popular. But Lulu's been a brand love of many. Tell us more.
It's a staple in this area, Nicole, that
really features a secular trend of the work from home, athleisure wear being so prevalent in what we see pretty much every day in terms of fashion styles. And the firm has done an outstanding job of beating their target estimates. Over the last 4 quarters, the average earnings surprise is a positive beat to the tune of 21%. And you might look at the chart and say, well, what happened? The shares were down nearly 40% off of the highs from late last year. And as they reported their third quarter results in December, they actually lifted guidance, but then flash forward to January, where store traffic trends were certainly lower, with Omicron's influence really taking a bite out of people's aptitude to go out and about, especially in January and February. Lulu did, in fact, broadcast a profit warning. You can see the operating margin, the stat that's actually taking a downshift. And that was the big concern that really resulted in a lot of selling pressure. And when we take a look, Nicole, at what investors might be paying attention to, we know that the top line and the bottom line growth parameters are absolutely there. Expecting year-over-year growth on the sales side of 23% should they hit their target of 214. That's $2.14 billion in sales revenues for the quarter. And then on the earnings side, Nicole, that's a year-over-year growth metric of 26% if they hit their target estimate of 327. The firm is not a stranger to trying new things. The two things that they've really gone after to a degree have been the Mirror, which was an acquisition, and they've broadcast to investors that you shouldn't really anticipate anything major on revenues deriving from their acquisition of Mirror, about $130 million for the entire year fiscal 22. That's only 2% of revenues. But Nicole, don't know if you caught this, but they've launched a running shoe. So the footwear being the Blissfeel sneakers, there's lots of crowded store shelves when it comes to running shoes, and Nike's done relatively well. But in terms of the priorities, analysts are a little skeptical because they feel, well, that may distract management from the core business. Others feeling, no, this does make some sense for the firm that's really committed to the fitness portion of the whole brand ecosystem. And so we'll see what happens with the Blissfeel sneakers, which is early stages at this point. But I would say that investors are, sitting well positioned valuation-wise, in light of the fact that Lululemon has a strong financial position, robust free cash flow. They've got an agile supply chain that's not producing too much disruption, and strong operating metrics, with the one miss being the tick down in operating margin.
I thought that was big news about the sneaker as well. I'm glad you brought that up because, sneakers can have great margin, but at the same time, there's so much competition, to your point, and we've seen Nike trying to go direct to consumer. I've seen the sneakerheads run from, and I say that with love because my kids, are big sneaker kids, and they resell them, and they run from Adidas to Nike, depending on who has the hot shoe. So it's a very, very fickle crowd. We'll have to see. Michael Keeley, a great report as always. Thank you very much. Nice to see you. TD Ameritrade Network, Michael Keeley. Now let's think about your retirement. Brett Gottlieb is with us, president and founder of Comprehensive Advisor. Brett, thanks for being with us. So, are the clients calling in? Have they really given you some nervous talk that they've had throughout this year? Because it's been a tough one for investors.
Nicole, great to see you. Surprisingly, they have not, or I should say not surprisingly, actually. When we are doing retirement planning with our clients, we're really looking and focusing on what are the goals that they're looking for? What are they trying to accomplish? Let's kind of block out some of the noise. We've got a lot of things going on in the market, from the run-up of Omicron at the end of this past year to inflation issues to interest rate rise. And so when you have a lot of that noise going on, you tend to have this fear factor come in the market's volatile. What are we going to do? And I always tell our clients, go back to the basics. What are the goals? What are we trying to accomplish? We don't need to be making major, adjustments. We're not market timers. This is retirement planning. I like to tell everybody this is slow and steady wins the race when it comes to planning for retirement.
So that's the idea here. The fact that they aren't calling with the jitters really shows that you do this diversification, but there is a time to rebalance and reallocate based on the current situation or any new news. You may do that once a quarter. You tell us what might be in the plans when you're doing these portfolios.
So that's exactly it. That's spot on. We want to make sure that we are understanding what's going on in the marketplace and making those small adjustments. Quarterly rebalance is a regular thing, depending upon the type of investment portfolio. If you're in a more stock-driven portfolio, it might be more regular. But if you're in your traditional, you're a client, you've just got money in your 401k and you're regularly adding to it, you're getting the benefit of dollar cost averaging, so you don't have to make adjustments. Maybe it's because of interest rate rise, and we know the impact that we're seeing on the ag right now at this point is reduce your bond exposure. Take on that higher level of risk. It's okay. Reassess. Where are you at? Are you 10 years from retirement? Are you 5 years from retirement? Or are you already in retirement and you have an income stream that's coming off of your portfolio? So it's, remaining the course, understanding timing usually doesn't work out for most people. Having cash on the sideline. One of the things that we did with our clients going into the end of the year is let's move some cash onto the sideline. Bonds are a problem, so if we don't want to be strong on the equity side and we need some safety, move to cash. Move to an area where when the market does dip, you can take advantage of that opportunity. Cash becomes king in times of volatility. But again, the biggest thing really when it comes around is people always ask me, what sector should I go into or what company should I go after? And I say, well, if you have a fully diverse portfolio in retirement specifically, not our we call them the sandbox, the play account where you're investing, you're trying to hit that home run, but your actual retirement that you're planning for the future that's going to provide for your income and your needs, you're fully diverse. You're touching various sectors and various industries, and that's going to be your best benefit over time. Like I said before, slow and steady wins the race.
Mm-hmm. Mm-hmm. Well, as you mentioned, you're right. There's the sandbox where you maybe chase some of the growth names and things like that, and then you have your real portfolio that's set up, and you can, protect yourself on the downside. That being said, as you saw tech getting sold off, did you see opportunities there? Do you see opportunities there? Because people love to talk about tech. I'd love for them to have a takeaway from you, whether it's tech, precious metals, anything else, large caps. Is there anything that you are certainly eyeing?
No question. Kind of like the prior two conversations that you had is companies like the Apple, like the Google, like the Amazons. These are large companies. They're staples. Look for opportunities where they've come down. We've got some splits coming up with Amazon and Google here. That's going to be an opportunity for people that traditionally can't, go in and buy one share because of the pricing of it, where they can get in. So those would be areas, no question. Precious metals is something that, in many people's mind has underperformed, but whenever you've got volatility, it's a little bit of a safe haven. It can give you a little bit of protection there. So we always like to say, have that side cash that you can push back into those opportunities as they present themselves. But I'm also a big believer, the large cap, the kind of staples that we see and we deal with on a regular basis is really the areas that I would focus if I was going into individual stocks.
All right, Brett, thank you. Nice to see you. Brett Gottlieb, President and Founder, Comprehensive Advisor. Thanks.
Thank you.
Still ahead, we bring in our panel to discuss the outlook for chip stocks and market factors impacting these companies. Coming up.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CNE Group, where risk meets opportunity.
I'm Jenny Horn. Here's a few more movers to keep on your intraday radar. KeyBank kept its outperform rating on Airbnb, saying its survey checks show that consumer travel is holding up well. The firm said Airbnb is the most levered to a global travel recovery, which has created an upward bias to its current estimates. Airbnb shares are up over 4% and have gained over 5% now year to date. UBS reiterated its buy rating on Levi Strauss, noting it's cautious heading into the company's earnings next week. The analyst said Levi is attractive due to its long-term earnings growth outlook, but in the near term, they doubt Levi's first quarter earnings event will actually send the shares meaningfully higher. And IGM Biosciences shares surged as much as 120% today after the company announced a global collaboration with Sanofi for multiple oncology, autoimmune, and inflammation targets. IGM said the collaboration could generate more than $6 billion in development, regulatory, and commercial milestones. Separately, IGM posted fourth quarter losses that widened from a year ago on no recorded revenue and announced plans to sell $200 million worth of common stock through an underwritten public offering. This has been your TD Ameritrade Network market update. Now back to the watch list with Nicole Petalides.
Jenny Horn, thank you so much for that report. Let's bring in our panel. Jim Keller is with us, Director of Research and Senior Technology Analyst at Argus Research, and Kim Forrest, Founder, Chief Investment Officer at Boca Capital Partners. Thank you both for being with us. Jim, I'll start with you as we have talked so much about the supply chain constraints. Where do we stand now when it comes to the group, and what your thoughts are in that hurdle?
Hello, Nicole. Supply chain crisis remains in place. We're probably not in as dire a situation as we were before. The positive takeaway for the semiconductor industry would be that all of the hardware companies in our coverage, whether it's Ciena, Cisco, HP, Inc., or Dell, they have massive backlogs of business now, and they're going to be filling out those backlogs for, the next 4 to 6 quarters, and that will keep semiconductor demand strong as they build these devices that are unable to build as that backlog's built. But we do see that the situation has improved somewhat.
All right, and so Kim, what are you thinking? I see some names here on your list too, Kim. Tell me a little bit about some of the trends that you like and what you're seeing.
Sure. So I have my entire career been a fan of productive technology. And what does that mean? Well, it's really business-oriented tech that companies deploy, and they can say, oh, I've put this technology in and it has a return for my business and it makes my people more productive. So it's an easy sell, theoretically. So as I look out, I see companies that can't hire enough people. They are going to have to be forced to turn to technology. And I think this is one of the many drivers, maybe the latest driver, that makes me overly optimistic on semis in particular, but technology in general.
Yeah, and Kim, just to follow up, I know you had Micron, for example, on your list as one of the good ones. So you said when things are running hot, you don't hesitate to take some profits, and then when there is a slowdown, you'll add. Where are we now, and what is your plan here?
Well, I think that there's still better days ahead for Micron, and a lot of it has to do with capacity. NAND is something that I follow because, again, it's deployed in productive technology. We're creating more and more data. It has to live somewhere. So I love NAND as the new storage device rather than spinning disks. And I still think, even maybe beyond the 4 to 6 quarters that Jim mentioned, that I think that we have a clear runway of demand and supply tightening up for the next little while. So I am still a bull on Micron.
Okay, and then Jim, let's talk about some of the names that you liked. I saw you talked about the lack of getting the approval for mergers, for example, from China. You had that as a theme. Are there other themes that you're watching, and what names might be winners for you?
Well, that's good that you mentioned that, Nicole, because we've seen a little bit of a thawing in the situation there with China. So, for example, one of our favorite names is AMD, which just completed the acquisition of Xilinx. So Xilinx, it was an all-stock deal, so it does represent some dilution for AMD, but Xilinx has higher margins and also a lower tax rate. And because there's no debt associated with the deal, there's not going to be a significant step up in AMD's debt service or interest costs. So we see AMD as a real strong story here, growing its revenue to over $25 billion this year from about $16 billion last year and less than $10 billion in 2020. And we've raised our estimates despite the share dilution. And just to talk about the China situation, yes, China did block multiple acquisitions such as Broadcom acquiring Qualcomm or Applied Materials acquiring Kokusai. But lately, there's been some thawing. The Maxim integrated deal was approved for analog devices, and the Xilinx deal I mentioned. And what we're seeing is China is responding to the fact that U.S. is kind of threatening to deny access to some key technologies, grow its own semiconductor business, and I think that's led to a thawing in the situation, plus the change in administration. So better signs on the regulatory front there.
And as we talk about, obviously, Internet of Things and AI and autonomous and 5G, Kim, what would you say to folks who are not invested in this group? I mean, what are they missing out on that they must do?
Well, I think they're missing out on the future, right? It's really obvious that even the dumber appliances that we have in our homes are becoming smart. And then there's all the more chips that are needed. A lot, if you're talking about AI and autonomous driving, believe it or not, a lot of those are going to be on the server side as well. So you have just a world that is going to demand more and more information being put in and then calculating information. And what delivers that? Well, it's chips. Simple.
Right. And as we see all these names, Western Dig, Micron, Lam Research, Jim, your thoughts as we're wrapping it up here?
Sure. And to amplify Kim's comments on those, kind of secular demand drivers, there's also cyclical drivers, recovery from the pandemic. People are going back to offices and discovering that their equipment is out of date. They're making more robust, home offices, for the long haul. And then there's the demographic thing, the rise of the global middle class, billions and billions of people joining the middle class and wanting devices that, to Kim's point, have more and more content per device. And then all the secular drivers she mentioned, like, AI and robotics and IoT and you name it. So lots of long-term positives in this industry.
Right, and just a quick thought on memory and how important memory really is, Kim. That was something that you focused on. I know even when we buy our Apple products at home, the kids are always asking for more memory. What a big part of that is, right?
It is, and it's a seemingly dull part of the technology equation, right? But once you're doing stuff and creating content and taking pictures are big, right? And videos, it all has to go somewhere. So it's storage.
Right. Thank you both very, very much. Jim Callagher of Argus Research and Kim Forrest of Boca Capital Partners. Thank you. Wonderful to see you both. A great conversation. We appreciate it. That's going to do it for us here at the Watch List, live from the New York Stock Exchange every single weekday at 2 p.m. Eastern Time. Now be with me every day at 11 a.m. for Trading 360, 2 p.m. for the Watch List. I'm Nicole Petalides. Thank you for watching. Keep it right here on the TD Ameritrade Network because, Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
After the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Good afternoon. Welcome to Market on Close. I'm Oliver Brannick. Boulder celebrating another big day here. The Russell 2000 is jamming right now, 2.5%. The NASDAQ is back above 15,000, really breaching some important levels here. Small caps in particular are peeking their head back into a range that was holding there for a long time before we broke down at the end of last year. So we're retracing some important ground here on charts, and that's pretty exciting. As far as reason, rhyme, don't forget this began the rally the day the Fed first did that hike, March 15th. And then now today we got the story out of Ukraine that Russia might be drawing down some troops from outside the capital. So you get some good positive news flow on one of the main geopolitical issues on investors' minds, and we get reason for some follow through here. Now, over the last couple weeks, there hasn't really been a whole lot of clear news flow as a catalyst for this rally. For the most part, it's just been best defined as a relief rally of sorts. After Jay Powell outlined the path for hikes, got one under the belt, and some relief really hit this market, and we found support and we rallied right after ticking into bear market territory for the NASDAQ. So now that we actually have some news flow around it, I do think things get a little bit more interesting here. How much of this rally has been about the market preparing for some degree of positive news out of Ukraine? I think there's pretty good evidence that that has been kind of percolating here for a couple weeks. So far, up until today, it largely has been best described as a lack of escalation in the warfare and the dialogue between the two sides. But then today you actually get some news flow. If it's to be believed and if it's to be confirmed, the White House says that better, see than tell, and let's see the action instead of the words from Russia. But if indeed this does come to fruition and there is a drawdown of military activity by Russians in Ukraine, then you've got a good reason for volatility to come out of this market. And sure enough, we've got VIX down below 20. Also, for a couple weeks, we've seen a lot of choppiness in crude oil and gold. Those were the two very clearly Russia-Ukraine linked assets that put their highs in several weeks ago. And so as we see them again retreating here today, the question now is what has been priced in? That obviously billion-dollar impossible question, the eternal one for markets that we're always trying to figure out. What did investors expect and what is surprise? So the reaction this morning was a quick, sharp drop, a pretty notable one in crude and gold, but both of them found a little bit of support. Crude more so than gold, but both still down, yes. WTI holding 100, 104, gold trying to hold on to 19. So there is perhaps some message here that maybe the market did price some of this in going into it. Obviously, we're getting an additional selling into crude and gold since the news hit overnight about this potential drawdown of troops by Russia. But what had already been showing up in that crude peak, gold peak, do we get real follow through? Does this inject another leg of gains in the market, or does this justify what we've already gotten? That's what we're going to be figuring out, I think, the next couple days here as we close out this week with a pretty good batch of economic data. Friday, we've got employment, and then tons of Fed speakers, too. And right now, for the most part, they're talking up 50 basis points for the next hike. Tomorrow, the newsletter in the morning, TD Market Minute. If you're watching on the site, go up and subscribe. My edition comes out tomorrow. I'm going to make the case for a 100 basis point hike. Why not? Get it out of the way. So check it out in the morning. We'll talk about it tomorrow. All right, SPHB, the high beta ETF, it's doing the best when markets are up. This is where you want to be if you want to get the best bang for your buck in a high beta ETF. Noteworthy, though, is that this particular fund, even after a 17% rally off the lows, is still very textbook downtrend. But if we do start to rally from here, then it starts to take out that high from February. High beta stocks then would be the leaders in a rebound and a push back towards the highs of the stock market. If we get it, that's just the way it works. Stocks go up overall. The high beta group is going to go up even more. But it is interesting to see how that cuts both ways, because at the lows, the high beta group was underperforming, of course, and was ticking very reliably to lower lows throughout the way. So it's a really textbook downtrend that's still in place here for the high beta fund. You've got the lower lows already very well established, and then even after this rally here, still technically a lower high from the early February, late Jan level, but it's really close. So this is still an impressive move, but just a few charts that I want to point out here this afternoon that even after a lot of strength are still at some areas of potential resistance as we're trying to assess, is this true reversal or is this a bear market rally? That's the question that's mostly relevant for tech and growth names and the stuff that actually went into a bear market, like the high beta swinging stuff. So the Russell and the NASDAQ were the ones that tick technical bear markets, not the S&P and the Dow, because some of the more value-oriented, cyclical, or even inflation-themed assets have been outperforming, of course, so the broad market has done better. For a lot of these deep growth bear markets, though, that we've been in for some time, these charts still need a lot of work to be fully repaired. Now, some places that are outside of that growth category but still got really blasted were the reopened trades too. They were really suspect underperformers, but they do fit into that high beta camp as well. So right now that high beta camp, which is stocks that swing more than the market when the market goes up and stocks that swing more to the downside when the market goes down, is a lot of the growth and tech themes, but then you also have the pure COVID plays, the reopening plays, those epicenter stocks like airlines, like cruise lines, that on days like today do get a lot of particularly strong action. But again, if you look at the airlines, I mean, we're basically just kind of back. This is the JETS ETF. We're kind of back to a point that has been at equilibrium many times over the last 8 months of trading. This is the line at 22 bucks on the JETS ETF. You can see where it had previously been support many times, touch, support, and then we broke down and we got stuck mired in this trading range for a while, bit of a fake out above it, and then when we came back down, we crashed pretty hard here with the broad market. So again, another really impressive rally when you go from $16.88 up to 22 in the course of just 3 weeks. Big moves in charts that now bring us up to, frankly, probably more areas of resistance. So that's where we're at. A really impressive move here, but we still need to get some follow through on some of these. Now, for the most part, all the boxes that I laid out last week in the same newsletter about whether bears were going to get crushed, we've checked off 3 of those 4 boxes. We got Tesla above $1,000. We got Bitcoin above $45,000. We got the NASDAQ making a higher high than in February, but we're still waiting for that dollar to really break down. That's the box that I put out there that hasn't been checked. So far, we're 3 for 4, but the dollar just won't quite break here. It's down pretty big today. We do see that geopolitical safety trade come out of the dollar, given the Russia story overnight, but it still is holding on to its general range that it's put in, and it's been pretty sticky throughout the last couple months. We didn't break out, even as yields broke out, but we're also not breaking down. So the main 2 factors that I think about as driving the dollar, the general safety trade when investors don't know what to do during volatile events like a geopolitical invasion. Money went into the dollar, even as gold was going up. The dollar went up with gold. But then also, of course, the dollar is representing the difference between our hawkish central bank and the rest of the world that's trying to catch up. And those higher interest rates that support the dollar as well as the Fed combats inflation. So if that's what's keeping the dollar bid here as the geopolitical element of the dollar fades out, then it's an important message. We still do need to keep some appreciation for the Fed's potential hawkish path here. And that's why this week, the next couple days, going to be really important to see if we are going to get language from Fed governors that continues to set up that 50 basis points, which then will culminate on Friday's data with employment, which will really give us an idea after last week's jobless claims if Powell is going to be able to hammer home a pretty big hike. And that is possibly what could put this rally back on its heels. Okay, let's talk some more about what's happening today. In the meantime, the rally is looking pretty darn good. Caroline Woods joins us from New York. Apple, amazingly enough, even though it's not taking out highs yet, Caroline, it's put together a really long streak of wins.
That's right, Oliver. It's up about 1.8% right now to almost $179 a share. I heard you mention at the top of the show there's not a lot of clear news for the rallies. Sort of the case with Apple today, but it's on pace for its best winning streak since 2003. It's officially positive for the year, up about 0.7% right now, so it's wiped out all those year-to-date losses. The last time it saw, so it's up 11 straight days. The last time it saw a winning streak like this was back in 2003. It had a 12-day winning streak pre-iPhone. Back when Apple's fastest growing product was the iPod. The iPhone didn't come out until 4 years after that in 2007. but very much could be about broader optimism around those ceasefire talks between Russia and Ukraine, or de-escalation talks. I will say that there was that Russian presidential aide who said de-escalation by the Russian military is not a ceasefire. So
right.
It's hard to not be skeptical about that.
Agreed.
But of course, Apple's Coda won Best Picture at the Oscars, making history for a streaming service win. And it's really happening despite those reports of production cuts of the iPhone SE. So investors shrugging that off. It seems a bit maybe like a FOMO trade. I was looking at a note from Dan Ives saying many investors were caught off guard by this rally and are now playing catch up, with Cupertino front and center, of course, referring to Apple. He was on Trading 360 with Nicole, reiterating his price targets of $200 base case, $225 bull case, north of $3 trillion market cap once again. So a lot of positivity here, but no clear reason why.
Yeah, okay. So risk on. Apple moves with the wave of buying in this market, even without any particularly great revelatory news flow. In fact,
risk on, but keep in mind some of those growth stocks that actually have earnings that aren't emerging companies have already been in a little bit more in favor this year. So risk on. Right.
Depends which group you're talking about. What about the cloud stuff, Caroline? I know there's some notes out on a few of the big names there. That was deep entrenched bear market, one of the worst sectors within the last 6 months. But how are analysts feeling about the recent bounce?
This should tell you something about momentum today, because BNP Paribas actually downgraded Workday to neutral from outperform, adjusted its price target to $230 from $305, yet Workday is up 1.4% today. Meanwhile, downgraded Snowflake to underperform from neutral and adjusted its price target to $190 from $220. It's trading at $239 today, $240, up 2% today. So clearly, again, shrugging off the bad news. I mean, I will say analysts overall are still very bullish for Workday. 35 buys, 2 holds, 0 sells. Snowflake as well, 22 buys, 8 holds, no sells.
Wow.
Or actually, I guess 1 sell now with BNP Paribas. So take that from the neutral camp, the hold camp. But it's so pretty bullish. But despite a bearish note from BNP Paribas, stocks move higher.
That's pretty amazing, considering that Snowflake is one of those charts that has very much still been stuck in a downtrend, even after the big move off the lows. I mean, just real painfully obvious trend downwards here. It dropped 57% off the highs, and nobody turned the rating around to sell until now. That's pretty wild.
Well, it's down about 30% year to date. So.
Ouch. Okay.
Yeah.
All right.
One sell.
Okay, but doesn't get in the way of a nice bullish day. Snow up 2% right now.
I'm interested, though, Oliver, to hear more about your 100 basis point hike thesis, because I did ask a guest on the show last week about it. I don't think that the Fed will do it without very much preparing the market for it, but I might not be in disagreement with you there.
There we go. All right. I'm going to try and convince Jay Powell. Maybe he'll sign up. Mr. Powell, if you're watching, click the link above. Doubt it, but guy can dream, right? All right. Thanks, Caroline. Appreciate the walkthrough here.
Let's get it over with.
All right, some big moves in stocks today for those that are deep in bear markets, and for those that have been strong. Generally a pretty good broad rally in the session, and plenty of optimism in cloud companies, even despite some downgrades. Okay, so is the worst past for us? Let's bring in Kevin Rendino, a CEO at 180 Degree Capital, publicly traded investment management firm under the ticker TURN, Turn. Kevin, welcome to the show.
Good afternoon. How are you?
Okay, so when people buy your stock, when they buy Turn, what are they buying exposure to right now? Walk us through your strategy.
They're buying a collection of small micro-cap companies, value-oriented, Graham and Dodd value approach. That's about 70% of our book value, and they're also buying about 30% of our holdings are in private companies. The company that we took over the predecessor company was called Harris & Harris, and it was predominantly a VC a BDC focused on VC investments, and we've been winding down those private businesses. But today, Turn is focused on small cap, micro cap companies, Graham and Dodd approach, value orientation, and we're activists. So that's what you get when you own 180.
Okay.
By the way, I agree with your 100 basis points.
All right. You think the Powell should lay down the hammer?
I don't think he will, but I think he should have. They're already late, obviously. They should have been doing this last year. Only until 2 weeks ago, they were still buying bonds. So I can't take him seriously when he's talking about fighting inflation. But you didn't ask about that.
I do not believe he will do the 100 basis points either, but I think it's worth a case being argued for. Kevin, it's interesting to hear you say that because looking at the way the market has changed since he has tried to get more hawkish, small caps have gotten blasted, even worse than some of the tech stuff. The Russell's been the worst performing index since November. So how come a small cap stock picker wants or thinks this should happen?
Well, it would have been a better conversation to have had in November. Look, you want to buy small caps when there's blood on the streets. You want to buy small caps when the VIX is at elevated levels. You want to buy small caps when the consumer confidence numbers are as low as they are. You want to buy small caps when it's a risk-off environment. And obviously that's what's happened over the course of the last 3 or 4 months. First, starting with interest rate fears, supply chain issues caused by the pandemic, causing inflation, and then obviously most recently Russia's invasion of Ukraine. If you look back where we were since November, the Russell microcap index is down 25%. So the time for being safe was in the fall of last year. The time for getting a little more aggressive, we think, resides now rather than November, because we've already experienced a lot of the pain associated with a market that's been in a drawdown, and a significant one over the course of the last 5 months.
Even with that drawdown, the Russell 2000 remains 24% above its pre-COVID high. How much of a deal are we getting? How much of a sale is this really, Kevin, when we're still a quarter of the value higher than we were at the pre-COVID high?
Yeah, but the earnings of the Russell is infinitely higher than it was pre-COVID. So the market multiple is a lot lower today than where it was at the onset of the pandemic, and obviously in the 6 months after the pandemic. So one of the things we always say to ourselves is what matters the most is that the absolute value of earnings goes up. The change can be lowered. You know, the relative percentage increase year over year can go from, let's say, 10% to 7%, and the market adjusts during that period of time. But as long as the absolute level of earnings goes up, rather than go down, then the market is set up for a good one. And that's not only for small caps, that's for mid caps and for large caps also. And we do see earnings increasing here from where we are today over the next 12 months.
Kevin, when we think about the small caps that you like, when we're envisioning your portfolio, start by giving me your view on the kind of two extremes, where if we define those extremes as companies that were at the epicenter of COVID risk, travel stocks that really got crushed, and then on the other end, the very high-tech COVID beneficiaries, that extreme growth category of tech. If we kind of view those as being on opposite ends of the spectrum for the market over the last couple of years, do you dabble in either of those extremes? Do you believe that small tech businesses that have gotten beat up have opportunity? And how about the other side, the COVID trades that also got equally beat up the last couple months?
Yeah, well, this pandemic has gone on a lot longer than I think any of us would have hoped on the one hand. On the other hand, we got a vaccine quicker than any of us could have possibly imagined. And so our view is, and we've had this view for some time now, that you want to play the reopening up of the world. You're seeing pockets of COVID impact in areas that don't have the same vaccination rates than, let's say, the United States has. And that's caused a lot of the supply chain issues. You know, if you think about what we import from Asia as it relates to information technology parts, whether it's routers or chips, I mean, Ford has been talking about this forever. That's where most of the pain has occurred in the last 4 or 5 months. And we think we're playing for a resumption of normalcy, the end of the pandemic. And so for us, we're trying to play all those industries that have gotten beaten up because of these supply chain issues that have really wreaked havoc. Those are companies like Quantum Corp, or any of the semiconductor companies that basically import a lot of their parts from Asia. That's where our focus is on today, because that's where valuations are at their lowest. We're buying companies like Quantum at levels they haven't seen in 5 years. So for us, we're more playing that. The COVID stocks that, you know, the Pelotons of the world, that's not where our focus is right now. Our attention is on all the areas of the economies that have gotten beaten up here in the last 4 years, as Omicron really has wreaked havoc on the supply chain, really starting since Thanksgiving of the past year.
Quantum Corp QMCO, I'm looking at the chart right now, sitting at multi-year lows. To your point, appreciate the specific pick there and the macro analysis this afternoon. Kevin, good stuff. Looking forward to more. Thank you.
Good talking to you.
Yeah, absolutely. Kevin Rendino, CEO at 180 Degree Capital, turns the ticker to URN. Coming up, let's check back in with Tony Zhang. Last time he was here, gave you a pretty good trade that worked out. We're going to check in on that one and then get a new trade as we continue to think about energy. Last time around, Tony was looking for some upside in the solar plays, and we've gotten some of that. Let's check out American Water for another utility-exposed stock when we come back.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Market on Close. Let's do some trading with Tony Zhang, joining us, the chief strategist at Options Play. Tony, welcome back to the show. Let's do a little trade management here from your bullish TAN trade, the solar ETF. Last time we spoke, March 15th, couple weeks. It's been grinding higher here.
Yeah, that's exactly right. It's grinding higher. It's doing exactly what we were expecting to stay above that $74 level, currently around the $77 level. So the put credit spread that we sold is roughly at 50% of max gain. So the best way to manage these types of trades is that if you've traded only a single contract, now is about time to take profits and trade the next and put it into the next trade. But if you traded multiple contracts, this is a time where you can take half the contracts off, take some profits, but leave the other half on to potentially make the full 100% of the credit that you received on this put credit spread.
Okay, sold the, here's the tan 77 right now, and area on the chart that gets kind of interesting. Another one of those that's sort of back into a level that had been support, $70, when it was trading above that as high as $100 from a year ago up through last November. So I like the point of maybe taking some profits at this juncture. Okay, so Tony, now you're thinking about utilities, water utilities in particular. Why is that?
Yeah, so if we look at utilities as a sector, this is right now the strongest sector we see in the broader markets. Utilities recently just broke out above the $72 level, which was the all-time high. And I think this is an important level for us to start paying attention to utilities as a sector. And you can play this by either going along the XLU as a sector itself, or you can play this with some of the individual names. And I was looking at American Water Works, one of the darlings, if you will, of this particular sector in 2021, but recently had this huge 24% correction recently. And I think this is potentially an opportunity for American Water Works to play a little bit of catch up here. It was one of the best performing stocks in this particular sector, had this significant drawdown, which did reset valuations. American Water Works, by far one of the most rich, if you will, in terms of valuations in this particular sector. This reset, I think, provides a better entry opportunity for some investors who may have missed out on the moves we've seen in American Water Works last year. And if you look at the chart patterns here, recently over the past month or so, what we've seen is a completion of a bottoming formation, which actually just today completed. It's that inverted head and shoulders pattern that we saw complete over the past week or so. The neckline's around 161, 162, and we just got the breakout here today. So I think the timing on this particular trade is great for this breakout back into that 175 and even as high as that 189 all-time high we've seen here on American Water Works.
Okay, so the call spread 175 you're selling, the 165 you are buying, and we're pretty much they're about $1 away, the 165. Right now we're at 163.80 cents roughly. So looking for an extension of this move and a nice push higher.
Yeah, that's exactly right. Earlier today, when we were looking at this, we were actually looking at the 160, 170 just before the breakout. But now that we've seen the breakout, we're moving the strikes up to the 165, 175s, paying about $3.60 for this $10 wide debit spread. So paying just a little under 1/3 of or just above 1/3 of the vertical width. That means that the potential reward is 2/3 of that $10. So almost a 2-to-1 risk to reward ratio if by the May expiration, which is roughly 52 days from now, you see American Water Works trade towards that upper strike 175, which I think is a fairly conservative target given the all-time highs are in that 190 range. If it trades above that 175 area, you're looking at a 2-to-1 risk to reward ratio. This is an opportunity to take some profits, perhaps some partial profits, and keep a part of a position for that 2-to-1 risk to reward ratio, and then potentially even rolling that to a higher strike price, again, targeting that 190 high to the upside as we get into the second half of this year. Okay,
so you're pretty bullish on this and ready to extend it if we do get that move. But right now looking for just a continuation up here at 164 roughly. And a stock that's made a pretty giant U-turn for your utility. Quite a volatile stock here. Tony Zhang, great stuff. We'll check in on the trade shortly. Appreciate it as always. Chief Strategist.
Thank you so much for having me.
Yes, sir. Absolutely. And options play coming up. Let's get some options trades from Mr. Tom White. He's got Upstart, Fubo, and Pulte Group on his list with some interesting options action coming up next.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Bullish day means we've got some bullish trades. Tom Wyatt joins me from the TD Ameritrade newsroom with some options corner content for us. Tom, Fubo, Upstart, Pulte Group, 3 bullish trades for us. Okay, since Upstart and Pulte are connected to the housing trade, let's go there first, Tom. A group that has been really getting slammed, but not just some of the more growthy themed companies you're looking at here. The home builders themselves with Pulte have been deep down in the dumps. So Upstart, though, has been really, really brutal. And even after a big rally today, it's still just kind of sitting at one-year lows.
Yeah, I mean, remember, this stock was over $400 less than a year ago, Oliver, so it's had a pretty big slide. Still down about 20% so far this year, even with the 10% pop that we're seeing today. This cloud-based AI company in the lending business, their reliance on third-party funding. They've never been, this newer company's never been battle-tested through a true recession, and a lot of people are calling for that. And with the geopolitical risk along with inflation, what does that mean for this? Stock was downgraded last week by Wedbush, put a price target of $75 on this company, down from 110 based on weakening trends. But with that 10% pop today, you're seeing a lot of flows into this name, especially in the April 1st weekly options, real short-term speculators in there around that 120 strike. But the one that stuck out to me was out in the April monthly or April 8th weekly series that expires in 10 days. They were buying the 140 strike calls, some YOLO calls for you, Ollie, where they were buying something $20 out of the money to the upside on these calls. They bought about 8,000 of them, average debit of about $2.60. That takes the break even for this trader, where he's profitable at expiration at the 142.60 over the next 10 days. That's about 18% above the current share price. But like I said, the stock's up 10% today. You get a couple more days like that, you could easily see it above 140. Call volume's double the normal daily average volume that we've seen over the last 5 trading sessions. And as I mentioned, they were also piling into a lot of the 120 strike calls in the April 1st weeklies that expire in just 3 days. So bullish flows in this company. It's down 70% from those all-time highs, above 401 last October. So, but somebody buying some YOLO calls here. And look at you. I mean, even $20 out of the money with only 10 days left, Oliver, they're still paying a debit of $260 on these out-of-the-money calls. So still a lot of option premium in there. Implied volatility really elevated in Upstart on that slide over the last 6 months.
Okay. So, Tom, they're looking for a pretty nice bounce here that could still, I mean, be well within the recent trading range, 150, the highs from earlier in the month and last month, but a stock that every time it seems to get started fades right back down. Mm-hmm. Okay, well, what about Pulte Group in the home builder category when we've got, stock still sitting now, $45? It's been here multiple times the last couple months. Can't seem to turn the trend around as so much else in this market catches a bid. Home builders looking still pretty weak.
They are, and we talked about this this morning on MTL with D.R. Horton, and now these PEs are getting contracted to where Pulte's at about a 6 PE, and demand for housing is still out there. Their backlog continues to grow, but what are some of the headwinds, right? Inflationary pressures, supply chain issues, and also rising interest rates, right? The 30-year mortgage is getting close to 5%. That thing was at 1 or 2.9%, Oliver, just a year ago. So think about that, what kind of pressure that puts on the housing market. But vacancies are at their lowest rate in 5 decades. That builders need to build more, right? Not less. So there's a lot of conflicting headwinds and tailwinds for this particular group. Stock's up over 3% today, still down about 21% so far this year. And traders are coming in there kind of reassessing a position that they had because they sold out of some long April calls that they had that didn't work out. And they bought the May 50 strike call 10,000 times in here for a debit of $1.05. So that break even of 51.05 to the upside, that's about 12% above the current share price in there. And call volume is about 21,000 total calls across all option series, with only about 300 puts traded on the day. So call volume is about 10 times normal daily average volume that we've seen over the last week in Pulte homes. But somebody kind of rejiggering their bullish stance in here. But you need a move of 12% above the current share price into the May expiration, which is 52 days. So will the housing home builder stocks kind of rebound here? You don't know, because we've seen a lot of price target cuts across the board as a lot of the analysts think this is mid-cycle, and it doesn't bode well for the rest of the year. But at the same time, some of those things I mentioned, the low vacancy rates, the demand built up for new housing, but affordability has become a real issue along with rising rates.
Yeah, okay. So home builders have a few pretty big headwinds that don't look like they're going to turn around anytime soon, even though they've got that massive tailwind of lack of supply still and a lot of demand. We'll see if the bounce can apply to home builders. Seems to hit every sector right now, except for this one. So some conviction, I guess, in the weakness. We heard the bull case from Ken Leon on KB Home yesterday. Tom, last trade you got Fubo TV, the sports streaming company that has just been really, really punished. Yeah. Another one with a big bounce that barely registers when you look at the long-term chart. You know, it's hard to even see it after it went from $35 to $6. Yeah.
Yeah, and stock's still down 50% this year, even with the 9% pop that you're seeing in the shares today. They did partner with the leading data-driven analytics firm, Kantar, recently, hoping to leverage their advertising and marketing campaigns. That's a positive. They did deliver pretty decent results last quarter. They got dragged down by Roku in this particular space, but you know, revenues did rise 120% year over year to over $230 million. So there were some positives, but look at that chart right there. It's just a falling knife. Even with this 9% rise today, it's just a blip on a falling knife type of chart there. But that being said, anytime you get Fubo moving around, you get a lot of the speculators. We've seen the meme stocks, the speculation in GameStop, AMC, even Bed Bath & Beyond. Now you're seeing it in Fubo's, can be considered in that mix when it goes up. You get the speculators out, no different here. They were out there buying the April 9 calls just out of the money to the upside. They bought 25,000 of those earlier today for an average debit of only 45 cents. So that break even of $9.45 to the upside. That's still about 23% above the current share price. It doesn't look like a lot on a dollar basis. It's less than $2 move to the upside. But on a percentage basis, you need a pretty big spike, and you're only giving yourself roughly 16 days in this position. Call volume on this one also 10 times normal daily average volume that we've seen in there over the last 5 trading sessions. So anytime you get a little blip in some of these stocks, you see the speculators coming out trying to scoop up some cheap out of the money calls. But we've seen that not work out over the last 6 months or so in the markets.
Okay. Bulls on parade today. Yeah. Big showing. A lot of speculative call buying on the assumption this rally resumes. Interesting finds. Tom White, thanks. A couple of housing-related trades for us. and Fubo TV coming up. Let's get back to the macro discussion. We saw a pretty big move in crude oil, but then it stopped. We found some buyers. Still a bad day for crude bulls, but it looked like it could have been a lot worse this morning. What is the market telling us? Perhaps that we should wait for more concrete evidence that Russia is really dialing back forces. Let's talk about whether or not you can trade that headline with Scott Bauer coming up.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
I'm Maria Schrader. Here are a few stories to watch this hour. General Motors announced that it has so far received over 65,000 reservations for the all-electric GMC Hummer and will increase production as a result. New orders will likely not be fulfilled until 2024 due to the strong momentum of orders. The Hummer EV pickup's price starts at over $100,000. GM shares are up over 4% today. Meta Platforms announced that it is establishing a new engineering hub in Toronto, expected to create 2,500 new jobs over the next several years. The hub is meant to build extended reality experiences. However, Bloomberg reports that Meta will no longer be building a data center in the Netherlands after facing local pushback. Meta is up around 3% today. And Stanley Black & Decker shares rose today on speculation that the company could be a potential target for activist investors due to underperformance versus peers and during COVID. Activist Insight writes that an outright sale might be too much to ask given the size of the company. The stock hit a 52-week low yesterday, but is up over 3% today. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Rennick.
Crude oil dove overnight on headlines that Russia would dial back its presence in Kyiv militarily, but then WTI found some buyers, and it's been pretty firm throughout the session. Let's bring in Scott Bauer to talk about whether or not traders should be trying to game these headlines. Scott, the most dangerous trading game right now, trying to predict what Putin is doing, or did we have Scott Bauer? Okay, the most dangerous game is trying to get the hit off the ground. All right, there's the chart. Down 1% right now. At least we got his audio, I believe. Scott, you hear me?
I got you.
Beautiful. All right, talk to me, Mr. Bauer.
Oliver, this is such a tough trade. We all want this to happen. We all, from the humanitarian side of this, want this to happen. I don't know that anybody really believes it's going to happen. I think the bigger question is, though, Oliver, and I actually reached out to you earlier today about this, is what happens if there is a ceasefire? What happens with all of the sanctions put in place over the last month or so against the Russian economy? Do we just pull those out right away? Does oil start flowing again? What happens to all of that? So I think that it is a very, very tough trade. I would be fading the rallies and the sell-offs that we saw today based on, unfortunately, there being some peace negotiation.
Interesting. So a shorter term type of trade here, Scott? You think maybe some of this optimism has got extended?
Absolutely. I really do. I think that it is very tough to judge
of course, turbocharge corporate earnings. Margin will also help them. So there are a lot of things going on, different factors that affect different banks differently. Citi, by the way, has the lowest price to book. And there's a tremendous restructuring going on within that organization. Again, longer term, I think it's a great value.
So Wells Fargo, longer term, great value. Any other particulars here that are the highest on your list, Chuck?
Well, I'd probably put Bank